feel for how we are seeing, as consumers, as shoppers, this holiday shopping season? How are we interacting with AI?
Thanks for having me, Alexis. And yes, it's been quite incredible to see how consumers are starting to go to these AI shopping models as their first stop in product discovery. So think about it as doing outsourcing your research, making your discovery for holiday products much more effective and efficient. And actually, what's really interesting is that we saw this at the pivotal moment in Black Friday. Traffic driven by AI to these US retail websites, it actually jumped 805% year over
Wow.
year on Black Friday. Yeah, and that's
Are
according to
there,
Adobe Analytics.
I'm curious if there are like particular searches that people are doing, right? With
Exactly,
AI.
because AI doesn't rank products the way that Google research does, at least
Correct.
from my experience. So, what
Right.
actually determines which products get recommended or not by an AI assistant?
Yes. This is actually the key difference between optimizing for traditional SEO search versus AI shopping. And so it is important to know that user prompts don't actually influence what specifically gets surfaced. You have to remember the shopper's history and their personal context that the model has learned about them over time is what's influencing the answers. So, for example, you and I can type in the same exact prompt and get wildly different answers. Now, obviously, the prompt does have some influence, but the model knows a ton about you and a ton about me, and it really curates and personalizes its responses to us. So, one of the major differences from the SEO play of the old and the new is focusing on how the model interprets information about your products for the different persona types, the different prompt types, the different product categories, and not optimizing for those individual prompts.
So, for brands listening right now, what are one or two things that they can still do this season to improve their chances of showing up in these AI recommendations?
Yeah. The number one thing we talk with brands and retailers about is focusing on the accuracy of their SKU level data and not focusing so much on brand level storytelling. That's because a lot of these AI models, what people don't recognize is they recommend products. They don't actually recommend the brand or the brand narrative. So, products that really, if you focus on your verified SKU data, they're 60 times more likely to be selected in ChatGPT than those relying on
Okay,
broader
guys,
brand
I got it all
storytelling. And
back up,
what
kind of
is
getting my new
really
stuff
important is
down.
these
But
crawlers, these AI bots are looking at your
all right,
website
I'm gonna
every
sign
15
off for
minutes.
the
So you
day,
can make changes that can be
and I appreciate
instantaneously
everybody
shown.
hanging
It
out with
doesn't
me
have to be
this
something
week.
that you're trying to do over a 6-month period like SEO used to do.
How can
Um,
we use AI, I guess, to our
and
advantage or
I
more
got I got
smartly
everything
when we
centered. It's
are
gonna run through
searching for
Asia
certain
and Europe,
products?
and I'll be
Are
back
there
on the
sort of,
mic tomorrow morning. And
ways that we word
everybody have a
things,
good evening.
little
We'll talk to you
hacks or
tomorrow.
tips that you have
Godspeed.
for us?
Yeah, what's actually
Weatherman out.
interesting is, remember how we as consumers all used to have tabs open and read reviews and then look at an influencer post and then go to different retailer pages. What you don't realize is subliminally you're doing your research. You're looking at all these different places to compile your opinion of what product you should purchase. So influencing the model is also asking it the same detailed questions that you're essentially reading the review or the influencer post to learn. So making sure that you make that clear. I want something that is vegan and I want it to be safe for my 13-year-old and I want it to be under $20 and I want this many reviews. Like ask it all the things that you are independently looking for. And today, what's really impressive and exciting about this and why the consumer trajectory has grown as it has is because an AI compresses that entire very time consuming activity into a single step and giving you a recommendation. It'll give you a better recommendation the better question you ask it.
So, looking ahead to 2026, does AI driven shopping level the playing field, or does it risk concentration among the big players? I mean, does it actually help the smaller shops and smaller businesses?
Yes, that's the one thing I like to say a lot. It's actually leveled the playing field for small brands. There is an outsized opportunity for these smaller brands to compete with the larger ones. So, unlike paid search today, where a brand can pay to have their product listed at the top of a Google search, that doesn't exist in the AI models. And also, AI doesn't hold brand affinity. It is truly just a machine reading your data and working to find patterns and inferences about all the data it finds about your products across the internet. So if you win the data game for the machine, you will win the consumer eyeballs.
All right, Kimberly Schenk, co-founder and CEO of Novi, there in San Francisco. We know we're going to be dealing a lot more and interacting a lot more with AI, not only us as consumers, but businesses as well. So thanks for giving us that roundup. Appreciate it.
Academy.
We're still going to continue with the AI space because there's just still a lot of development. So the top two are California becoming the first in the nation law mandating large AI developers to publish details about their efforts to prevent public safety risks, and New York becoming the second state to restrict the most advanced AI under legislation signed by Governor Kathy Hochul on Friday. And with us to discuss all of that and more is Mel Walker. She's Managing Director and the Data and AI Practice Leader at Cohn Resnick. She joins us live from North Carolina while we sit here in the Interactive Brokers studio. So Mel, thank you so much for joining us. So California just passed the SB 53 on AI transparency and safety. In plain English, can you explain what that law requires?
Yeah, thank you for having me. I appreciate that. Yeah, basically, that law is really pushing these organizations toward transparency. That was truly the goal of this particular law. We've actually had a couple others. Colorado has one as well, and that one was a little more focused on high-risk areas like employment and education, whereas SB 53 is more focused on transparency and a lot of self-reporting for these organizations, where it's encouraging them to use frameworks and report that they're following those frameworks. Excuse me. And there are fines and penalties if they're not doing that.
So let's just break down just for a minute, because we're here in New York. So I'm very interested in this bill that, or this law that Hochul has now passed regarding AI and transparency in the state. How is it different from the one we see in California, Mel?
Yeah, that's a really interesting question. I have to say I'm not as much up to speed on that one just because it was just closing in on Friday.
Yeah.
I'm a little bit lagging on keeping up with these. They are moving so quickly.
It's moving so quickly for an area that didn't have a lot of regulation. It seems like a lot of states are sort of jamming it in, right? At year-end bills and things like that.
Well, that's exactly right. And also, the Trump administration just signed their EO, which is trying very hard to prevent all of these states from doing this patchwork legislation. So we've got a lot of infighting going on within the political arena, and it's making it very difficult for the organizations to try to make sure they're compliant and they're doing what they need to do on their side.
So with the SB 53, let's stick with that since that is less new. Which companies need to care more about this? Only big tech firms or really any business using AI tools?
Yeah, that's really focused. That particular law is focused on what's called the frontier model developers, and that is a very specific class of organizations that are large in size and really developing this particular technology and on the forefront of that technology. So they are trying to make sure that they're focused on the larger organizations that have over 500 million in annual revenue, and focusing on making sure that they're the ones that are self-reporting and being very transparent in their policies.
Do you see opportunity for some of these companies? Who maybe is best positioned, with these new laws being enacted? And I'm sure we'll see more states jump on board with their own laws in the new year. But is there one area of AI or particular companies that you think have a little bit of an edge because they're better positioned than others?
I do think there's a particular area where there does seem to be not only bipartisan support, but almost across the board support. And that is when we're talking about safety for children. I think that's the one area that we have good alignment and support to try to get something across the line. However, because of the recent EO that was passed, that part of that EO is saying that these states are not going to be recognized for the laws that they're putting forth, and potentially withholding of federal funding. So there's some teeth there for, the non-adherence to what's going on. And, I don't know what we're going to see moving forward other than more chaos happening, but we do need to come to some kind of alignment so the companies can start to make sure they're being compliant with all these laws that are happening.
Thank you so much, Mel Walker. We have to leave it at that. She's the managing director and the data and AI practice leader at Cohn Resnick. She was joining us from North Carolina. Thank you so much. There's really a lot of things to talk about in the AI space. To her point, it's hard to keep up.
It's hard to keep up. I think it's hard for companies to keep up and to keep up with the regulation. I think it's so much coming at us, right? And then we talk about AI and how it's impacting the job search and how so many folks who are graduating, recent graduates, are finding that AI is taking a lot of those entry-level positions. So I think it's hard to find an area really of our economy that has, even though it's a nascent technology, that has not yet been touched by AI.
Or even Federal Reserve Chairman Jerome Powell in his FOMC meeting recently mentioned how AI will affect the productivity of all the labor market.
That goes to, everybody's talking about it.
Everyone's talking about it, and we still don't know what it would mean. Some people are saying that it may not be that bad, but who knows?
Yeah. All right, guys. A lot more to talk about. We're talking about Uniqlo, how it looks in this retail landscape. This is Bloomberg Business Week.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all advancing today. Silver, gold, both climbing to records. The S&P up 44, gain there of 0.6%. Dow up 227. That was a gain of 0.5%. NASDAQ up 121 points. NASDAQ Composite Index up today by about 0.5%. The Bloomberg Mag 7 Index up 0.5. Russell 2000 Index of small cap shares was up by 1.2%. 10-year 4.16% with the 2-year 3.50%. Gold up $107 the ounce, up 2.5%. West Texas Intermediate crude up 2.6%. WTI 57.
Regulators. We regulate any stealing of his property. We're damn good too. But you can't be any geek off the street. Gotta be handy with the steel, if you know what I mean. Earn your keep.
Regulators!
Mount up!
Affiliates. She was a guest on Bloomberg Business Week Daily.
I think that when you have very, very narrow leadership, the danger is always that there's a hiccup in something, and whatever it is that's driving that narrow leadership. And we saw that recently with the whole AI story, people wondering whether or not these stocks are overvalued. But I think one of the things that you're seeing is that a lot of other stocks are benefiting as well. So as long as people have a lot of options to choose from that continue to do well, people will stay invested.
Quay Nguyen, Chief Investment Officer, Equity Strategies at Research Affiliates. So again, recapping here, a move higher on this Monday. Start of a new trading week. S&P up 44, 68.78, gain there of 0.6%. The Dow up 227, up by about 0.5%. NASDAQ Composite Index also up by 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie. This is Bloomberg Business Week. It's 4:42 on the clock. I'm Isabel Lee alongside Alexis Christoforous. We're filling in for Carol Masser and Tim Stenovic, who are both out on vacation, as they well deserve, although we are jealous because we're stuck here in this
and
cold
we're here
studio.
tomorrow, too, so you can't
We're
get rid
here
of us
tomorrow,
too.
too. We're live from the Bloomberg Interactive Brokers studio. We're streaming live on YouTube and Bloomberg Originals. So, Alexis, we were just complaining about how cold it is, and I must say I love Uniqlo because one of the things I love about their brand is their heat tech products.
It's very cool. I have a few of those pieces.
It's these things you wear under your clothes, and they really just protect you from the heat. And I think they have just fantastic basics, thermals, and even simple bags. And I'm excited because our next guest talks about just that. We have Bloomberg News senior editor Reed Stevenson, who is based in Tokyo, and he spent time with the billionaire founder of Uniqlo and has all the best details in his story. So thank you so much for joining us, Reed. Maybe we can first start with how it was like spending the day with him. You had a ton of details in your story, rich nuggets, like when you checked out with him and he was employee number 1. That was what his ID number said. If I was the employee he was talking to, I would have just been scared. But can you tell us more about how that process was like and what was like getting to know him?
Yeah, in fact, I was a little worried about even putting that number out there because, I don't know how the system works, but somebody could use it and actually get the discount. So it's not my fault if that happens. But yeah, going to the store with him was just really, really fascinating. I mean, he, came up with the concept, and he is the sort of the gravitational center of the company. He thinks about clothes. He thinks about retail, how to present them, how to sell them. And, that's made him a billionaire. Japan's richest person, depending on the stock price, and like the 31st wealthiest person in the world. But really just when you walk through a store with him, he's just like a store manager, right? He will touch the clothes. He'll, check out the sleeve and the hem of an item.
He's really hands-on then, Tadashi Yanai, the CEO there. Yeah.
Indeed. After, building such a large business, he still really, really enjoys going into the store, looking at the products, looking at the customers, seeing what they're doing, and just kind of staying in touch with the pulse of the consumer. And for example, he was very good friends with the store manager. He visits the store all the time. This is actually one of two that are located in Ginza here in Tokyo, and everything from the checkout process to what the mood is like to the actual products, you really get a good sense of how he runs the business just through a single store visit.
Mm-hmm. Who does he consider his biggest competition? Because I know that he also has big aspirations in the retail space, doesn't he?
He does. He is looking to reach 10 trillion yen in revenue. He hasn't really given a specific time frame, but it's triple current sales. Now, look, if you sit down and ask him who's your competition, he's not going to mention Zara, right? It's kind of obvious, but he thinks, and the people who work with him closely on the products, the styling, everything, think that Uniqlo has evolved from low quality, low cost to high quality, high style at a reasonable price. So he thinks that the clothes can be paired with a Chanel, right? And in fact, I think these days when you do kind of open up a magazine, if anyone remembers what magazines are, I mean, there are even tips on pairing Uniqlo with high-end fashion clothes. And that's kind of what they're going for, that they think that they've reached this sweet spot given their technology, you mentioned heat tech, scale, where the garments can actually have a longer kind of life in your wardrobe and paired with a lot of different clothes. That's why, you don't see logos on them. That's why you see him hiring, designers who really think hard about, what styles will sort of both be new but also endure. And all of that, really, you just get a good sense of when you walk through the floor and you kind of listen to him talk about, the business.
I didn't actually realize the enormity of Uniqlo. They have $22.9 billion in annual revenue in 26 markets. What makes them so different? You talk about the quality, but is it really just that? Do they have more of a strategy? Because you also talk about in your story how they tried to debut in the U.S., in New Jersey, and then they failed. So they must have done something right the second time. I mean, Tadashi Yanai, CEO of Fast Retailing, said that he wasn't... it was a challenge, but it didn't stop him. That's why he debuted the second time. Do they have a secret sauce when it comes to their strategy, other than
I think it's... Yeah, there's a few things. I think it's a willingness to fail. They have persistence, and then I think just it sounds very basic, but just the ability to really manage a supply chain. The RFID tags that actually help with checkout were originally conceived to track distribution and inventory. Actually, it was only an afterthought that they ended up being used at the cash register. But what they're actually for, and it's an added cost to each garment, is to track products as they go from the factory all the way to the store and to keep losses at a minimum. And so a lot of thought goes into the actual production and delivery of clothes. Now, the other element you spoke about, which is really how well known they are, there's still a final challenge remaining for them, which is Middle America. Uniqlo has done well on the coasts in California and in New York and, up and down the East Coast. But really, in order to kind of create a true global empire, and I've spoken with relatives in Middle America who still haven't heard about Uniqlo. And for Yanai, he sees this as a challenge. He wants to tackle this, and he thinks he's going to get there. And it's just persistence and, showing value. And just keep plugging away at it, and essentially, we'll see if he realizes that vision or not, and whether actually he can also pass the company on to people who can continue to fulfill that sort of vision that he has.
And we have to leave it at that, but really fascinating stuff. Thank you so much, Bloomberg News senior editor Reed Stevenson, on his Bloomberg Business Week story about Uniqlo's billionaire owner, Tadashi Yanai. In the story, he also said that Tadashi Yanai asked, do I get an employee discount on this machine? So how cute was that? And I feel like it really signals his humility, Alex.
You're watching Bloomberg Business Week. We'll be right back.
You're listening to Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio.
And welcome back to Bloomberg Business Week. I'm Alexis Christoforous along with Isabel Lee at our Interactive Brokers studio here at Bloomberg headquarters in New York. Want to get a look at some stock movers here. In a holiday shortened week, a good first day here for Wall Street. Nice Monday to kick things off. Warner Brothers Discovery, though, still in the news. Nora Melinda here with a breakdown. Nora.
Yeah, I mean, we've been seeing so much action when we look at Warner Brothers Discovery. I mean, Paramount Skydance has really been in focus throughout the trading day today. We did see shares of that company ending higher. That's ticker WBD for Warner Brothers Discovery and P-Sky for Paramount Skydance. We had Larry Ellison, one of the richest men in the world, agreeing to personally back with his fortunes Paramount Skydance's bid for Warner Brothers Discovery. So we've really been seeing this tug of war, Netflix on one end, Paramount Skydance on the other, really trying to see who will actually be able to take over aspects of this company here.
What about First Solar? What's going on there?
First Solar, we've been seeing a lot of activity as well. We did see shares higher. This is after news that Alphabet will be buying clean energy developer Intersect Power. We know that this is one of the company's biggest deals aimed at boosting its AI-related data center footprint. So you did see First Solar rising, just given the fact that it is actually a customer there of Intersect Power. So Intersect Power has been a customer of First Solar, excuse me. So we've definitely been seeing some activity there in the trade.
Yeah, you know, I feel like right up until the last day of the year, there are going to be these AI deals. Because again, this is a data center deal, right, with Alphabet. So it really is about, once again, powering the AI boom. And I feel like just every other day, we're just seeing another deal.
Yeah.
So thanks for bringing us First Solar. Round things off here with Clearwater Analytics. CWAN is the ticker. What's going on there?
Right. Clearwater Analytics. We did see a group of private equity firms agreeing to buy this company. About $8.4 billion is the deal that we're talking about here. But analysts did say that this deal price was lower than anticipated. But if we think about how the street was really viewing this, we did see shares moving higher. So clearly investors are buying in on this, but analysts are saying, hey, maybe this wasn't the right price that we were looking for.
So maybe very quickly, Nora, as the stock market correspondent and Bloomberg TV, was there anything that really shocked you or excited you as you cover these individual names this year? Maybe a favorite to talk about?
I mean, there's been so much. And as you called out just a bit earlier, I've been looking a lot at the tech space. I think that that's really been buoying much of the market this year and in the more recent previous years. So it'll be interesting to see what we end up seeing for 2026. And a lot of the eyes more recently has been on quantum computing stocks, which we talked a lot about today as investors are really trying to see what is the next AI play and how can they be ahead of the curve.
That's interesting because the Bank of America wrote in a note recently that they don't see that the AI plays are in froth-like levels yet, but quantum and nuclear stocks may be. So that's an interesting point that you bring. And I feel like even in the ETF world, those are the stocks that have been popping so far.
And very speculative space. I mean, if you think about the fact of financing and the revenue that they have, they're only talking about tens of millions of dollars here versus maybe a big tech player that rakes in billions of dollars in revenue. So it really is a bet on the future that investors are making here for companies that haven't necessarily yet displayed the profitability that investors are looking for.
You know, guys, I always love the READ go function on the terminal to see what people are reading. Most read article. Did you guys already look at READ? Don't look at it. Don't look at it.
Okay, I'm not going to cheat. I'm not going to cheat.
What do you think? I mean, it was on top go all day. So,
I mean, I'm thinking Warner Brothers Discovery has to be one of the most top-read stories.
You got it. Yeah. Larry Ellison pledges $40 billion to bolster Warner Brothers. But it's hard not to click that. Hard not to want to read that story.
Because you almost have to. Because almost every day or nearly every day there's a development. And again, this is another development with Larry Ellison throwing his personal fortune behind the Paramount bid. What could it be next week or what could it be in the next month? I mean, who knows? And even our guests earlier when we talked to them, Molly Schutz and the gentleman from Bloomberg Intelligence, Stephen Flynn, yes, they both were great. And they also didn't know because it's just really unpredictable.
Yeah, they're actually really seeing this going well into next year. But we just don't know. You know, about 2 weeks ago, we thought, okay, Paramount's taking this to the shareholders. The shareholders will speak, and we're just going to move on.
And then even Warner Brothers Discovery, I mean, they were talking to their shareholders essentially saying, hey, guys, we already had an initial deal with Netflix. They were essentially kind of giving them a nudge saying, you know, we think that you should stick with Netflix as well. But then you have this play by Larry Ellison. So it'll be interesting to see what actually happens as this materializes.
This is unrelated, but not really. What I dread these days is when I hear of a nice series that I want to watch, I check whether I have a subscription.
I know.
to those
so many subscriptions at this point.
Annoying now.
Or let's show of hands, who has done the free trial just to watch a series?
Oh, of course.
And then cancel it.
Of course.
Yeah.
I have not, only because I'm bad at canceling, and I know I will pay for it. And
well, they bank on people like you, Isabel.
Yes.
Thank you for my service. Thank you.
Pretty soon it'll be like one of those cable bundles. We'll have so many subscriptions.
Exactly.
That we'll be paying the same price that we were paying for cable.
But you know what? Guess what? Check your phone carrier. Because a lot of phone carriers are offering to pay for your subscription services for free. I know T-Mobile does.
I was going to say, T-Mobile has all the deals.
Oh, really?
All the deals. You have T-Mobile
Although
Tuesdays.
I must admit, they are with ads. If you let them pay your Netflix, for example, you're going to get the lowest tier. But here's how I grew up watching ads.
I wouldn't be mad at ads if they're free. Come on.
Come on.
Let's see what's going on.
Throw me all the ads.
By the way, I just want to mention our other two top read stories behind Larry Ellison. Trian-backed group to buy Janus Henderson, valuing that deal at $7.4 billion. So again, still Monday merger mania, even though we're in a holiday shortened week. And Alphabet, of course, buying Intersect for $4.75 billion. It is a AI power race, guys, and it is continuing We're going to close the year out that way. We're going to, I think, go through 2026 that way. But at some point, it's show me the money, right?
And all of us will just be busy. Nora, you and me, and we'll be looking at a terminal all day, every day.
Well, that's a good thing. I'm Alexis Christophers with Isabel Lee. We're going to be back tomorrow with a business week as Tim and Carol take some more time off. But we've got Balance of Power coming back with you now. Joe Matthew, going to see you through the next hour. Thanks for joining us.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Joe Matthew. Tonight from Washington, sending a message. The U.S. ramping up its pressure campaign on Venezuela's President Nicolas Maduro by targeting now a third oil tanker, with President Trump about to announce plans for the next generation of U.S. Navy warships. We'll have a live report ahead. Also, special delivery. New details tonight on NVIDIA's push to begin shipments to China, giving Beijing access to one of the world's most powerful AI chips. This as Google's parent company Alphabet makes its own power play today. Strategist Dan Ives is standing by to discuss. And going for Greenland, the White House latest play for the Arctic island that's creating new tension and angering a NATO ally in the process. But we begin tonight with President Trump set to make an announcement alongside Defense Secretary Pete Hegseth and the Secretary of the Navy just moments from now. For the details, we turn to the White House North Lawn, Bloomberg's Kate Sullivan. Kate, what do we have on store tonight in this announcement?
That's right. So we're expecting to hear from the president really at any moment now. And we're expecting this announcement to be specifically about shipbuilding. You know, there are reports that Trump is going to announce that the Navy is going to build a whole new class of warships and that it's going to be called the Trump-class battleship. So he's going to name it after himself. He's down at Mar-a-Lago. The president is there for the holidays. And as you mentioned, he's supposed to be joined by Pete Hegseth and the Secretary of the Navy. You know, this is really part of Trump's bid to revive U.S. shipbuilding and compete with China. But as I mentioned, the president is supposed to speak at any moment now, and hopefully he'll be answering some reporter questions, and we'll learn more.
All right, Kate, it's been an interesting couple of days for the administration when it comes to Venezuela, bagging another oil tanker and pursuing a third tanker. Do we have any update on that third tanker and what the administration's saying about this effort?
Not at the moment, no. You know, this is definitely, we've seen the president really ramp up pressure when it comes to Venezuela and really ramp up these efforts. We've also seen these boat strikes. You know, there have been many people who have been killed. The administration says that they're targeting drug trafficking, and so we'll continue to stay tuned, but no updates there.
Okay, thank you so much. Bloomberg's Kate Sullivan at the White House this evening. Today's shipbuilding announcement comes as the U.S. pursues, as I mentioned, a third tanker off the coast of Venezuela as part of what President Trump describes as a blockade aimed at cutting Venezuela's primary source of funding and raising new questions about the administration's goals in the region. For more, we're joined by retired U.S. Army four-star General Wesley Clark, former NATO Supreme Allied Commander Europe, also former Commander-Chief U.S. Southern Command. So he knows a thing or two about this part of the world, and it's great to see you again, General. Welcome back to Bloomberg TV and radio. As we pursue now a third oil tanker, is the U.S. acting within the bounds of the law, knowing that we had announced actual sanctions against these tankers before we started occupying them?
Yes, it seems we are acting within the bounds of the law. And but we shouldn't underestimate the difficulty of this. I mean, if you really tried to blockade the coastline of Venezuela, I know it looks like a postage stamp on a map, but when you actually get down there, it's a big place. And that coastline is it's as long or longer than the entire west coast of the United States. So it takes a lot of ships, a lot of aircraft. And in this case, the pictures we've seen of this tanker looks like it's fully loaded. So that's a big boy. It's carrying a lot of mass. You put a small ship in front of it to try to stop it, it won't stop quickly. It might run through a ship. So you're going to have to board it to get it stopped if it doesn't heed the signals.
Well, you know what the people are asking as we take a look at a map of the region and where these tankers are. By the way, the first one that we seized has made its way to Galveston, Texas. General, when you seize 2 ships and pursue a third, are you essentially declaring war on Venezuela?
I don't think it's a declaration of war. I think it is a means of putting economic pressure on. Now, when you put ground troops in, yeah, you really need to get some authorization from Congress for that, because that's a campaign of indefinite duration once you put ground troops in. But this is a naval action to seize sanctioned ships. As far as we can tell, you're doing it with the Coast Guard resources. We've seized ships before. It's been done, and it's an easy way to put economic pressure on Maduro in Venezuela.
I'm curious your thoughts on what we heard from the Secretary of State, who held a very lengthy news conference partly on this, and the way he framed what he called a standoff in the Caribbean. Listen to Marco Rubio.
It is clear that the current status quo with the Venezuelan regime is intolerable for the United States. The status quo, that they operate and cooperate with terrorist organizations against the national interests of the United States. Not just cooperate, but partner with and participate in activities that threaten the national interests of the United States. So yes, our goal is to change that dynamic. And that's why the president's doing what he's doing.
But of course, General, to change that dynamic requires regime change, does it not? Is that what he's essentially saying?
He is essentially saying that, but, you know, Maduro doesn't have to have all that support from the Russians. He doesn't have to have a relationship with Cuba. He doesn't have to have a relationship with the Iranians. He chooses to do that. So if he wants to survive, can the leopard change its spots? That's the question. And if it doesn't, then I think the Secretary of State's made pretty clear that this is going to be a continually tightening noose on Maduro. I hope we don't go in on it with troops on the ground, though. I hate to see that kind of a fighting in a crowded area where there's a lot of weapons on the other side. This is not Panama of 1989. This is a much different setting. It could be that it could be easily done. You could perhaps snatch Maduro out or put him under pressure, have him renounce, have him disband his people and so forth in return for some kind of exile, maybe give him a little cash bonus to sweeten the pot a little bit, get him away. If you have to go in on the ground and actually fight a bunch of people in Caracas and in the area where the port is and so forth, it's going to be destructive, probably going to take some losses, and it's certainly going to look like big, bad, ugly America again. I'd like to see us do more with the Organization of American States, with the other countries in South America. It can't be good for them what Maduro is doing. And we should be the good guys in this, not the bad guys. So we should be working with them and encouraging them to pressure Maduro to get out. He's caused so much hardship in the region to Colombia and Peru. He's forced out millions of people. They've distorted the labor markets in these countries. He's pushed migration in those countries that's been just as disruptive as in the United States, really. So they should have an interest.
What do you think our evolving justification for this blockade, as the president calls it, or shooting at alleged drug boats, says about us as good guys or bad guys? Because this started as an operation to stop the drug flow into the United States. That's why we were picking off these cigarette boats coming out of Venezuela. But recently, the president has not even mentioned drugs. He's been talking about oil. The fact that he says Venezuela illegally took our oil licenses and we're going to take them back. How does that change the framing of this potential conflict?
Well, it does change the framing of it. It makes us look a little bit like greedy Norte Americanos, to be honest with you. I mean, you know, the reason we talk about banana republics is because 100 years ago, when the banana plantations in Central America were nationalized, the United States went in there to retake those United Fruit banana plantations and give them back to the United Fruit Company. And so it left a lingering bad taste in Latin American countries. So yes, there's some issues with oil, and they should be worked out. But we'd be on much stronger grounds if we went in legally through the Organization of American States, protesting a failed election, a non-democratic election, telling him he's got to get rid of the Russians and the Iranians out of there. There are other ways to leverage this than going after oil. And that's probably the worst way we could do it, because it looks like we're going to go snatch resources, and it's all about money. And if you heard the Secretary of State, it's not all about money. It's about U.S. national security.
We're going to be hearing from the Secretary of Defense and the President of the United States in a moment, General, talking about the President's Golden Fleet, as he calls it, and a new class of warship. They're calling it the Trump class of warship, the FFX, with a first boat ready by 2028 to try to fill in shortfalls in our Navy. They're down at Mar-a-Lago, and the stage has been set for this announcement. Is this something that our Navy needs and can afford?
Well, the Navy has been the most neglected of the services, Joe. I mean, it is really short. It's retiring submarines, it's retiring warships that we didn't think needed to be retired, but we're having trouble manning. We're also having trouble shipbuilding. We can't get enough welders in some of these shipyards. And people don't want to work for what they're being paid for. It's nasty, dirty, hard work, and Americans have traditionally done that really well. But now we've let our civilian shipbuilding industry collapse in the United States. And because of budget constraints, and, you know, we went for a number of years without any new defense appropriation. We're just continuing resolutions on it. So we didn't get the money we needed to really build the fleet we need. So we're way behind China in the Western Pacific. So we're really short.
Doing a lot.
Ships, they've got to be large enough to stay at sea, and they've got to have enough on them to be able to handle the electronic warfare, the lasers, the cyber warfare, as well as anti-submarine and anti-air. So there's a heavy requirement on these ships. I think they're going to be loaded.
Could be quite a windfall for HII, the stock hitting an all-time high today, the shipbuilder. General, it's great to see you. Thank you for the insights, as always. Retired four-star General Wesley Clark, former Commander-Chief, U.S. Southern Command. Coming up on Balance of Power, President Trump raising the temperature on Greenland as well over his pick now for special envoy to the Arctic island. We'll have those details up ahead, but first, breaking news after the bell tonight. The Big Take reporting that Tesla engineers warned Elon Musk about issues with the EV maker's door handles. We'll have more on that. And NVIDIA preparing to sell chips to China when we talk with Dan Ives. Straight ahead on Balance of Power on Bloomberg TV and radio. It's Balance of Power on Bloomberg TV and radio. I'm Joe Matthew in Washington. Thanks for joining us. Larry Ellison is throwing his personal fortune behind Paramount's bid for Warner Brothers, aiming to give his son's company an advantage in the fiercely contested takeover battle with Netflix. Both suitors moving today to strengthen the financial backing for their offers, as opposed to actually increasing their bids. The pre-market announcement driving the day, Warner Brothers and Paramount both moving on the news, with Netflix down about 1%, Paramount in the green. For all the details, we turn to Power Moves with Bloomberg's Nora Melinda, who joins us live from World Headquarters in New York. Another chapter in this saga, Nora.
Well, certainly another chapter as we continue to turn the page in this fallout between these companies all fighting over Warner Brothers Discovery. You've got Paramount Skydance in focus today. We did see shares of Paramount Skydance ending up about 4.3% to end the day. But the biggest news that came out of this latest saga is the fact that Larry Ellison, which we know is one of the richest men in the world, he actually personally threw some of his money behind Paramount Skydance's bid to purchase Warner Brothers Discovery. So this is about a $40 billion guarantee, a personal guarantee that clearly adds a lot of excitement for investors in Paramount Skydance. We did see shares of Paramount Skydance up about 4.3%. Warner Brothers Discovery shares ending up about 3.5% higher. But Netflix still remains in focus. We do know that Warner Brothers Discovery was earlier urging a lot of its investors, saying, hey, we already have this deal going, this ongoing communication between Netflix and Warner Brothers Discovery. Maybe we should continue on with them. But now that we've got this latest money coming in, money definitely talks here. We know that to be certain. We are still seeing a lot of activity in the market right now, Joe.
All right. Little revival in the AI trade today, Nora. NVIDIA up about 1.5%. It helped to lift the whole neighborhood on this news from Reuters that it's preparing to ship H200 chips to China in February. I guess China's back on the menu?
Right. I mean, a lot of the conversation has been really focused about NVIDIA and China and the chips there. And so that really, we do know that is a central part of where a lot of its revenue comes from in China. So there's been a lot of headlines that we've been following over the more recent months. But this really just underscores the demand that we are seeing in terms of artificial intelligence more broadly. This year, the focus really was tech, both this year and the previous year. So as I've been talking to a lot of my sources here on Wall Street, the question is how far this AI rally will continue to run, especially as we look ahead to 2026 and all the momentum that we've really been seeing coming from this sector in particular, Joe.
I have just the guy to ask in a moment. Nora, thank you. Bloomberg's Nora Melinda with us from World Headquarters in New York. The Chinese market does appear to be finally at hand for NVIDIA, indeed, reportedly telling Chinese clients that it plans to ship its second most powerful AI chips to China mid-February. Is the word. NVIDIA planning to fulfill orders from existing stock, according to Reuters, with shipments expected of up to 80,000 H200 chips, which were approved for sale in China by the Trump administration just weeks ago. And joining us now with his reaction to this and a lot more today, it's been a busy one, Dan Ives, Global Head of Tech Research at Wedbush Securities. Dan, it's great to have you on the political show here on Bloomberg TV and radio. I don't know how I got so lucky, but I'd love your take on this, because we talk about export controls every day in Washington. You're on the other end of this, of course, looking at NVIDIA's balance sheet and forecast, trying to figure out how to factor this in. How significant is this to crack back into the Chinese market?
Look, there's one chip in the world fueling the AI revolution, and that's NVIDIA. And you really need to give them access to the China market. I think that's the understanding that's been well understood now in the Beltway. It's important because the reality is we're talking about $20 billion a year. And if they don't allow them to sell into China, that just gives Huawei and China competition the ability to narrow the gap. And that's what Jensen continues to talk. And I think that message is definitely being heard.
Is it possible for a Dan Ives to do channel checks when it comes to China? Do we know that there are buyers on the other end?
Yeah, I mean, like, obviously we spend a lot of time in Asia, in China. Look, they want NVIDIA chips. The reality is, would you want Peter Luger's steak or would you want White Castle? And the reality is they want the one chip in the world fueling the AI revolution. And that guy's wearing a black leather jacket, and his name is Jensen. And look, there's competition. Huawei and others, they're narrowing the gap. But big tech in China, there's one chip they want. It's NVIDIA.
Well, it's really interesting because Michael Burry, I think, is ready to meet you at White Castle. He was out once again with a knock on NVIDIA today, suggesting that energy efficiencies will make their highest power chips less useful in the immediate term. So as we throw all these data centers back together with an eye on Broadcom and its TPUs, is there some truth to this?
Look, I mean, our last Asia trip, if I go back a month ago, demand to supply is 12-1 for NVIDIA chips. So look, it's going to continue to be a prove me in terms of the AI revolution, but I mean, we still believe this is early days. You're talking about 3 to 4 trillion that's going to be spent next few years. There's others. Look, we're bullish on Google, bullish on AMD. Others are going to get into this AI arms race on the chip side. But right now, there's one chip at the top of that mountain, and it's NVIDIA's world, and everyone else is paying rent.
It's NVIDIA's world. Is this stock then, in your view, with the earnings growth, revenue growth that we've seen in the most recent forecast, is this stock cheaper than it was a year ago?
Yeah, I mean, like 250 to 275 is where I see it end of 2026. It's a cheap stock. And you know, I think it's one where investors sometimes, you know, there's a lot of noise in this, and you got to separate out what demand ultimately looks like. And we're in the third inning of a 9-inning game in terms of AI revolution. And it's not just about NVIDIA, it's about Microsoft. It's about Google. It's about Palantir. It's the, you know, the infrastructure, Nebius and others, GE Vernova. I mean, this is where it's all heading. You know, even when you look at things like nuclear, right, in terms of from a perspective, from an energy, it's just starting.
Well, I'm glad you mentioned energy, because I talked about this today with Joseph Mycutt at CSIS, and he talks about energy with relation to AI. And we talked about this deal today, but also just the rampant growth in data center construction in this country and the potential for us to keep bumping into the ceiling, the capacity ceiling, when it comes to things like water and, yes, energy. Dan, here's what he said.
I think it's a little bit like a tale of two cities. It's the best of times, it's the worst of times.
Wow.
Looking back at 2025, it's been a remarkable year of continued acceleration. When we think about the build out that we expect to see over the next 5 years, that's going to continue to happen. All of the challenges that you raise, power availability, water use, a general sense that society's not getting the benefits of the data center build out, those are going to almost probably get worse.
Could get worse, Dan Ives. When you throw the NIMBY log on the fire, you consider the capacity constraints when it comes to cooling, yes, water, and also energy, whether or not we're all going to have a small nuclear reactor in our backyard at some point. What kind of volatility do investors need to brace for, knowing that this can't grow in a straight line?
Yeah, no, look, but I think for the first time in 30 years, the U.S. is ahead of China when it comes to technology. Energy is obviously the constraint. You saw the TAE nuclear deal. You see what's happening, you know, in terms of what we see across all types of energy, not just nuclear, solar, and grid, but I think continuing nuclear is going to be the play. Look what GE Vernova is trying to do in terms of stopgap. Look, the reality is that is going to be the focus to make sure in this AI revolution that the U.S. is ahead. And I believe this is going to be a time of innovation, but no doubt, the biggest constraint in the AI revolution is energy.
Yep. Alphabet today agreeing to buy clean energy developer Intersect Power. I know that's not a big priority for the administration right now, Dan, but this is a $5 billion deal. To what extent will clean energy provide the next leg?
I think it's all about clean energy. I mean, we've talked about it. You know, this is just the start of big tech owning more and more energy, and they're going to build it out vertically. I mean, that's the arms race that's playing out. You'll see OpenAI, you'll see other tech players, Microsoft and others, because that is where we're going in terms of from an energy perspective. And I continue to think you're going to see more deals like this. We've talked about nuclear and others. That's where I continue to think it heads.
Really interesting. Dan, I've got to ask you about the Tesla news while you're with us. Headlines on the terminal that Tesla engineers warned Elon Musk about the door handles, the electronic door handles, pushing him to consider making them purely mechanical for the Model 3 sedan in the name of safety. He pushed back because he valued the simplicity of push-button controls. How much of a liability is the story for the company?
I mean, look, in my view, Tesla, you have 10 million vehicles that will be on the road by next year in terms of made. And I think the success speaks for itself. Look, I'm not saying that there's not issues, and these are all things that are very important. to sort of understand and to make sure it's better and better. But I think right now for Tesla and for Musk, I mean, also the future is really about autonomous and robotics. And I think that's what investors are all focused on. And this is going to be a battleground stock. It will continue to be, but like we've talked about, we think $3 trillion in a bull case where we could see this, given the autonomous chapter is now here.
Fascinating, as always. With regard to autonomous, I've only got a minute left. Dan, what's the next stop on the road for Tesla? Most people have only seen reports of robotic cars, whether it's Waymo or Tesla's version on this. When does this go mainstream?
Oh, I think 2026. I mean, we've been cars in Austin, everything they're building out, the geofence area. I think you're going to have 30 cities with robotaxi, 2026. Wow. And this is going to be, I think, probably the most important year ever for Tesla, given true autonomous and robotaxis. And I think you're going to see more and more that are, in a robotaxi in the next year.
You at the point where you prefer a driverless car, Dan Ives?
I do. Look, I do. I mean, the point is that I think it's one. I've been in Waymos. I've been in robotaxis. I'm a big fan of full self-driving on Tesla.
I love that.
I think that's where this. If you have an 8-year-old today, they're not going to need a driver's license when they're 16.
Yeah. Incredible. I like that idea. I'll get in one of these, but if Dan Ives is with me, Global Head of Tech Research
do it
at
together.
Wedbush. Dan, great to see you. That's the plan. Thanks for being with us. I'm Joe Matthew. This is Bloomberg TV and Radio.
announcements of retirements from the House show that the House has not gotten done as much as they wanted to get done this year. Longest government shutdown, everything was jammed into one big, beautiful bill, not much else got done legislatively. This is a bad sign about the workplace environment on Capitol Hill. At this end of year and going into the Christmas season, not a great time for House Republicans. And a bad time as politicians are reassessing whether or not to run again.
This is Balance of Power on Bloomberg TV and radio. I'm Joe Matthew in Washington. Patrick McHenry, their Bloomberg Politics contributor, former House Speaker pro tem, this morning discussing what lawmakers were able to accomplish in 2025. Now that Congress is out of session until the new year, lawmakers are gone. Unresolved health care funding and the DOJ's release of the Epstein files loom over lawmakers' return in January, if any of them want to come back. Joining us now to break it all down for us, Bloomberg congressional reporter Stephen Dennis, who can't wait to get back. Great to see you. There are questions now about whether we're counting down to a shutdown or, in fact, a solution around health care would impact government funding at all. We have a funding deadline at the end of January.
Yeah, I do not expect another shutdown. I spoke to Chuck Schumer as he was leaving the Capitol for the break, and he said he had a deal with Thune to try to get the appropriations bills done. He has kind of looked at the ACA issue as in the rearview mirror. The deadline's going to be passing. People are going to be seeing those bills in a few days for January. You know, technically, there will be a vote in the House on the Democratic ACA bill because of that discharge petition. But, you know, if that passes the House, John Thune has said it's dead on arrival in the Senate. Now, the real question is whether the moderates in both parties, who have been talking a lot about trying to come up with a compromise bill, can they find 60 votes for something, and will the president embrace it? So far, the president's sort of been the missing link here. If he were to say he wants some kind of extension, it would happen. Particularly one that didn't have, some big new abortion restrictions added to it, which a lot of Republicans want. So I think, the ACA is sort of out there as something that, seems like a long shot at this point.
So short of a deal to extend subsidies, do we go the whole year? We go straight through the midterms with premiums where they stand now? Because even Tony Fabrizio would tell you that could be worth a couple dozen seats in the House.
Yeah, I know. There's a big political risk here for Republicans. If you look at the reason why they're in the majority, there's about 5,000 votes in a handful of districts. If they had changed sides, they would have lost the majority. So this is a very closely divided House, even with all the redistricting that's going on. And, do we have 20 million people who in a few days are going to get lumps of coal in their stocking when it comes to health care? And suddenly they're facing an extra $1,000, in some cases many thousands of dollars in higher costs to them. So I do think this is something that's a lot of Republicans know that it's a hot potato, and they're going to be facing a lot of pressure all year long on it.
As far as avoiding a shutdown and funding the government, important over the weekend, the appropriations chairs in both chambers seem to have agreed on top lines. That's actual progress. I think we can report here from Washington. Will that resolve in a couple of minibus pieces of legislation that fund us through the end of the year?
Yeah, so the Senate Republicans have been working with Susan Collins, have been working on a 6-bill package, including health care and defense. They want to get all 9 bills that are remaining done by January 30th. They seem to have a glide path to get there. There have been fights back and forth over smaller pieces of these bills. But, I think that both sides really have an incentive to not have another shutdown. And so, Schumer, when he was leaving, said, I have this deal with Thune. I think that they can get it done provided that there aren't huge new Trump factors. There's always something coming out of the White House. All it takes is something big for Democrats to potentially say, hey, we need to have something in this package to prevent Trump from doing that. And, we'll see.
Well, we'll call you back then. It's my last chance to walk out with Stephen Dennis in the calendar year. I hope you have a great holiday and Happy New Year to you. Stephen Dennis, thank you as always. President Trump is nominating the governor of Louisiana, Jeff Landry, as his new special envoy to Greenland. You see this over the weekend, a post on social media. The president says Jeff understands how essential Greenland is to our national security and will strongly advance our country's interests for the safety, security, and survival of our allies and indeed the world. He writes the move comes after the president suggested that, well, he wanted to purchase Greenland back in March.
We need Greenland for national security and international security. So I think we'll go as far as we have to go. We need Greenland, and the world needs us to have Greenland. I think you may have JD going, actually. Yeah, I don't know if they've split that up, but Usha's great. But I understand JD might be gone.
Reaction from overseas today. European Commission President Ursula von der Leyen responding to the president's announcement on social media, saying the EU stands in full solidarity with Denmark and the people of Greenland. Joining us now with her insights into the region, Jennifer Spence, Director of Arctic Initiatives at Harvard Kennedy School's Belfer Center. It's great to have you with us. If President Trump did actually manage to somehow gain Greenland, either by buying it or I guess through some sort of occupation, what would he have to gain when it comes to national security?
Well, it's a good question, Joe. I can't say that I see the connection between it being necessary to have a secure Greenland and needing to acquire Greenland. There's a lot of things that can be done to reach that sort of level of safety and security, both for Greenlanders and for the world and for the United States, without acquiring or annexing Greenland. That part's the question mark for me.
Well, of course, Greenland has provided resources to the U.S. in the past when it comes to the military in World War II, when it comes to the Cold War. Does it still serve that role?
Well, it's an interesting point. In fact, I mean, yeah, as you point out, the U.S. has had a presence in Greenland for military purposes for quite some time and was critical during the Cold War. But ultimately, when the Cold War ended, so did a lot of the interest in investing in infrastructure, military infrastructure in Greenland. In fact, we saw that sort of a real decline in investment because there wasn't the perceived risk. Now, of course, the equation is changing. We're seeing a change in the dynamics in the Arctic generally. But I don't know that you could argue that Greenland has resisted. In fact, they've been a full partner in the U.S.'s involvement and presence in Greenland specifically. There's been no resistance there. Throughout all the communications we've had with all of this, they've really been clear that this is not about not being ready to be an ally and a partner from a military perspective. So again, the sort of assumption that means that there needs to be an acquisition of the country is really the part that's concerning, I think, for a lot of people.
Seems like it's been a minute since we were sniffing around there. Remember, Donald Trump Jr. went for a visit. J.D. Vance, the vice president, was there back in March. Jennifer, here's what he said on his visit.
Our message to Denmark is very simple. You have not done a good job by the people of Greenland. You have underinvested in the people of Greenland, and you have underinvested in the security architecture of this incredible, beautiful landmass filled with incredible people. That has to change. And because it hasn't changed, this is why President Trump's policy in Greenland is what it is.
I have to be honest, Jennifer, I'm not sure what it is. Maybe you can describe President Trump's policy, unless it's one of annexation. But this is an interesting situation where you've got the vice president of the United States chastising a European nation for the way it's handling its own territory. How does that strike you?
Well, I mean, there's a couple of interesting points there. First of all, what we have seen both before J.D. Vance's visit, but also after is, I mean, and I have spoken to colleagues in Greenland who acknowledge that probably from a deterrence and domain awareness perspective, that there needed to be more investment. But that investment, the Kingdom of Denmark is investing more. The United States is investing more. So those investments are happening. But the other thing that is sort of lost in that is that at the end of the day, Greenland is a self-governing country under the Kingdom of Denmark. And starting in 2009 with a Self-Government Act, they're actually in transition to being independent from the Kingdom of Denmark on their own terms. So Greenland isn't asking to be saved by the United States right now. What it is communicating to the world is, you know, we are open to partner with people and we want to be part of a partnership, but we're not looking for a new we don't need to be colonized by another country. We've been through that.
I want to ask you about the man who's got the job here as special envoy, Jeff Landry. I don't know if you know him, Republican governor of Louisiana. The president again said that Landry understands how essential Greenland is to our national security. Landry was out with a statement of his own shortly thereafter, saying that it's a volunteer job and that it in no way affects my position as governor of Louisiana. As a specialist in the Arctic, is there a door that Governor Landry can open for the U.S. in Copenhagen?
Well, I would argue that his tweets on X, or his X tweets, or however we say that these days, is not going to endear him to a lot of Greenlanders or to the Kingdom of Denmark, or we have seen internationally. If there's absolutely no concern, I don't think, with there being a special envoy identified by the United States, it's the mandate and the vision that he's coming with. And what he's clearly stating right off the get-go is he's not there to listen to the needs and interests of the people that live in Greenland, but is very much communicating a position that President Trump has said many, many times before. And so he's on that bandwagon, and that he's been very transparent about that. So I don't expect that he's going to get a very warm welcome. And hopefully he will listen. If he's ready to listen and learn, maybe there can be a productive relationship where they can, but at this point, the assumption is that the only way to get where everybody needs to go is by acquiring the country. I think it's going to be a pretty closed door.
Well, it's great to talk to you, Jennifer. Thank you for joining us. Jennifer Spence, Director of Arctic Initiatives at Harvard's Belfer Center. We appreciate that. President Trump at Mar-a-Lago, alongside the Secretary of Defense and the Secretary of the Navy, has begun taking questions from reporters. This is the Golden Fleet announcement, what has resolved into a conversation about the Epstein files. At least that was the last question. Let's put an ear on this live on Bloomberg.
And there is tremendous backlash. It's an interesting question because a lot of people are very angry that pictures are being released of other people that really had nothing to do with Epstein, but they're in a picture with him because he was at a party. And you ruin a reputation of somebody. So a lot of people are very angry that this continues. A lot of Republicans are angry because of the fact that it's just used to deflect against a tremendous success. Look, we have $18 trillion coming into our country. We have, I believe, we're going to have the most successful economy in history. We inherited a mess. Now prices are coming way down. Gasoline is less than $2 in some states, $1.99, $1.97, $1.95 a gallon. $1.95. Think of that. A gallon. Nobody ever thought they'd see that. They don't want to talk about that. They want to talk about Epstein. And the problem is a lot of Democrats are being caught up in the web, like Larry Summers. Larry Summers was the head of Harvard. He's now been forced to resign from every board he's on. Board. Now he was at Epstein's Island a lot. I wasn't. I never went there, by the way. But fortunately, it's nice. But I never went there. But a lot of people did go there. But instead of talking about the battleships or instead of talking about most favored nations drugs, we're bringing down drug prices like at a level that has never even been thought of, by thousands. Think of it, by 1,000%, by 1,200, 1,300, 1,400% in some cases. A drug that sells for $10 in London is costing $130 in New York. We're bringing it down to $20, and they're going to go up to 20. So they're going from 10 to 20, which is a doubling. It's a doubling. That's a lot, but it's a doubling. But we're going down to 20. So we're going down, if you can do your own math, but it's 2,000%, 3,000%. It's pretty amazing. And, the New York Times had a story about it. A small story way in the back of the paper. It's the single biggest thing to happen with respect to drugs probably in 50 years. There's never been anything like this. In my first term, I was able to get drug prices down 0.25%. It's the first time in 28 years that they went down. 0.25%. I was so proud of myself. Now we're doing them 2,000%, 1,500%, 1,200%. That pill that sold
President Trump speaking live at Mar-a-Lago. We wanted to put an ear on that for a moment as he steers reporters from questions about the Epstein files now to lower pharmaceutical prices. And we'll let you know if he makes any headlines on the terminal as he continues his conversation with the media. Coming up, fracturing within the MAGA movement. We'll discuss what recent departures of the Heritage Foundation could mean for the Republican Party. And we assembled our political panel. That's next on Balance of Power on Bloomberg TV and radio. This is Balance of Power on Bloomberg TV and radio. I'm Joe Matthew in Washington. Walkout at the Heritage Foundation over the weekend. More than a dozen staffers walking out in the latest sign of fracturing within the MAGA movement. Several senior leaders and staff left the organization to join Advancing American Freedom, a group founded by former Vice President Mike Pence, who told the Wall Street Journal he long admired the Heritage Foundation, but says the group is now abandoning its principles. Heritage most notably authored Project 2025, a policy playbook that has served as a roadmap for much of the Trump administration's first year. Joining us now, their reaction to this and the other stories we're following today, our political panel, Bloomberg Politics contributors Rick Davis, our Republican strategist and partner at Stone Court Capital, alongside Democratic analyst Jeannie Shanzano, democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, I don't know your thoughts on this. The president of the United States had tried to distance himself from Heritage during the campaign, suggested that Project 2025 had nothing to do with his presidency. And now, of course, we're watching him pick through some of the highlights of that piece of literature here. To what extent does the Heritage Foundation speak for the contemporary Republican Party?
Yeah, I think the key point there that you make, Joe, is contemporary Republican Party. There had been a time during my period with Ronald Reagan where the Heritage Foundation spoke for that conservative movement. Movement conservatives, Reagan conservatives, the Heritage Foundation was the mouthpiece. Today, it's a mouthpiece of big government populism. And part of the controversy associated with this departure is statements that were construed as anti-Semitic. Coming from executives at the Heritage Foundation. So it has changed dramatically, fits better in the Donald Trump mode than the traditional Republican mode, and I think has severely damaged its brand, the way I would evaluate it. But at the end of the day, people vote with their feet, and it looks like a few of them are stampeding their way over to Vice President Pence's foundation.
Well, Jeannie, of course, Rick refers to a big argument that's taking place within the Republican Party that we saw play out, the Turning Point USA event over the course of the weekend. And it stems back to a Tucker Carlson interview with Nick Fuentes, which many people thought was unacceptable as part of the modern Republican Party. So there are questions about anti-Semitism, the role that Republicans should take against it, and racism broadly. I don't know if you heard J.D. Vance speak at Turning Point. He was on stage with all the pyrotechnics over the weekend to make this pronouncement. Listen.
In the United States of America, you don't have to apologize for being white anymore. We don't persecute you for being male, for being straight, for being gay, for being anything. The only thing that we demand is that you be a great American patriot.
Jeannie, what is the impact of language like this on the electorate?
Yeah, I mean, it was fascinating. When Rick was describing that, I was thinking the same thing. We saw this echoed at Turning Point. You had people like Vivek Ramaswamy and Ben Shapiro on one side. You had the vice president sort of walking this fine line in the middle. And then you had the folks on the other side, represented by Nick Fuentes, who you mentioned, but maybe Tucker Carlson and some others. I think the vice president is trying to keep this coalition together. So we also heard from him some kind of dog whistles talking about Minneapolis as Mogadishu and attacks on Jasmine Crockett and other things. But he doesn't want to go too far one way or the other. I think that may be a problem for him. And one of the things that struck me was that Vivek Ramaswamy actually defended the second lady more forcefully from that stage than did her husband, J.D. Vance. So I think this is going to continue. And I think the question is, can J.D. Vance hold this coalition together, or is he going to be forced to take a side as we get closer to 2028?
Well, it's a pretty sensitive spot to be in here. Rick, I don't know who was apologizing for being white. That was a line that jumped off the page. But this could set up a really interesting dynamic going into 2028 with J.D. Vance, the standard bearer, endorsed by Erica Kirk and, of course, the folks at Turning Point, against somebody like Ted Cruz, who has been riding a hard line on anti-Semitism, saying it plays no role in this party.
Yeah, I think the emergence of the narrative that Ted Cruz is looking for a presidential run in 28 is a great juxtaposition to the infighting that's occurring within the MAGA coalition. And you've described that infighting, but what's really interesting is now serious politicians like Ted Cruz are looking at the landscape of 2028's presidential election and say, hey, there's plenty of room for me. These folks are going to cannibalize themselves. And he may be right. I think that this Turning Point conference, the America Fest, could be seen as the first shot of the beginnings of the 2028 presidential election. Certainly the endorsement of J.D. Vance has done that. And it's also a message to people like Ted Cruz that you can't wait till later. There's no such thing as waking up after the midterm elections, taking a poll and seeing whether or not you got a run in you for president. Presidential campaign started this weekend.
Wow. How about that, Jeannie? Do you see this the same way? It wouldn't be Ted Cruz's first foray into presidential politics, but boy, it's early. And this could represent a major fracture in the Republican Party in the primary cycle. What do you think?
It could. I'm thinking about a recent poll which showed J.D. Vance at like about 22% support, which is not horrible. I mean, 3.5 years out or 3 years out, really. But about 66% of those folks said they had no particular person in mind to support. So there is room. And of course, let's face it, historically vice presidents who are looking for a third term of their president, if that's what JD Vance ends up doing, hugging Donald Trump, they haven't been incredibly successful. So I think we're going to see a challenge. I don't know if it's going to be Ted Cruz. It's awfully early. Again, I'll mention Vivek Ramaswamy. Imagine he wins for governor. Does he jump out as a challenger? There's a lot of folks out there who could get into challenge. And Mike Pence, who could get into challenge somebody like JD Vance.
Did Ted Cruz put this blood in the water, Rick? How did we get to be talking about this already?
Look, there's a lot of reporting around the fact that Ted Cruz has been talking to folks, who have intimate knowledge of the process of running presidential campaigns. Yeah. As Jeannie mentioned, he's run it before. He knows the game. He ran a very credible campaign the last time. Didn't last very long. He couldn't get a positioning on Iowa that he wanted to be able to sustain the bid, but he's learned a lot. And by the way, the lesson of politics over the last 50 years has been you got to run and lose once to really have the advantage of running again, because there's a lot to learn as a candidate, not just as a campaign. Mm-hmm. So, I think, and by the way, we had a dozen people in that race. So every one of those dozen still probably wake up every morning thinking, I could be president of the United States.
Great panel. Rick Davis and Jeannie Shanzano, we thank you both for the insights on the Monday edition here of Balance of Power. I want to mention a breaking headline that just crossed the terminal. This will be a big mover tomorrow. Novo Nordisk says its Wegovy pill has been approved in the U.S. as an oral GLP-1. The pill. Novo shares right now are skyrocketing, up over 5% in after-hours trading. We saw a little blip in Lilly shares, but holding positive as well. Much more on this tomorrow, right here on Balance of Power on Bloomberg TV and radio.
This has not been a great time for genius. The people who claim to have it do not seem to qualify for it. The people who diagnose it others seem to have a very, very narrow definition.
Okay, I'd like to introduce Mark Douglas. Mark is best known for his books, probably The Disciplined Trader and my favorite, Trading in the Zone, which I had the privilege of writing the foreword for. I have to tell you, Mark's book, Trading in the Zone, really had a big impact on me because it deals with the mental aspect of trading. You can also find out more about Mark's products at markdouglas.com. So here he is, Mark Douglas.
A lot of familiar faces. I'm just getting in front of the room. I'm kind of amazed, actually, how many people I recognize. It's pretty nice. What's that? What? You have to get the microphone volume turned up? Oh, you can't. You couldn't hear me just then? Really? Oh, I'm sorry. Oh. Oh, well, first of all, I don't think this microphone is on for you. This microphone is on for that back there. So I don't actually have a microphone. This is not amplifying my voice. So if I'm not talking loud enough, just let me know. Normally I talk loud enough. I don't know why I maybe started out. So anyway, it's nice to be here. It really is. It's nice to be. I flew in from Scottsdale, Arizona, and who read the paper today? Who read the Orlando paper? Nobody read the paper this morning? You did? Only one person? Yeah, there was an article actually in the Orlando paper about middle way through the front section talking about how hot it is in Arizona right now, or at least in Phoenix. People don't seem to believe just how hot it gets there, but I'm telling you, it really gets hot. It's like, how many people had the heat on last night in their room? I'm not kidding. I'm really not. Last week we had temperatures up to, if the news stations report the temperatures of being 116, that means there were 118 to 120. And we set a record last Monday for the highest low temperature in Arizona recorded history. It didn't get below 96 degrees. That was our low of the day, 96 degrees. Now, not to take anything away from Arizona weather, because 8 months out of the year, it couldn't be more heavenly in Arizona. I mean, the weather is absolutely spectacular, but we do pay for it. We pay for it this time of the year. And so, if you're interested in coming out to Arizona, I would definitely suggest it, late October through maybe April, but otherwise, this time of the year, be prepared for some really unbelievable temperatures. But this is what we need right here. We need this rain because we're in a really severe drought. But anyway, enough about Arizona. You guys want to know about trading, right? Trading psychology, more specifically. What I'm gonna talk about is the psychology behind creating consistency in your trading. And an interesting thing that I found even about 3 weeks ago, I did a presentation in Toronto, and there were probably about 100 people in the room, and I was really kind of amazed at how many people really didn't have a definition of what consistency was. Just think about it for a second, that they really didn't know, what does it mean to really create consistency? Like when I asked the question to the audience, nobody really could answer the question. What is consistency? I mean, if you're going to create it, if it's something that you're going to manifest in your life, I mean, or in your trading, it certainly has to be something that you know what it means. You have to know the parameters of it. And I'm just going to simply define consistency as, as a nice, steadily rising equity curve. That's all. Just a nice steadily rising equity curve, okay, at a nice, say, 45-degree angle. Will that equity curve have any drawdowns? Yeah. But what kind of drawdowns? Small drawdowns. Small drawdowns that reflect any trading system or methodology or any particular way in which you decide to trade, the kind of losses that you will experience as a result of being a trader. It's a natural part of the business that we will have small drawdowns. But what isn't consistency are the kind of, let's say, a kind of equity curve that looks like this, with a huge drawdown, and build it right back up again, another huge drawdown, build it back up, and another huge drawdown. Now, most traders who don't understand the nature of trading or the nature of the psychology behind what it means to be consistent, they will attribute these huge drawdowns to something that happened in the market. They'll always try to find a reason to determine what is it about what the market did on this particular day or in this particular trade or whatever series of trades created this huge drawdown that caused that to happen. And then go on a search to find what it is. What I'm going to establish, hopefully today in the next 2 hours, is that those huge drawdowns are not the result of something you did not know about the market. They are not the result of something you did not know about the market. They are the result of something you didn't know about yourself. And there are ways to prevent that. And those ways to prevent it are what it means to really create a nice, steadily rising equity curve. And those ways basically fall into 4 general categories. None of this is, by the way, none of this material is in that book. So there's no point in looking. I just didn't want you to waste your time. There's no material in the book. You've got the videotape. I mean, come on. So you just need to sit back and listen. Anyway, so we got 4 basic categories. One is that you have to have an edge. In other words, you have to know enough about the nature of the market and how it moves so that you can determine when there's a higher probability of one thing happening over another. That's how I'm defining an edge. When there's a higher probability of one thing happening over another. And then the next category is that you have to learn how to think in the market's perspective. I just simply, as a heading, would say that you have to learn how to think in probabilities. Now, this is really can be a, this is really kind of where most traders have their, let's say, have the greatest amount of difficulty. And first, in recognizing what it is, what it means to think in probabilities, and then once they recognize it, implementing some process or series of steps where they're actually retraining their mind to think in probabilities. Now, this is what I'm going to spend most of the time on in the next 2 hours. And just before I even get into it, just so you kind of have a little bit of a background, is that our minds do not naturally think that way. Our minds don't naturally process information in a way that will cause us to, let's say, be in harmony with or have, let's say, be in correspondence with the nature of the way the market exists. And so we have to do something very specific to train our minds to think in probabilities if we want to create consistency. The third category is all the, let's say, conflicting energy that exists inside of us. I'm saying conflicting energy, conflicting beliefs, or whatever that would argue against us accumulating vast sums of money as a trader. Now, what kind of things am I talking about? Anybody have any ideas of what I might be talking about?
Just a general belief system.
A general belief system. What's that? Go ahead.
Say a general belief system maybe from childhood.
A general belief system about childhood, but can you think of anything specific?
Self-doubt.
Self-doubt? Well, okay, but anything more specific than that even?
Filthy rich.
Filthy rich. Now look at the word filthy and rich, okay? Where does that word filthy come from? It can come from a number of different sources, but what people have to understand is that we grow up. We can grow up. We don't say we do grow up. We can grow up with any number of things that we've learned throughout our lives that are going to fall into the category of what I'm going to just say are self-sabotaging beliefs. In many cases, they're religious-based beliefs. Because essentially, as traders, what are we doing? We're basically taking money from other people with no services rendered. That's basically what we're doing as traders. And there are a lot of religious beliefs that let's say that would really rail against the idea of doing something like taking money away from other people with no services rendered. And so as a result of, we build up our skills, we build up our knowledge about the nature of trading, we get better and better at it, and all of a sudden find ourselves, or maybe not in the moment find ourselves, but when we look back and with a little bit of introspection and say, why did this happen? We make trading errors. Errors that cause these kinds of drawdowns. Sometimes it can be simple ones. Like even a buy for a sell. I did it just the other day. It didn't create a huge loss because I caught it, but the point is that if I wasn't conscious of what I was doing and why I was doing it in the moment, I could have very easily let that trade go, and it could have been more than what I anticipated. And the problem is that when we experience these kind of drawdowns, they create psychological damage. They create the kind of psychological damage that's very difficult to recover from. Or it can be difficult depending on one's skill level and being able to do so. And what kind of psychological damage am I talking about? The lack of self-trust. We don't trust ourselves anymore. And when we don't trust ourselves to do what we need to do when we need to do it without any reservation, without any hesitation, what ends up happening is that we end up generating fear. And what we're going to find out in a little bit is that fear has a very insidious effect on our ability to be objective and see what the market is offering us in any given moment. Because we can define the market as this kind of never-ending opportunity flow. And the market is basically giving us an opportunity in any given moment to get in, add to, detract from, or get out. But it's this never-ending flow. Now, if we're not perceiving it as this never-ending flow, the market's not causing us to perceive it that way. It's what's going on inside of us that's causing us to perceive it as something other than this never-ending opportunity flow. And those are the kinds of internal forces that cause these kind of drawdowns. That's the third area. The fourth area is learning, let's say, building a specific kind of mental framework that will allow you to recognize when you've crossed through the threshold of euphoria, so let's say from normal confidence to overconfidence, or from normal confidence to a state of euphoria. In other words, there is what I'm going to call a psychological threshold. Below this threshold, you're just confident. Once you pass through it, you're in a state of euphoria. And why would being in a state of euphoria be a problem? What's that? Loss of objectivity. Anything else? Feeling invincible. Why is feeling invincible a problem when you're interacting with the market? Everybody understands the implications? In other words, when you've crossed the threshold into a state of mind of euphoria, it is impossible to perceive risk. That is the nature of euphoria. In other words, the nature of euphoria is that from our individual perspective, from the perspective of our state of mind, in that state of mind, it would be impossible for me to perceive that anything can happen other than what I expect to happen. Anything. The only thing that's going to happen is what I expect to happen. And as a result of being so absolutely sure that what I expect to happen is going to happen, what would be the next step in this process? To break my money management rules, right? In other words, to put on a position that would be much larger than what I would normally trade. Maybe 10 times, maybe 20. Well, there's no risk. Why not? Right? Why not? Now, the problem, of course, with putting on an inordinately large position is that it doesn't take very much movement for the market to put you to put you in a huge losing trade. And the problem there is that if I've got this huge position on with being absolutely positive that it's going to work, and then the market just goes against me by just a little bit, I can go from this state of euphoria, from this state of, let's say, in essence, heaven on earth, to a state of extreme agony and pain of hell on earth virtually instantaneously. Can I not? And then once I get into this state of mind right here, I will be in mind freeze. My mind will freeze up. I'll be, let's say, paralyzed to do anything, and I just sit and watch as the market takes my money away until something snaps inside of my mind, so okay, that's enough, and I get out. And then I look back at my equity and I see one of these huge drawdowns, okay, and I think, oh my God, how did that happen? Now, if you don't understand the underlying dynamics of what I've just talked about, you're gonna go look at the market, and you're gonna try to find what happened in the market that caused that. What set of variables, what set of market variables caused that to happen? You see, the market didn't have anything to do with it. Nothing. To create consistency, in essence, what we have to do is learn how to trade without making errors. Does that make sense to everybody? Right? But then what is a trading error? Okay, if that's the case, everyone say, did everyone nod their head? Yes, yes, okay. We're not, okay, it makes sense, right? To create consistency, I have to reach higher and higher levels of error-free trading, right? There's a correlation there. In other words, everyone sees the correlation, right? But then if I said, okay, what are trading errors? List them. What? Not following your rules is a trading error. Okay, good. See, but these are things you should be able to, whoa, well, right off the top of your head, right? You guys are all in the business of trading. Every single one of you would probably say, yes, my goal is to create consistent results. If I said, what do you want? What's your objective? What are you trying to accomplish here? Well, I want consistency. And yet, if we just established that consistency is a function of the lack of errors, you should be able to rattle off those errors right off the top of your head so that you can recognize them when you're making them. Right? What's the biggest error that virtually all traders make, except for the ones who have gotten to the point where they don't make them anymore? What's the biggest number one error that traders make? What? No. I know I'm right. Okay. Yeah. And so but see, I know I'm right. But how does I know I'm right manifest itself into a trading error? What?
Not exiting so that you can take what you see as the next correct signal, and you can't take it because you're locked in the wrong position that you did not exit.
I would agree with everything you said. I'm just going to say it a little bit differently. What's that? Yeah. Yeah. Not predefining your risk. Everything we just said, I'm just going to say it a little bit differently. Not predefining your risk. Now, I'm not going to ask people to raise their hands, but I bet there are people in this room who still will get into a trade without predefining their risk. Now, why won't people predefine their risk? Why is that so hard to do? Why do you think that's so hard to do? What do you think of the underlying dynamics are? Well, yeah, you don't want to be wrong. Now, see, when you've learned to think in probabilities, what you're going to learn, what you're going to understand, is that trading is not a right or wrong endeavor. It has nothing to do with being right or wrong. But this is really important. Yes, we don't want to be wrong, and we don't want to lose money. And there's a problem here in terms of the way our minds are designed to think. If I think of trading, getting into a trade, as being something I can be right or wrong about, and I have not accepted the risk, meaning I have not accepted the dollar value of the potential loss that I can incur from that trade by not predefining it, or by predefining it and still not accepting it, then my mind has the potential to associate whatever's happening in the market now with something that's happened in my past. Meaning our minds are wired to associate. Meaning that if I haven't changed the way that I think about trading, I have the potential to look at any given trade as, well, let's say any given trade has the potential to tap me into the accumulated emotional pain of what it means to be wrong, or every time I've been wrong in my life. Yeah, exactly. I'm going to say that again. If I haven't redefined trading to think about it in the appropriate way based on the way that I'm going to explain in a moment, being wrong on a trade has the potential to tap me into the accumulated pain of every time I've been wrong in my life, because that's the way our minds are designed to think. They're designed to associate. So if that's the case, little wonder that I'm going to avoid predefining my risk. Because here's what's going to happen. For me to predefine my risk, see, I don't want that to happen. I don't want to be in that state of pain. For me to predefine my risk, what do I have to do? I have to gather evidence that will suggest why this trade might not work. Right? I have to gather evidence to say, okay, what are the things that could happen that would tell me, or what does the market have to look like, sound like, or feel like to tell me this trade isn't working? And I have to gather evidence to tell me that so that I know how to recognize it. But the problem is if I gather too much evidence, I might talk myself out of the trade. Right? And if I talk myself out of the trade and it turns out to be a winner, then I could be in a state of agony that might be even greater than had I put the trade on and it turned out to be a loser. So how do I compensate? So I've got a mental dilemma here. I've got a dilemma. How do I resolve the dilemma? Gather enough evidence, in other words, have the trade be so technically or fundamentally sound, whatever method you might use, to the point where I have convinced myself that I'm right. And see, if I'm right, there's no risk. Right? Why predefine the risk if I'm right? There is no risk. I wouldn't be doing this if I didn't think I was right. What's that?
It's not doing as an implicit risk.
I'm still there's people say, go ahead, say that again.
Not doing still has an implicit risk that you don't associate it with.
Yeah.
Not doing something has an implicit risk in not doing something.
Right.
And that is also a risk.
Right.
They're normally associated as a risk. Inaction. Inaction is a risk. Fear.
But go ahead.
I think part of your belief system kicks in. Hope is something we are trained to have. We always look forward, hoping things will be better. So when I'm wrong, that fellow jumps off there and says, "Don't worry about it."
I know exactly. I'm going to give you an example that really that typifies exactly what you're saying. And see, here's the thing. Here's the problem with trading. I'm just going to put up some typical errors that we make over and over again all the time. Let's see if we can we how do we need to adjust it? Go forward or back? Oh, I'll just move it up a little bit. Anyway, here's what's interesting about these errors. Okay, one, hesitate, get in too late, jump the gun, get in too soon. Don't define your risk in advance of putting out a trade. Define your risk. Don't take your loss, and it turns out to be a bigger loss. Get out of a winning trade too soon. Leave money on the table. Get out of a winning trade. Let a winning trade turn into lose without having taken any profits. Move a stop close to your entry point. Get stopped out, and the market trades back in your favor. Now, here's what's really interesting about trading, and the biggest one. Like I said, the biggest one is that not predefining your risk, and that I just went through the whole dilemma of the psychological dynamics behind that. Did everybody understand that dilemma? Go ahead.
Could you just restate? You said being wrong has the potential of
tapping you into the accumulated pain of every time you've been wrong in your life. And that's definitely something we're going to avoid. Our minds will automatically alter the way we perceive the market to help us avoid that from that happening, okay? Now I'll explain the underlying dynamics of that in a second. But there's a real important point that I want to make here, is that these are all trading errors. Will everybody at least acknowledge they're all trading errors? I mean, are we all together on this? Okay. However, here's what's really interesting about trading and why it can be so difficult to create consistent success, is because you can make every single one of those errors over and over again and still find yourself in a winning trade. You don't have to know. Yeah, right. Here, the microphone didn't pick up, but someone back there said, "Thank God." Now think about the nature of trading. What skills do you need to find yourself in a winning trade? What? No. What skills do you need to find yourself in a winning trade? None. Zero. Think about that. You don't need to know anything to find yourself in a winning trade. Right? Nothing. You don't have to have any skills whatsoever. And if you can find yourself in a winning trade without having any skills whatsoever, once, can it happen again? And can it happen again? Yeah, it can. We don't know what the limit is to how many times it can happen without having any knowledge whatsoever. What do you need to know to find yourself with a winning blackjack hand? Nothing. What do you need to know about roulette? Nothing. What do you need to know about craps? Nothing. What does that suggest to you? Do you see any correlations here? Do you see any correlations? What does that suggest to you about the nature of trading? It's gambling. Absolutely. Now, interestingly enough, when I proposed this in Toronto 3 weeks ago, they really railed against it. Oh, you would not believe how difficult it was for them to wrap their mind around the idea that trading was gambling.
Not very religious.
What's that?
Not a very religious statement.
Yeah. Yeah. And interestingly enough, to really be consistent, to create consistent results, you have to acquire a mindset that is really consistent with the kind of mindset that a good, not a compulsive gambler, but a professional gambler would have, or the kind of mindset that the casinos have.
Does that mean that living in Las Vegas?
I don't know. I mean, because look at it. What do the casinos do? They spend billions of dollars building these grandiose hotels. They have to, now think about this. They have to justify spending that kind of money. They spend billions of dollars, building these grand hotels to attract people into playing an event, wagering on an event that all of us know has a random outcome. And yet they create consistent results for themselves. There's a reason why. It's because they think about it in the appropriate way. As traders, if you can learn to think about this in the appropriate way, you can become the casino. Because your technical analysis will put the edge in your favor. You will get an edge. But if you can't use that edge appropriately, meaning that if you consistently make these errors or any other type of errors, you will not create consistent results. You will create random results. And the problem with creating random results, even though it can be a lot of fun because you can end up on huge winning streaks, because keep in mind, you can make every single one of those errors and still end up in a winning trade. You can be the best analyst in the world or the worst analyst in the world. You can have the best reasons or the worst reasons. It doesn't make any difference. You can still end up in a winning trade. But as long as you're susceptible, as long as you're susceptible to this, okay? As long as you're susceptible to these huge drawdowns, you are creating accumulated psychological damage that will have an enormous impact on your ability to make consistent money. Eventually what will happen is if you don't understand the underlying dynamics of these drawdowns, from trading randomly, you'll end up with typically analysis paralysis. You'll become an incredible market analyst and the inability to take advantage of what you perceive as an opportunity. You won't be able to put your trades on. And you'll see the gap between what you know, what you understand, what you've learned about in terms of opportunities, and your bottom line results grow ever wider, wider and wider and wider. So are we kind of ready to get to the way we need to think to, you know, if I kind of set this up all right for you guys? So where do we want to go? What do you guys want to know now? What?
I used to go to Vegas for 13 years with the shopping center convention.
You say the shopping center convention? Okay.
I never put one nickel I never gambled the entire time I've been trading full time for 6 years, putting much more than a nickel in. Is there something really sick about me? Or
sick? No,
maybe I get this answer later.
Well, no, I'm going to say no. I don't see the correlation between why you think because you went to Vegas and didn't gamble. I mean, why you think. I mean, I can think of things.
Gambling. This is not to me.
Yeah, well, the sooner you think about this, what I'm saying to you now is that the sooner you think about this as gambling, the easier it'll be to create consistent results.
I already have.
Well, great. Yeah, if you know, so why would you say that there was? Why do you think that there was some sort of sick implication then?
Well, because I was afraid of the risk of gambling in Las Vegas, but I'm not afraid of the risk of trading.
Okay. If you've accepted the risk, that's one of the key issues right there. One of the reasons why people have such a difficult time and make these errors is because they have not accepted the risk. If you've truly, and what does it mean to accept something? Because he's bringing up a really good point. What does it mean to accept something? What is the definition of true acceptance?
You don't have to control it anymore. You can let it go.
Well, I understand where the not control comment comes from, and let it go. I'm not going to argue with either one of those statements, other than to say that the way I define acceptance is that when you've really accepted something, you've reconciled it, meaning to the point, reconciled it where there's no other potential, there's no potential for anything else inside of you, meaning inside your mental environment, any belief that you've ever acquired to argue against what it is that you've accepted. There is no conflicting energy. Not something you have to rationalize away or justify or anything else. True acceptance means there's no conflicting energy. And essentially, as traders, of course, what we have to do is get to the point where we've accepted the risk of trading with no conflicting energy. Because if there's anything else inside of us that argues against what it is that we're doing, for whatever reason, it will create some degree of fear, and to whatever degree of fear that we're operating out of will narrow our focus of attention and take us out of a state of objectivity, or let's say take us out of this constant opportunity flow that the market's offering us. We'll be further and further away from that flow. So what we have to do is learn to train, or what we have to do is step into a process of training our minds to think in probabilities. Now, what exactly does that mean? How do we know that the market exists from a probabilistic perspective? How do we know that it's even gambling in the first place, based on however it is that we're going to define gambling? Isn't gambling, let's say, an event, a game that has a random outcome? Does trading have a random outcome? So there's no difference, is there? And how do we know that trading has a random outcome? How do we know that whatever particular way that you might define your edge, meaning whatever methodology you use to determine this is a time to buy and this is a time to sell, or vice versa, or this is the time to get in, this is the time to get out, this is the time to take profits, this is the time to add to or detract from your position. Whatever that is, how do we know? How do we know for an absolute fact that there's a random outcome?
It's not a guaranteed result.
Yeah, but how do you know that?
Because the market moves after you go out.
Understandably, yes, the market moves, and what's creating that movement?
No, you, the randomness.
No, well, no, but what? No, really, what's creating the movement?
Buyers and sellers.
Other buyers and sellers, right? So if you decide to buy at this point right here, what is now required for you to find yourself in a winning trade? No, what's that? Yeah, there has to be more buyers, right? Someone has to be willing to bid the price up further. What's that? Yeah, someone has to be willing to bid the price up further. If you buy, someone has to buy after you. If you sell, someone has to sell after you. If those people aren't there, then you're not gonna find yourself in a winning trade. It's that simple. If those people aren't there, you were the last buyer, right? At least in that time frame. In that time frame, you were the last buyer. What else can happen to determine, regardless of what our edge is, that we might not find ourselves in a winning trade?
News.
What? No, not new. No, just really fundamental. Just really fundamental. I'm just getting what it takes for you to find yourself in a winning trade. Someone has to buy or sell after you. What else can happen? The opposite.
Somebody could get in, you comes in and buys a lot more than
You could be a buyer, and some huge seller comes into the market, right? So in essence, I'm going to make the statement that it only takes one trader somewhere in the world to negate the positive outcome of your edge. Theoretically, usually it's more, but theoretically, it only takes one trader somewhere in the world to negate the positive outcome of your edge. Does anybody want to argue with that statement? Now, interestingly enough, no one wants to argue with it. Chances are, and we didn't get a rate, I didn't ask for a show of hands, that there are people in this room who have put on, and maybe still, or let's say before this morning, put on trades without predefining the risk. Now I'm going to ask you if you really, truly believed that it only takes one trader somewhere in the world to negate the positive outcome of your edge. If you really believe that, would it be possible for you to put on a trade without predefining your risk? Anybody else? I got one no. Anybody else? Yeah. You guys agree or not? See, if you really, now, and this is really what we're talking about here. We're talking about a set of beliefs that create a state of mind. A state of mind that compels you to be consistent, that compels you to do exactly what you need to do when you need to do it, without hesitation, without reservation. If you really believed that it only took one person somewhere in the world to negate the positive outcome of your edge, you would not be capable of putting on a trade without predefining your risk. Because the moment that you started to do it, it would create a conflict. And somehow or another, you'd have to argue away the conflict. You'd have to argue away in your mind and justify why you're going to put on this trade, knowing that all it takes is someone somewhere in the world with a different belief about what's high and what's low to make that trade a loser. Are you guys with me on this? How many people in this room have ever played slots? When you put your quarters or dollars in slot machines and you push the button or pull the handle and the numbers didn't come up, tumblers didn't come up in a way that gave you a payout, did you think you were wrong? Why?
So I accepted the risk.
You accepted the risk, and what else? What other reason? Why?
Next time.
Next time? Okay, and what other reason?
I got 2 7s instead of 3 7s.
Because I have no control.
Because you have no control? Okay, what other reason? These are good. All good reasons. What? What's that? That's accepting the risk, but there's another reason.
Didn't expect to win?
No, not necessarily. You expected the winner, you wouldn't put the money in. What else? Yeah, you believe in random outcomes. Your belief in random outcomes prevented you from making the connection about being wrong. You believed that the outcome was random. And therefore, there's no connection. How is it that you think that thousands of people, millions of people on a daily basis can go into a casino and shove money in these machines and not come away, totally emotionally traumatized? If these were traders, they wouldn't be able to do it. If there are traders sitting there with the kind of mentality the traders have sitting in front of these machines, it would be impossible. You guys would be walking away completely traumatized. The reality of trading is that it is a probability game. Because here's if you just break it down to the most fundamental level, what do you have? If you just take the market and break it down to this most fundamental level, what do you have? Buyers and sellers that do what? Create what? Up and down ticks. Right? At the most fundamental level, what we have are buyers and sellers who create up and down ticks. And how do they create their up and down ticks? What has to happen for a tick to go higher than the last or lower than the last? What's that? Volume, but what's that? Somebody has to have a stronger belief in the future. Why do we know that for a fact? They want to pay more. In other words, if you look at trading at the most fundamental level, and this is really critical that you understand this, if 9 was the last price, there's only two ways you can make money in trading. You've got to buy low and sell high, or sell high and buy low. Now, if 9 is the last posted price, what's low? 8 is low and 10 is high, right? Now, what does it tell you if someone is willing to actually buy it at 10 instead of buying it at 9 or 8? Yeah, they believe it's going to go to 11, or otherwise they would have waited, right? But what about the guy selling it to him? He also has a belief too. He wouldn't be selling it to him if he didn't think that the next tick was going to be 9 or below. So what you've got is you've got two conflicting and competing forces in every single trade. Both traders are doing it to make money. Both traders believe they are right, or they wouldn't be doing it. But what's the difference? One has to have a stronger conviction in their belief, because they are willing to do the opposite of what they have to do to make money, at least in that moment. The opposite is they are buying high instead of buying low. They are creating movement. They are actually stepping up and creating movement where the guy on the other side of the trade is passive, doing exactly what he thinks he needs to do. He's selling high relative to the last price. So all market movement is simply a function of what, no matter what the reasons are. See, it doesn't really matter what everyone's reasons are for doing all this. It doesn't matter. Because as we already know, most people think they've got good rational reasons. The reality is they're trading randomly anyway, aren't they? So what it all boils down to is all market movement is a function of what traders believe about the future and how convicted they are, how their degree of conviction in their beliefs. Now, all this interaction, all this belief and conviction and the degree of conviction results in simply up and down ticks. Just up and down ticks, okay? Now, what technical analysis has done for us is basically help us recognize that there are patterns in the group dynamics. In other words, you've got a finite number of people who are interacting together day after day, week after week, and they will create behavior patterns. The dynamics here aren't any different than individuals who will respond in exactly the same way under the same conditions or circumstances over and over and over again. Groups do the same thing. They create behavior patterns. So the ticks, so we got individual ticks that form into these larger patterns, and these patterns we have found repeat themselves over and over and over again. right? And as a result of the way our minds are designed to think, it is natural for us to think that if I can find consistency here, meaning this pattern repeats itself over and over again, that the outcome should also be consistent too, right? Wrong. The outcome will be consistent, wrong to an extent. Well, the outcome will be consistent over a, what? Large sample size of trades. So you've got individual patterns where the patterns themselves can look exactly like the previous one, can measure mathematically exactly like the previous one, but will the outcome be the same as the previous one? And why? And we got people shaking their heads, which is good. Not everyone's shaking their head, agreeing. But the point is, how do we know for a fact that the outcome may not be the same? Because even though, like I said, visually they can look exactly the same and measure exactly the same, there are still always going to be different people involved in this trade. And it only takes one person somewhere in the world to have a different idea to negate the positive outcome of that trade, for example, if you bought that support line. Just one trader, that's all it takes. So what it means, it's like, it isn't any different than the concept of if I flipped a coin, an evenly weighted coin, 1,000 times, I had 1,000 flip sample set. I will find that each sample set has a relatively even distribution between the number of times heads come up and the number of times tails come up. You with me on this? It'll be close to 50-50. That is a pattern. That's a pattern I can rely on. But within that 1,000 flip sample size, do I know the distribution between the individual heads and tails? In other words, I don't know what the distribution is. I can get 10 heads in a row, I can get 10 tails in a row, I can get 5 heads, 3 tails, heads, tails, heads, tails, heads, tails. All in all, it's going to come up to 50-50. Casinos. They've got basically a 4% or 4.5% edge in blackjack based on the way they've got the rules set up. That means that of all the hands played, or let's say if there's $1 million wagered on any particular table, they're going to end up with $45,000. That means that takes into consideration all the big winners, all the big losers, everybody in between. Do they fret? They sit there and fret over every single hand that's played? No, they don't. They've learned to think about it appropriately. Go ahead.
Mark, real early in my trading career, I went to a seminar, and the person speaking said to the group, if we flip a coin 20 times, how many of you think there's any chance that we would have, say heads is a winner and tails is a loser, that we would have 12 or more heads or tails in a row? And nobody in the group believed that it was possible. We then proceeded to flip the coins in a row. Out of the 2014 came heads in a row.
I believe it. Yeah, to me, that's,
everybody
yeah.
was just astounded.
Right.
Because nobody ever thought, it's like, could I ever possibly have that many losers in a row? Well, there's proof positive.
Oh, yeah.
Just when you think it won't.
Absolutely. But if you did it flip 1,000 times, you still come up close to 50-50. So now, just based on what I've just said just now, what would that require? What would that require of us to create consistent results as traders?
Try to find a 50 way to win.
Well, no, you got to have an edge. You've got to have an edge. In other words, yeah, to execute your trades without thinking about the outcome of each individual trade. In other words, every single error, guys, look, and girls here, every single error that's on that list, you cannot make. You cannot make any one of those errors without believing you think you know what's going to happen next. Just take a moment and contemplate what I just said. You can't make any one of those errors without somehow thinking or believing that you know what's going to happen next. And that's why you can't create consistent results if you're not creating consistent results. It's because you're still susceptible to making those errors. And the way you're susceptible to making those errors is because you're susceptible to defining all these R's, these up and down ticks, defining the up and down ticks in some way as potentially painful. In other words, you are taking basically a neutral event that you're observing. And what do I mean by neutral event? What? No, neutral event emotionally. Neutral in the sense that can the environment, let's say, or let me ask you, is the information that the market generates about itself and its potential to move inherently joyful or painful information? Is it positively or negatively charged information? What's that? Well, no, I'm asking from the market's perspective. Is the information that the market generates about itself, is it positively or negatively charged? It's neutral, right? Okay, it's neutral. Is there such a thing as positively charged information? No? No, no. Just in the environment. Is there such a thing as positively charged information? Yes, okay. Is there such a thing as negatively charged information? Okay. In other words, people expressing affection and love can be positively charged, right? Or is positively charged. People hurling insults at you is negatively charged, right? Okay, so the market does not generate, as a characteristic of its existence, positive or negatively charged information. If that is the case, then how is it that we can feel fear?
Because we're attacked, we reject.
Yeah, in other words, somehow or another we've interpreted the information in a way that causes us to feel that way, right? So from the market's perspective, it's neutral. It's the interpretation process that causes us to define it in a way or interpret it in a way where it's potentially painful. And as soon as it becomes potentially painful is when we know what we think is going to happen next. In other words, why am I hesitating? Why am I hesitating? Why am I getting in too late? Why do I do that?
Because I think it's going to be different next.
Yeah, because I think I know, because I don't think it's going to work, right? Why am I hesitating? I don't think it's going to work, and I got to wait. Because I know what's going to happen next, or at least I think that I do. Why am I jumping the gun? I know I'm going to miss out, right? I'm going to miss out. I got to get in now. Why don't I predefine my risk? Yeah, I know I'm right. What?
I've tested it for 10 years.
I was worried about the how much time have I got here? 5 minutes? About 9? Oh, okay, I'm sorry. Go ahead, I'm sorry.
Take 10.
Take 10.
I've tested it for 10 years. So I did my forward testing, my analysis is correct, my technical fundamentals. I don't know. I cannot be wrong.
You cannot what?
I cannot be wrong.
You cannot be wrong. Yeah, right. Exactly. See, every single error that we make is always going to be the result of thinking, feeling, or believing I know what's going to happen next. But the problem, as I said before, is that this is only an error. It's only an error within the context of what you're trying to accomplish. Now think about what I just said. These are only errors within the context of what you're trying to accomplish. If you're trying to accomplish consistency, then these are trading errors. If your objective is not consistency, even though you might say that it is, if the reality of your trading is that it's not consistency, then every single thing that you can do here could result in a winning trade, and it's not an error, obviously, then, is it? If I can hesitate and it ends up in a winning trade, then I did the right thing. If I can jump the gun and I end up in a winning trade, I did the right thing. It's only the accumulation of these errors that cause these massive drawdowns that end up hurting us. Okay, so what we have is the market works the same way in terms of let's say trading works the same way in that we've got patterns, the patterns repeat themselves, but the outcome to each individual pattern is random. And we know that because there are always different participants making up any particular pattern that might look, sound, or feel or measure exactly the same as the last time that it occurred in the market. Which means that there's always a risk. It's just like a number of you people have read Trading in the Zone. Remember the example I used in Trading in the Zone about working with a trader who came to me for consultations, and he was like a really terrific analyst, but he never made money as a trader, and he blew through a bunch of his family's money and his friends and anybody he could talk into opening up an account for him. And so after going through a lot of people's money and a lot of people being pissed off at him, he came to me for help, and I said, hey, look, you've got a number of different issues here that you're going to have to work through that might take, an extended period of time. Why don't you get a job doing something, that someone will pay you for, and earn your money legitimately. And so he got a job as an analyst for a clearing firm in Chicago. And he, like I said, he was a good analyst, and they paid him really well for it. And so the president of the firm, who was a retired grain trader, never traded, using technical analysis. He was always down in the soybean pit. And traders, the way traders make money in the pit, especially locals that they trade, their mentality and the way they trade and how they make money is very, very different than making direction-based decisions off a screen. But anyway, so in fact, it's so different that you almost really couldn't classify the two as being trading. The guys in the pit would say they're traders. The guys on the screen would say they're traders. There's such a vast difference between the two that one of them can't be trading. But anyway, you'd have to call it something else. You'd have to just call it something else. But anyway, so he sat down with the analyst and to learn about this mysterious technical analysis, and that's exactly what he looked at. It was somewhat mysterious, and the analyst would always talk in real definite terms, very arrogantly, like, okay, this is going to be the high of the day, this is going to be the low of the day. So in one particular day, the market was trading in between what he said was going to be the high, going to be the low, started drifting down to the low, and so the chairman said, hey, so this is going to be the low of the day, right? He said, yep, that's right, this is the low of the day. So he picked up the phone right next to him with a direct line to the soybean pit and said, sell 2 million bushels at the market. And the soybeans dropped 10 cents in a matter of, like 5 seconds. And the guy's looking like, what the hell happened? Okay, random results. That was the pattern that he was looking at told him that was supposed to be the low of the day. All it takes is one trader somewhere in the world to negate the positive outcome of your edge. Okay, but the reality of trading or thinking in probabilities has to do with 5 fundamental truths about the nature of the market and trading. Make what thing bigger or smaller? I'm not sure what you mean. Well, the problem is that. Oh, here we go. Okay, good. I was using this instead of this. Okay.
Mark, you're going.
Okay. Now, if the casinos can make money can make consistent money by taking an event that has a random outcome, or each individual event, each individual hand of blackjack has a random outcome in relationship to the last hand. We as traders can do the same thing, but we can only do it if we acquire the appropriate mindset. What I found the appropriate mindset to be is thinking that anything can happen. Not just thinking it, believing it. Believing that at any given moment, anything can happen. That every moment of the market is unique. Now, think about the word unique, about the definition of the word unique. Everyone probably understands or knows the definition of unique, something not like anything else that ever existed. We understand the definition, but to actually believe that every moment is unique can be quite difficult because of the implications. The implications on our current set of beliefs and as well as the way our minds are designed to think. Remember, our minds are designed to think in association, to link this moment, whatever's occurring right now in this moment, that's similar to something that's already in my brain. Something that's already in my brain as a memory is my past. And if every moment is truly unique, it means that in essence, my mind is not processing information in a way that's consistent with the way reality exists. Because what's going to happen is that, let's say for an example, I've got my edge, and my edge presents itself, and I execute my trades flawlessly for the first 3 trades. And they're all winners. And then the next occurrence of my edge comes up. My mind is designed to think in association, to take what's similar now in the environment. What's similar, because it can't be identical, although it may seem that way. But what's either similar or what we think of as identical, associate it with what's already in my mind, meaning I'm going to associate it with the past 3 trades. They've all been winners. It taps me into a nice, happy feeling. Possibly, again, like a state of euphoria. I might even cross that threshold. I have worked with traders where all it took was one winning trade to flip them into a state of euphoria. One, that's all. Just one winner, and they were flipped into a state of euphoria. And so the way my mind processes information is that I will automatically associate this now moment opportunity with my past, causing me to do what? Possibly make a trading error, right? I can make any number of errors. I can make a money management error. I might even jump the gun, get in too soon, because I think whatever's happening right now, I might miss out on it. Right? Or what if the last 3 trades were losers? Yeah, I probably won't take the trade. Why? Because my mind, the way it processed the information, caused me to enter into a state of mind that told me that this trade is a loser. The fact is, I, at a rational level anyway, do not know what's going to happen next. And the most important thing is I don't have to know to make money. I do not have to know what's going to happen next to make money as a trader. Does a casino have to know what's going to happen next on every single hand of blackjack to make money? Do they have to know what every number is going to come up next whenever the time they spin the roulette wheel? Or someone throws the dice and craps? No, they do not. And nor do we. We don't have to know what's going to happen next. And every time we get into a trade thinking that we do, for whatever reason, we have the potential to make a trading error. And to create these huge drawdowns. Now, again, let's get back to the unique. Every moment is unique. How do we know for a fact that every moment in the environment is really unique? Not just the market, but in our everyday lives. How do we know, let's say, how can we establish that every moment is really unique? Is there any way to really establish it?
We change every moment, right?
Yeah, but I mean, so let's get down to a real fundamental level. How do we know that every moment's really unique? Well, yeah, but how does that make every moment unique? Time. And what's happening over time?
Changes.
But what causes change? Movement, right? Movement over time causes change, meaning that what we know, what we understand and know is that every atom and every molecule spinning around every atom is in constant motion. That's at the most fundamental level. So in essence, for a moment not to be unique, for some moment in time not to be unique, every molecule of every atom would have to be in the exact same position it was in some previous moment. I don't think that's possible. I don't know that it is or it isn't. I mean, I don't know for sure. I just don't think it's possible. And therefore, as a result, it makes it easier for me to believe that every moment's unique. And as a result of believing that every moment's unique, it makes it easier for me to counteract this automatic mechanism in my mind that causes me to process information in a way that tells me that I think I know what's going to happen next, when the reality is I might not. What I think is happening, what's really happening, could be there could be a vast difference between the two. A perfect example would be one in trading in the zone where when I was many years ago, when I was writing The Disciplined Trader, it was like on a Saturday afternoon. I'd been writing all day, and I turned on the TV just to take a break, and it was late in the afternoon on a Saturday, and there was some locally produced program in Chicago called Gotcha Chicago. And what they did was just like, they did practical jokes on celebrities, but in this one segment, they hired a guy to go out on Michigan Avenue, and they stuffed his pockets full of cash and gave him a sign that said, "Free money today only." And his instructions were to give money to anybody who asked for it. That was his instructions. And so he went out on Michigan Avenue with this sign, and they had a film crew out there, hidden so that nobody could see what was happening. And he was, first of all, he was shocked. You could tell he was shocked by the way that he was acting and the look on his face, because he thought that people would just come rushing to him asking for money. And they didn't. As a matter of fact, there were many people who were making a wide path around the guy. Now, if we make some assumptions here, one, that there were any number of people who passed him by that could read the sign. They actually, in fact, could read the sign, "Free money today only." And two, that money is very important to most people. As a matter of fact, maybe under other circumstances, crowds, people can get into a frenzied state of mind and act, really, act in very bizarre ways if they think money's free. So in essence, in some ways, he might have even been endangering himself and didn't even know it or think about it. So he was getting frustrated by the fact that nobody was asking him for money, and except for one guy. That's right. One guy came up to him and asked him for a quarter for a bus transfer. Okay? And I looked at this guy who's probably a panhandler, because there's a lot of panhandlers in downtown Chicago. So he got frustrated, and he walked up to some guy with a briefcase, typical guy, suit and briefcase, and said, "Sir, would you like some money?" And the guy said, "Not today." Really, not today. And he said, "Well, how many days does this happen?" And the guy just walked by him. Now, what does this example tell you about the nature of the way our minds have the potential to process information and the kind of interpretations that we can make? You can always tell what people believe based on their behavior. You can always extrapolate their behavior back to a belief, because it takes energy to express ourselves. Now think about this. There's any number of ways in any given moment that each of us can express ourselves, meaning interact with whatever environmental forces are attendant upon any particular situation. It takes energy to express ourselves, and we will express ourselves in some way that is consistent with what? With what we believe is true in the moment, right? Are you guys with me on this? So if I really got good at this, I could take anybody's outward behavior in relationship to the circumstances and really say, well, this is what they had to believe to behave this way. This is what they had to believe to behave this way. So what can we say about the people that walked by the sign? They didn't believe it. They were operating out of a belief that free money does not exist. And in most cases, it does not. In this particular day, it did. It was real. It was true. Anything can happen. Every moment is unique. And what about the people? So what we have here, and this is what's really critically important for you to understand. I need another one of these. What's the other one? Can't find that other blank one. Oh, here it is. Okay. Consistency is the result of a state of mind. So we have positive, we have negative. In other words, we have degrees of fear and degrees of confidence, okay? Confidence is positive energy, fear is negative energy. And what we want as traders, ideally, is to be in a confident state of mind, a confident, carefree state of mind, without the potential to define and interpret the up and down ticks in any particular painful way. So what we have in this situation with the free money is that every single belief that people were operating out of caused them to tap into a particular state of mind, from, let's say, from positive to negative, based on their interpretation. So we could say that the panhandler who asked for a quarter, got exactly what he asked for, and so therefore he was tapped into some degree of a positive state of mind. Right? Now, the people who were actually going out of their way to avoid him, what could we say about their state of mind? Their belief and their state of mind. Negative, some degree of fear. In other words, first of all, let's look at the interpretation. They see the sign clearly says free money today only. And so the first thing that happens is that their belief that free money doesn't exist acts as a counteracting force against the force of those words, saying, okay, that's not true. They deny the existence of the words, that's not true, and therefore, but this creates a conflict. And our minds don't like to be in a state of conflict or confusion. And so we have to reconcile the conflict in some way. In other words, there is evidence that says that my belief that free money doesn't exist is right here in the environment, where it creates this conflicting force. How do we resolve the conflict? We justify it in some way by saying, okay, since that's not true, this guy must be crazy. And if he's crazy, he might be dangerous. And therefore, as a result, I am going to take a wide berth around him. So as soon as I interpreted that information in a way that caused me to define him as dangerous, it tapped me into some degree of a negative state of mind, okay, because of my fear. Now, let's take a hypothetical situation. Let's say somebody saw the sign and says to themselves, oh, okay, what if? What if? He walks up to the guy and says, okay, give me 20 bucks. Guy pulls out $20 out of his pocket and gives it to him. What's going to happen now? No, not everyone else saw that. Okay, just say that he did it. And what's going to happen to the person that asked for the money? What? No, well, not he could. Yeah, it's possible. Yeah, in other words, yeah, something has to happen. In other words, his belief about that free money doesn't exist is going to change. Not necessarily. You never know. It's hard. I mean, every circumstance is really different when it comes to this. But the point that I'm making is that his belief that free money doesn't exist will change. He'll draw some of the energy out of it. Maybe not all of it. But this is in essence what we're going to have to do as traders to install those 5 fundamental truths that I had up a moment ago. We're going to have to change the way we think if you want to create consistent results. But I'm going to finish with the example. Hold on one second. Let me finish the example. So what ends up happening is that he's got the 20 bucks in his pocket, and what he's going to do is he's going to end up going back to the office or go home, and virtually everyone, because there's some really powerful implications here. Virtually everyone is going to say the exact same words to whoever it is they encounter, like their spouse or their friends or whatever. You won't believe what happened to me today. But 3 words, you won't believe. And you're right, they probably won't. Because their belief that free money doesn't exist will say, no, that's not true. I don't believe you. And like somebody said before, what could flip him in from, let's say he's walking around in a positive state of mind because he got free money, he got a nice pleasant surprise from the environment, didn't expect it, but what could cause that state of mind to go from positive all the way down to negative? What's that? No, the moment he thinks, or someone says to him, well, why didn't he ask for 100? Why didn't he ask for more? Yeah, and it flips, missed opportunity. It flips from positive to negative, missed opportunity. Now see, here's the problem with these negative states of mind, and why these negative states of mind make it virtually impossible for us to create consistent results. It doesn't mean you won't create results. It doesn't mean you won't have winning trades. All I'm saying is that you will always have the potential to create these huge catastrophic drawdowns. And when I say catastrophic drawdowns, because somebody asked me that, like the question in Toronto 3 weeks ago or 4 weeks ago, what's a catastrophic drawdown? Well, I've worked with traders who were multimillionaires, and a catastrophic drawdown for them was, $1,000. They didn't have the tolerance to lose $1,000. So it's different for everybody. But the point that I'm making is that if we're trading with any degree of fear, what ends up happening is that fear as an energy has a very negative effect on our ability to stay objectively focused in the now moment opportunity flow. In other words, fear has the effect of narrowing our focus of attention onto the object of our fear so that we end up creating the very experience we're trying to avoid. So if I'm afraid of being wrong, I'll make myself wrong based on my interpretation of the information. If I'm afraid of losing money, I will cause myself to lose money based on my interpretation of the information. If I'm afraid of missing out, if I'm afraid of leaving money on the table, I will create these very circumstances that I'm trying to avoid. Go ahead.
Why can't we apply that same principle to greed?
To what?
Greed.
You're going to have to...
Fear, we do this for fear, greed. We believe
Yeah.
to create something that makes us fearful. Why can't we have that for greed? So we have more greed and we can make more money and believe we'll make more money. Why is
Well, because the problem is because greed is the fear of there not being enough. The underlying fear behind greed is that there won't be enough, and I've got to get mine. And the I got to get mine part, causes us to do things. It causes us to do things that are going to be inappropriate in relationship to what the market's offering in that moment. It's a,
Greed is actually a form of fear.
oh, absolutely. Yeah. What else could it be? The only reason why we're greedy is because we think we're not good. It's not going to be there for me. There isn't enough. Okay, wait, look, I lost my train of thought here. I was going to get into something. What was I going to say? Oh, no, yeah, okay. No, I got it. Yeah, here's, see, so what we've got to do here, I just want to give you the example of how fear causes us to narrow our focus of attention. I'll give you a graphic example of what I'm talking about. If I've defined that as support, and I'm operating out of a fear of being wrong, typical trader, we've got 4 fears: being wrong, losing money, missing out, leaving money on the table. Those 4 fears are basically what's going to cause all those errors that we're talking about up there, okay? Now, if I'm operating out of a fear of being wrong, the first thing that's going to happen is that I will not want to predefine my risk, right? Therefore, I will gather whatever evidence is necessary for me to get into that trade to have convinced myself that it's going to work. The reality of the way the market works is that even though this is a pattern, and this pattern reproduces itself over and over and over again, I do not know the outcome of this particular trade because I do not know if the buyers that came into the market here and supported that price and drove it back up, and the buyers that came into the market here and supported that price and drove it back up are going to be here in this moment. They may be out to lunch. Right? Okay? So as a trader, what do I really need to do? All I really need to do is define my risk and say, how much room have I, how much distance do I have to give the market to tell me that the possibility of this trade is so diminished that it's not worth staying in any longer? How much room have I got to give it? There's all kinds of methods that you can use to determine that, but the point is, I'm not going to go through that process if I'm afraid of being wrong. Because I might convince myself not to take the trade. And that's all based on the fact that I'm defining trading as a right or wrong endeavor, not as a probability game, not something that has random outcomes, which the reality is it has nothing to do with being right or wrong. Just like pulling the handle of a slot machine. You don't feel wrong when the tumblers don't come up. And the reason why is because you have a belief that you're operating out of that it's a random result. And so it doesn't connect it to your feelings of what it means to be wrong. So, what ends up happening? Let's say I get in this trade and the market, does something like this. Okay? Now, the market gives us up and down ticks, right? At the most fundamental level, it gives us up and down ticks that form into patterns. If I'm afraid of being wrong, because it has the potential to tap me into the accumulated pain of every time I've been wrong in my life, what am I going to focus my attention on? The up ticks or the down ticks? The down ticks? No, I'm afraid of being wrong. The market's giving me up ticks and it's giving me down ticks. In this case, it's giving me more down ticks than up ticks. Let's say on a 4-to-1 ratio, but that doesn't matter because I'm going to take the upticks. I'm going to focus all my attention on the upticks. I'm going to place greater weight, greater significance on the meaning of the upticks in relationship to the downticks. In other words, my fear causes me to narrow my focus of attention in a way that makes the downticks invisible. In other words, we have automatic pain avoidance mechanisms in our mind. Everyone understands the nature of avoiding physical pain. You don't have to think about avoiding physical pain. In other words, this is a hot burner. I don't have to contemplate if I put my hand on it. I don't sit here and I don't weigh and judge or whatever, taking my hand off. It comes off automatically. Everyone understands that. What people typically don't understand is that the environment can offer information pain. Now, we all understand the nature of information pain in that context, but what we don't understand is the mechanism of how our minds will alter our perception of that information in a way that causes us not to have to confront it. And as traders, this is deadly. This mechanism is what causes all the pain. You're trying to avoid something that, in essence, you can avoid it, but it can't be avoided. And the reason why it's so difficult as traders is because in our everyday lives, we can lash out and we can control our environment or other people in ways, if we become effective at it, to cause them not to confront us with this information that we define as painful. And we can get really good at that. The problem is, you can't do anything to stop it, to stop the market from doing it, except control your perception. So, what ends up happening is that we place an inordinate amount of significance on the upticks, on whatever upticks that we might get, to the exclusion of the downticks, to the point where what? At some point, this guy's going to get out of this trade. What do you think that point is? We're talking energy dynamics here. Remember, all we have to do is look at someone's behavior in relationship to the external circumstances. We can tell what they believe. So, what's going on? When is he finally going to get out of this trade? Everyone in this room has experienced this, so you all really ought to know it. I'm sure there isn't one person in this room who hasn't done this. What's that? Yeah, you're going to get out when it reverses up. However, that's true. However, what's the underlying dynamics? Is being wrong the only thing we're afraid of? No, we're also afraid of losing money, right? So we have two fears now. We have two competing fears, where in this case, in the back of our mind is our fear of losing money. But as the market keeps on going further and further down, this fear of losing money starts coming to the forefront of our consciousness until it gets to the point where, let's say, if this represents all the negative energy and a belief of what it means to be wrong, then when the fear of losing $1 more is 1 degree greater than our fear of admitting that we're wrong, we will get out of the trade. You guys with me on this? When the fear of losing $1 more is 1 degree greater than how much energy is in our fear of admitting we're wrong, is when we get out of that trade. And the interesting part about all this is that have I learned, or have you learned, the distinction? In other words, there is a pattern that the market can create called a trend. This is a pretty fundamental pattern, right? And under normal circumstances, I would be able to perceive and recognize when that pattern exists in the market. Interestingly enough, when I'm in this trade, I do not see this as a trend, do I? As a matter of fact, I don't see it till I get out and I hit myself on the head and say, why didn't I just go short? In other words, my fear of being wrong literally blinded me, created what's called perceptual blindness to the pattern or the opportunity that the market was giving me in that moment. Now, if we just take the opposite, look, instead of this trade being a loser, let's just say the market goes in the guy's favor. Okay? What's going to end up happening here? Is he going to focus on the upticks or the downticks? Downticks. Yeah, who hasn't been in a winning trade where the market came back and took the money, right? So you're operating out of a fear of leaving money on the table? And that's exactly what's going to happen. Because every downtick, that fear that the market is going to take money away will well up, causing us to think that we know what's going to happen next, not recognize, let's say, that we're in an uptrending market and get out of that trade here instead of somewhere up here. And therefore, what ends up happening, of course, we fit the profile of the typical trader where we let our losses run and cut our profits short. And that's all because of the dynamics of the way fear causes us to narrow our focus of attention on the object of our fear so that we end up creating the very experiences we're trying to avoid. How much more time have I got, by the way? Like 30 minutes, because I want to make sure that we... So what we have to do, if we want to create consistency, we have to get to the point where we no longer have any potential to define and interpret what is, in essence, neutrally charged information, or with information without a charge, in any kind of negative way. How are we going to do that?
Is that a question?
Yeah, I'm asking you. How are we going to do it?
That's what I'm you.
What's that?
That's what we're going to do now.
What?
Redefining your risk.
Well, that is predefining your risk. I mean, accepting your risk implies, predefining and accepting your risk implies that it's completely reconciled, that there's no other conflicting energy inside of you that would argue otherwise. But the point is that how am I going to get to the point where I have access? Because really I'm going to define objectivity. I'm going to define what I want is I want 100% access to everything I've learned about the nature of the market in any given moment. Remember, I just said that my fear of being wrong caused me not to be able to perceive that as a trend. That's a distinction about the nature of the market. That distinction offers me opportunities to do something. That's part of the opportunity flow in any given moment, telling me what the market's potential is to move in any particular direction. If you look at just the concept of objectivity, is there such a thing as an objective reality? You could say that the only way that two people could actually be experiencing the very same thing in any given moment is if you had simultaneous awareness of everything going on at once. Now think about what I just said. Simultaneous awareness of every distinction that the environment, every possible way that the environment can characteristically express itself, you can perceive. And if I can perceive every possible way, and you can perceive every possible way, you and I are sharing a reality. Up to that point, anything less than that, and we're in our own little world. And there will be times in which we may be sharing a reality with another person, but for the most part, based on our interpretation of the information, it's unique to us. Now, has anybody in this room learned to make every possible distinction in terms of the way the market can express itself? This group dynamics, this group behavior? So in other words, if you shake your head no and you think that, okay, I haven't learned to make every possible distinction in the market's behavior, it means that at any given moment, there's things going on that are invisible to me, right? Because I can't perceive what I don't know. Just like the first time you looked at a price chart, what did you see? You saw lines that had no meaning. You couldn't make any distinction. That's right, you couldn't make any distinction in the nature of those lines, right? Here, give you a good example. quick. Here we go. Look at a chart like this. What do you see? You see a bunch of lines, right? Okay. Where's the other one? Oh, here we go. Same chart. Well, just take it away. Same chart. And all those measurements are almost exact. Really, virtually exact. I didn't fudge on anything there. That's symmetry, those are patterns, okay? But when we first saw these charts, okay, what did we see? Our minds could not make any distinctions at all that represented opportunities. Now, since all of us have learned to read charts to some extent or another, if I can magically reproduce the first chart you've ever looked at and put it before you right now, would you see opportunities in that chart that were completely invisible to you the first time you looked at it? Yeah. Okay. Now, what I'm saying is that all of us have our own objective reality. Meaning that if I've learned to make, let's say, 30% of all the possible distinctions in the market's behavior, in any given moment, I want to have conscious access to all 30%. To whatever degree I'm operating out of fear will diminish that percentage. You with me on this? Every degree I'm operating out of fear starts to diminish the percentage of what I can perceive of what I've learned about what's available, to the point where it can almost get to zero. So if I'm going to create consistent results, I have to find a way to trade in a carefree state of mind without the potential to define and interpret market information as painful. How am I going to do that?
You have to release control, if you have any control over it.
Yeah, how are you going to do that? Ignore what? Ignore outcomes? Yeah, we're going to have to step into an active process of changing the way we think. Step into an active process of changing the way that we think. To simply think like the casinos think. And in essence, this is what I'm talking about. Because every single one of these beliefs, that every moment is unique, and edge is nothing more than an indication of a higher probability of one thing happening over another. There's a random distribution between wins and losses in any given set of variables that define an edge, and you don't need to know what's going to happen next to make money. Every single one of those statements represent a concept about the nature of the way things work. This is the truth from the market's perspective. The closer that our minds are aligned to this truth, the less fear that we have the potential to operate out of, or the less potential we have to define these up and down ticks in any kind of painful way. Are you guys with me on this? Yes. So how do I get those in my brain unconflicted? How do I do that?
Probabilities and statistics.
Probabilities and statistics?
You believe in that.
Well, you don't necessarily have to be. I mean, it'll drop down to a subconscious level after a certain point, but it doesn't. No, in other words, you have to learn how to change your beliefs. That's basically what I'm getting at. You have to learn how to think, change the way that you think about things.
So then you have to know how you come up with believing something in the first place.
Yeah, exactly. So basically, I mean, we don't have that much time here. I mean, I don't even have that much time left. I mean, this is something that normally takes me a good 2.5 days to get through. I mean, 2.5 days of really intense stuff. But I'm gonna tell you how to do it. And if at least if you go to Trading in the Zone, you can reinforce it there. You could also get I've also got tapes, or you can even come to one of my workshops, which I'm going to be doing one in August in Scottsdale. But if you can't do any of that, at least know that there is a way to do this. And that's simply to set up a trading regimen. Use your trading to acquire skills instead of trading to make money. The money will be a byproduct of the level of skills that you've acquired. And to set up a trading regimen that is specifically designed to learn to believe those 5 fundamental truths. I'm going to say it again. To set up a trading regimen that is specifically designed to do one thing and one thing only, and everything else is not irrelevant but of secondary importance. To believe those at a core level of your trading identity in an unconflicted way. To believe those truths. So how would I do that? It's not that hard, really. I mean, I'm saying it's not that hard to set it up. You might find it hard to do. Might find it very hard to do. Anyway, the way I what's that? Yeah, the way I suggest to do it is to create a mechanical system. Now, is to take, when I say a mechanical set of variables, I mean exactly that. Where your entries have to be, your entry signals have to be precise. Where there's absolutely no subjectivity whatsoever as to whether or not this signal or this particular edge is present or not. No subjectivity. And your exits have to be precise. As a matter of fact, probably the best way to do this exercise, especially if you guys if you trade electronically and you do it and you trade the E-mini S&Ps or the NASDAQ, is to set up a trading exercise in which you go like 2 for 2 in the S&P, risk 2 to make 2, or 5 for 5 in the NASDAQ. Those are pretty easy parameters to work with. In other words, whatever comes first. So you don't have to make a judgment about where to take profits or where to take losses for that matter. And also what I suggest, I even set this up in a way where I just use a simple crossing stochastics on a 3-minute chart, like an 11-period stochastics on a 3-minute chart. You can either do it 2 ways. You can either take every signal, because you might get anywhere from 25 to 30 signals a day, or you can wait for divergence between stochastics and price. When there's a divergence, you just take those right there. So for an example, if you have if the market's going lower and stochastics crosses and you get a little bit of a rally, and then the market makes a lower low, but on the stochastics it makes a higher low, that's price divergence when you connect the lows, then just take that one right there. And what I do in these circumstances, just to set up the exercise, is that I wait for a hard cross. Wait for a hard cross in the stochastics, meaning that when the market, like on that bar where it's about to cross, the lines can cross and come back depending on whether the market's going up or down. And on the open of the next bar, it'll make a hard cross, meaning that they won't cross again until the actual numbers cause it to cross. So you actually go in on the market on the open of the next bar. So that way it's precise. You got to click as soon as they open. Now, what's the point of this exercise? The point is this. Are you guys clear about that? Okay. It's about the cleanest one I've got here. I only brought 2 of these. Here's what you want to do. You want to set this up in 20 trade sample sizes, between 20 and 30. No matter what particular variables you might use to define an edge, it doesn't matter. Really, the best thing to do is come up with your own set of variables. How good the variables are and how well they work is of secondary importance. If you just paid for commissions with this particular exercise, you would be doing well. If you just paid for commissions. The point is this, is that instead of saying I'm going to take the next trade like what most people do, you're going to say I'm going to take the next 20 trades. You're trading in 20 to 30 trade sample sizes, meaning what you want is you want a sample size of trade, just like flipping the coin. You want a sample size of trades that's large enough to adequately test your variables so that at the end of the sample size you can say, okay, my results are satisfying, therefore I'm going to take another 20 trades. Or you can say my results are unsatisfying and I'm going to tweak my variables. But you cannot tweak your variables in the middle of a sample size. That is absolutely forbidden for this exercise. And in essence what you're saying is that, okay, I'm going to take the next 20 trades. 17, 18, 19, 20. And what you want to do, in essence, what you're going to do with these next 20 trades is you're going to learn, you're going to be training your mind, you're going to be convincing yourself that you don't know what's going to happen next. And that you don't need to know to make money, because you don't know the distribution between wins and losses. Even if I gave you a system that in the past produced 70% winning trades, I still couldn't tell you, if I'm going to say I'm going to take the next 10 trades, I can't tell you which 7 are going to be winners and which 3 are going to be losers. I don't know. There's no way I could know. So that in essence, what that requires me to do as a trader, if my objective is to become consistent, is that I have to take every single trade. And I have to do it flawlessly, meaning I have to get to the point where I have flawless execution. And that's something you have to recognize as traders anyway. Analysis does not make you money. Only actual executing a trade can make you money. And so what I want to do is I want to get into these circumstances. I want to get into these circumstances where, let's say, this was a winner, and this was a winner, and this was a loser, this was a loser, and this was a loser. Now I'm on this, now I'm confronted with this sixth trade. And my mind, everything in my mind is telling me, no, that's a loser, I can't take that one. And just do the best you can. Take it, don't take it. But the point is that when you can do, and what I'm saying is that not to avoid these circumstances, when you can step through all these conflicting thoughts, when you can actually take the trade anyway, and that one turns out to be a winner, what you're doing is you're automatically drawing energy out of anything else that's inside your environment that would argue against doing exactly what you need to do when you need to do it. Every time you confront one of these situations and do the appropriate thing, step into it, confront it, and do it anyway. The point is that you will know when you have integrated those 5 fundamental beliefs in your mental environment effectively, when you can do one of these 20 trade sample sizes flawlessly without any conflicting or competing thoughts. You will be a trader, guaranteed. You will be a trader. So if you're going to set this up, set it up in a way that makes it easy on yourself. You don't have to be trading a large amount. You don't have to be trading, you want to do the S&Ps, the NASDAQ, just trade one contract. You don't even have to trade multiple contracts, just trade one. If you trade stocks, trade 10 shares. Doesn't matter. It really doesn't. This is not about making money. It's about creating skills. Consciously stepping into a process of creating skills. This isn't any different if you were a golfer, if you're into tennis, if you're in any other kind of endeavor that required certain skills. The difference is the skills are mental. You guys have any questions?
I just have one comment to make. The reason why we don't think logically is because human brain is supposed to think in risk and passion because of evolution. I know kind of personal psychology, but the reason is we don't apply logic outcomes because apparently we were cavemen. We didn't have the luxury of being retrospective, so we took whatever and we didn't go back and practice. The survival was the key.
Huh. I mean, yeah, well, you think about it this way. I mean, if our beliefs were a 100% reflection of the way things existed, now think about what I'm going to say right now. If our beliefs, if there was a 100% correspondence between what I believed and the way reality existed, what would that imply? That would imply I'd always have my expectations fulfilled. I'd be in a constant state of satisfaction. You guys with me on this? Because what is an expectation? An expectation is simply my mental representation of what the next moment or the next, a minute from now, 5 minutes or whatever, is going to look like in the environment. If the external environment shows up in a way that's consistent with what I expect, then I'm going to be in a state of satisfaction, right? To whatever degree it doesn't show up in a way that I expect, I will be in some degree of emotional pain. That is a universal characteristic of human nature. Everyone wants their expectations fulfilled. But the point is that if like I said, I'll say again, if our beliefs were a 100% reflection of the way reality existed from its perspective, from the environment's perspective, then we would be in a constant state of satisfaction. We'd always be getting what we wanted. Which implies that if we are not, then something's got to change. Now, in a social environment, if we've learned how to exercise control over people and the environment, we'll make the environment look like the way we want it to. There's always consequences to that. You know, there will be, because nobody likes to have to behave in a way that's inconsistent with what they believe. And if there was harmony between my belief and their belief, I wouldn't have to do anything in the first place, correct? The problem is we can't exercise that kind of control over the market. The only thing we can exercise control over is our own beliefs. And to create them in a way that's consistent with the way the market exists. The market exists in a probabilistic way. It's that simple. If our beliefs that we're operating out of are not consistent with that, then we are not going to create consistent results. It's that simple. We'll create random results. And we'll have a lot of fun. And we'll have winning streaks and we'll have winning trades. The problem is we'll always be susceptible to the catastrophic drawdowns. And they take their toll. Go ahead.
Mark, in your experience, it sounds like we got these perceptual filters. That this exercise eventually takes those things away.
Correct.
In harmony with the market.
Correct.
Has it been your experience, or do you think it's to the point that you just get to the point where you just know? I mean, you're so unbiased by anything that what to do next is just obvious?
You mean, yeah, you mean in other words, you're operating out of a sense of, you know, like an intuitive sense? Yeah, exactly. You're in the zone. In other words, there's complete harmony between you and, you know, your mind, your state of mind, and what the market is offering you in any given moment.
So the market's never trying to hide anything from
No.
you, it's just we put the blind.
That's right. Exactly.
So
Go ahead.
is that obvious then?
Is that obvious? What do you mean, is that obvious? It is obvious when you're in that state of mind. That'll be obvious. And when you start thinking about it is when you'll pop yourself right out of it. So go ahead.
I want to go back to your fishing deal.
Yeah.
Doing a lot of fishing. Sometimes I let Rodney catch fish, which I put the rod in the rod hole, and I end up catching more fish that way than I do try to actually fish. Which brings me to the mechanics of this. If we set up precise entry points, which there's no way of doing that with you mechanically get in, or you have stop loss stops to get in. Can you set this up mechanically and let it go on your end? I think I read you on precise entry. I understand that.
It has to be, yeah, precise.
But on your precise exit, that is.
You're better off setting it up where everything's precise. Where, what you don't want is to get yourself into a situation where you can't make a distinction between what's going on in you and what's going on in the market. In other words, if you set everything up, if you set this regimen up in a way so that you know that it's you that's having the conflicting thoughts, it's not some let's say some judgment that you have to make so that you can rationalize away your mistake.
I've done that with stops on stuff. I'm emotionally attached. If it hits a point, that's okay. I've already done that. So on my pre-planning for the trade, then I can actually pre-plan to what I'm going to take as a profit, pre-plan my loss, put that in there, and walk away.
That's right. Yeah, if you want to walk away, the best thing to do, look, if you're already evolved enough where you don't have these kind of problems that I'm talking about, you don't have to do it at all. All I'm saying is that, if you have the potential to define and interpret market information in any kind of a painful way, then for whatever reason, you probably have to do this exercise. You haven't acquired all the skills that are necessary. Instead of walking away, the best thing to do is actually sit there and watch it, meaning confront whatever it is that needs to be done and do it in that moment, being aware of all the conflicting thoughts. In other words, I'll give you another example. There's a trader I worked with many years ago who owned a couple of construction companies in Texas. He was in his 50s. He was trading bonds. He was losing his ass. He thought, okay, I'm going to go up to Chicago and show these guys something, right? So he bought a seat at the Board of Trade, went into the bond pit, and just got annihilated. You know, so he was having one of his bad days, and someone suggested he come to me for some coaching. And so one of the things that I realized, of course, that he really couldn't even define an edge. And at the time I was using point and figure analysis, and so I showed him how to define support and resistance within about a 6 or 8 tick point range in the bonds. And so we did this for about 2 weeks, and so it was time for him to go down to the floor and implement what it is that we did. And his instructions were very precise. In other words, if the market was in between, support and resistance, that if it came down to support, he was to execute his trade at a specific price. He was only supposed to risk 3 ticks, which is just about a little less than $100. 3 ticks, and if go 3 ticks against him, he had to get out. If not, and it went in his favor, he waited until it reached resistance. He took his profit and reversed and with the same stop. So the day that he went down there, the market was perfect because it was right in between. It came down to support. As it's coming down, he thinks it's not going to get to his price. He ends up getting in early, like 2 ticks early. It gets to his price where his original entry price in the first place. He thinks it's going to keep on going, and he blows out of the trade for a 2 tick loss. The market reverses, goes back up, does the exact same thing at the top, just completely screwed the whole thing up, right? Now all he had to do was risk $100 in each case. He couldn't do it. He literally could not do it. He did it he did the same thing the second day, the same thing the third day, so he stopped calling me because he didn't want, this is the kind of guy, he barks out orders to people, he expects them to do it. He thought he could go down to the floor and do the same thing. He found he didn't have any capacity to do it whatsoever. So in the meantime, he's down there trading for 2 or 3 weeks, and he's getting better and better at defining support and resistance. So the interesting part about what ended up happening is that he would end up waiting till the market hit his price and get in, but he was so afraid that the market was going to take his money away, he ended up getting out of the trade for like a 1 or 2 tick profit. Now what was particularly exasperating for him was that many of these trades, as he went back and looked at his entries, there were many times he had bought the low of the day or sold the high of the day and only ended up with 1 or 2 ticks. So this was like really bothering him. So I didn't hear from him for about 3 weeks. He called me up, explained to me what was happening, and his solution to the problem. His solution to the problem was to go ahead and up his size up to about 20 or 25 contracts. So, hey, makes sense, right? The problem with upping his size, so see, instead of learning how to hold on to his trades, okay, he's going to up his size and get the money, right? Well, the problem with upping your size is that you go from a 1-lot trader in the bond pit to a 20-lot trader. You're dealing with a completely different set of guys. There's all kinds of problems with that. Anyway, I knew he was gonna really, it was a disaster, and I knew it. I didn't say anything to him. I thought, hey, just let him. He's going to do it anyway. What difference does it make? So he did. He called me up. He lost all the money he'd made in the last 3 weeks, plus a bunch more. He said, okay, here's the key. I am ready to do anything. Okay? He was ready to do anything. And he was. He sincerely was. So I gave him an exercise, a real simple exercise. Very similar to what I just gave you guys. And this exercise worked great for him. He had to do the exact same thing as before. The only difference is that when he got that trade on, he had to put his hands in his pocket, turn and look at the clock on the wall and be in agony for as long as he could. He had to put his hands in his pocket and look at the clock, and here were the parameters. The market either stopped him out, or he had to stay in it for 20 minutes, whatever came first, or it reached his objective. 20 minutes, and the longer, and the first couple of times he, I don't remember, but it's probably only a minute or two that he could stay in the trade. But he worked his way. He was very diligent about it. He worked his way up to the point where he could turn around and look at the clock and face each agonizing second until it wasn't agonizing anymore. And then he went on to make quite a bit of money trading. So the point is of that story is that don't walk away from it. If there's conflicts, stay with them. In other words, be with it. Embrace it.
That's so fun.
What?
That's a lot of work.
Yeah, well, hey, depends on how bad you want the skills. Go ahead.
I have read somewhere, quite a number of cases actually, where someone has a trading system.
Oh, what? A trading system?
That's so good. Like, never had a single loss trade in 30 trades. All right. Is this person behaving from your philosophy, or he has an age that we don't know about? And what would that?
That would be hard for me to answer. It is very possible for somebody to have winning streaks of 30 or 40 trades in a row. That's not that unusual. It really isn't. I know it may seem like it, but it really isn't.
But it's not a function of understanding the dynamics of the market.
It's a function of both. What it is that when you've got the appropriate mindset, that's when you can utilize your technical abilities to their fullest potential. Okay? It isn't the other way around. Learning about the market's not going to give you this mindset, guys. It just isn't. If you think learning about technical analysis is going to give you the mindset we're talking about, you are headed you're either on the path or headed down the path of ultimate exasperation. It isn't going to work. Okay.
If this is about human reaction, then what is better? Is it better to just buy a system that exists, which many have tremendous track records, and leave it with the broker and let him trade that amount of money? Or is it better to trade that same amount of dollars if the human factors?
I can't answer what you think is better, because it has to be within the context of what you're trying to accomplish. Still you have to say, what are you trying to accomplish? If what you're trying to accomplish is just to acquire profits and you don't want to trade, then give it to somebody else to do. That's, the question really answers itself. But just put it within the context of what you're trying to accomplish. Put everything within the context of what you're trying to accomplish. What's your objective? Then do it whatever way is satisfying to you. Do it in a way that's most satisfying to you, whatever that is. And only you can determine that. The man says I got 3 minutes. Anybody else? If not, we can end 3 minutes early. I can take a break. Are we all done? Okay.
Good morning, traders. Thank you for joining us on this WTV special on putting your mind over the market. I'm Jared Levy, Chief Options Strategist here on Wise Trade TV, and using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, you know, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, you know, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit? This profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, you know, that they can rely on from their trading. And I'm sure that you know, many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy. Right. Or because it's easy to find yourself in a winning trade, exactly. Which many people do.
Right.
You know, that they think it's also easy to become a consistent winner.
Right.
And you know, it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the 2.
It almost seems like there's no relationship between the 2.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, you know, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that, you know, being able to click a mouse button or, you know, tap a pad is a skill. Right. And we don't have to have a reason or good reason or actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of you know, what kind of skills did it take to actually experience this? Absolutely none.
Yeah, so it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. You know, and that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're going to get into that, but at the most general level, I'm going to say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, you know, a high school basketball player who, you know, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's not
see that all the
out of the
time.
realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method, right, and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now.
You're
trying
on
to stay
TV.
focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
Well, you're doing fantastic. by the way.
Anyway, you know, with training, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method or trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's
So
interesting.
you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know, that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about when we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis, and not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, you know, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he will undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
You know, and I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because, you know, they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique.
Right.
They have to be able to view that as random and unique. You know, that's I think the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. And that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner, right. This trade, even if the charts are the same, right. Even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to, for us up here, you know, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, you know, let's again back up here for a second. There are traders out there using WiseTrade every
right.
single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria,
right.
same formula, same everything.
Right. The chart pattern can look exactly the same. Yeah, everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, you know, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of, you know, the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, you know, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or you know, how do they begin to remedy these issues?
Well, here we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this is because their initial exposure to the markets themselves is through electronics. Right. In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing, you know, you to want to participate in the first place. In other words, you know, markets started as exchanges, right. And there were, and so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way.
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay? Right. So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human behavior, the human belief in if I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, or it's going to go to 12. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, you know, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And
Okay.
so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are traders, there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is this, is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Okay. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? Is this the first step for them getting control and understanding how the market's working?
They definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any
or a
number,
fresh cross.
Yeah, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this, is that when this set of criteria, okay, is present in the market, that there's simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money.
Using all your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. But we're putting the edge, you said, in our favor.
Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which
times
flips are going to
come up heads,
which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails. The next one's tails. The next one's tails. In other words, we could have streaks of heads or tails. Okay, yeah. We could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have
70%. So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations
up. Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, and this makes a whole lot of sense to me, and I hope it's getting through to you guys, we have a tool that gives us an edge, whatever it is. Right. Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as,
I see. Okay.
So maybe 55 or 56% of the time.
Right.
Let's just say.
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make, at the most at one point, in I think around 1987 or 1988, he had $400 million.
Is that using his edge or his money management, or a combination of both? A combination
of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things, I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, okay, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows, he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan.
Well, yeah,
or they
usually
think
don't
about
have
the
a plan.
trade too much. They think about, is this going to be a winner? Is this going to be a
That's
loser
right.
for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think when
it's going to be a winner.
It's going to go on
And
forever.
I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk.
Right.
Now, does he put a cap on the upside? Does he put a cap on his win
Well,
side?
it's not a matter
Or
of
goal?
a cap. It's a matter of how, his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk-to-reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time, as I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV.
Okay, trading skills. Who are the professionals? We already talked about that. And why would it be beneficial to think like a professional trader? We already talked about that. What's the answer? Anybody can make money, okay? We kind of already established the fact that anybody can make money as a trader. Yeah, we're talking about consistency. What we want to do is we want to close that profit gap. We want to make sure that our bottom line results reflect the potential of our methodologies. Okay? And that's what the professional has learned how to do. The professional has learned how to close that profit gap. They have learned the appropriate skills to do that. They're people just like you and me, okay? They're no different. They really aren't. They've evolved into a different way of thinking about trading. That's the reason why they can do it. And you can do it too, with understanding and awareness. That is really primarily what this workshop is about anyway. Because when you think about it, if you've read stories of people who have aspired to greatness as a trader, you'll always find, with almost all of them, that there's this underlying thread, this underlying theme that virtually all of them have lost one or more of what they considered a fortune before they started becoming consistently successful. Why do you think that underlying thread or theme exists in their lives? What's that? Why do you think that commonality exists? Because at some point they lose so often and then come back from losing that, one, they gain the confidence that they can do it, and as a result the fear dissipates, and as soon as the fear is gone, they're trading from a carefree state of mind, and when you trade from that carefree state of mind, everything about your trading changes. Remember that the primary skill that we're talking about here is simply trading without fear. This is a trading skill. It is the primary skill that you will have to acquire to create consistency, to trade without fear.
You're watching Wise Trade TV.
Welcome back to the WTV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads.
Right.
Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern.
Right.
You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information.
Right.
So, for an example, if I'm in a losing trade, and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case.
Right.
It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me.
Okay.
In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade,
right.
I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks that I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to? Or?
Yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto.
Okay.
The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good.
Right.
And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. My reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you shut off?
Yes, by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
For whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel? Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's just
it's a random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly. Okay, because the odds aren't exactly in your favor, and what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not, I mean, this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in the machine.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? And then what we do is we wait for a pattern to show up. And if the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. First. The pattern shows up first, okay? Then what we have to do is put up our money, meaning how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. Right. How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it. But they haven't really accepted the risk.
Right. We see it every day. Every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which
is
another problem all in itself.
Oh, yeah. But see, the thing is like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
And how does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise they can do?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just like anything else in our lives. When we realize that there's a particular goal that we have, and and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay? And that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
What's that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate that the potential is by understanding that trading is not about being right or wrong. It's a probability game.
Right.
If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do
got an
evolve.
hour and a half, by the way. Keep going.
We do? Oh, okay. Well, yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's
move
right.
on.
And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some other traders didn't come into the market that had the same belief that you had or the same conviction that you had about this market doing whatever it is that you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? Someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter, okay?
Exactly.
They find themselves doing things that, what am I doing this for, And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade-by-trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology, at the very most fundamental level, what this is telling me is that
fresh cross.
There's a higher there's a high, or let's say the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now, they're either going to come or they're not. And so, as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out. It's not worth the cost of finding out. That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DVD.
Yeah, absolutely, but not like
very
specific. Not the kind of specifics that like if you're in a half an hour time frame, how much.
Well,
how
that's
much
the trader's decision.
Yeah,
but the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to their risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, et cetera. Is that an exercise you think would be beneficial?
Oh,
For the
absolutely.
traders?
Yeah, absolutely. I mean, and that's what I suggest to people, all the time. Especially, when I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and they'd get into a situation where they're on a pretty good losing streak, and often it required that they actually go back to a risk level that they hadn't. Meaning that if they were trading, 10,000 or 100,000 shares, or willing to take, $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that I mean, look at it this way: paper trading. Okay, a lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology. But more so, it is a graphic representation of the mental skills that you don't have. That's
an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills?
Look at your paper trading.
Yeah, look at your paper trading in relationship to your real trading. Yeah. Now, if there's, and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss.
Right.
Because the way our minds think, in other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendencies to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares, and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. That's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at WiseFest and earlier we talked about some events of pain in your life. And a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there, does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication, actually? And I'm not trying to be rhetorical here. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You aren't in pain right now, are you, Jared?
What's that? Yeah. I'm good. I've been out of the market all
I'm
week.
just kidding. Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring
Well,
to?
explain the gutter principle.
The gutter principle, in other words, how much in the gutter do you have to be before you're willing to say, I'll do anything?
Mm-hmm.
As a matter of fact, this kind of brings something up. Is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine tuning. Okay, they wanted creative ways of fine tuning themselves so that they could actually increase the amount of money that they make over a year, or whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated, they're so frustrated because of the potential that it's so obvious what the potential is, and yet there seems to be these invisible barriers that keep them from getting into that potential. That they come to me saying, "I'll do anything." And that's, now everyone has different tolerances of pain before they get to the point where they say, "I'll do anything," and mean it, and be sincere,
and mean it. Well,
That's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up this show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders or any final thoughts, maybe a mantra, something?
No, just basically just to kind of sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profits. But I'm saying the pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the objective part about trading.
You can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
Okay.
so we've got plenty more time to go. One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10. Mm-hmm. How do you define edge as a closing thought?
Just simply, an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, like for example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back in a couple minutes. Guys, It is time for a break. We want you to get your questions in for Mark. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can send us an email to trader@wisetradetv.com. When we come back, we will answer your questions and talk more about psychology in today's markets. We'll see you back here in 5 minutes.
know, this is kind of maybe a long drawn out introduction to the fact that what we're talking about here is that you guys have a really wonderful trading methodology where there is an enormous amount of potential for you to be able to make a consistent income from being able to take full advantage of the potential that this trading methodology offers you. But I would say that there's probably, it wouldn't be unfair for me to say that there's probably what I'm going to call the profit gap. The gap between the potential and your bottom line results. This is the potential, and this is your bottom line results. Most people think that when they realize that this gap exists, that somehow learning more about the markets is what's going to fill it. And what you're here today to learn is that that is categorically not the case. You have to learn more about yourself and how you interact with your trading platform and the market to be able to fill this gap. There are psychological skills involved.
You're watching Wise Trade TV.
Of course I watch Wise Trade TV.
I love Wise Trade TV.
It's like a partner. It's like somebody who's there with you. They care about what you're doing on your trading.
It's my friend. It's my support.
If you have a question and you're not sure about something, you can call in, you can email, and your question is answered.
It's exciting to be part of it, a live part of it.
You learn something every day.
If they're serious about wanting to trade, they need to watch the program. I mean, it's just all there is to it.
It's a no-brainer.
I wouldn't want to be without it.
We are doing this for you. Wise Trade TV.
Hello, I'm Alan Nuckman, president of the Commodity Explorer software program.
And I'm George Thompson, president of Wise Trade.
We're offering Commodity Explorer at a special subscription model for only $99 a month. It's great trading software with some super training, available video on demand at Wise Trade Television.
Alan, Wise traders trade with red lights and green lights, supply and demand. It makes sense to open your financial futures to commodities. It's that simple.
If you understand the charts of Wise Trade, Commodity Explorer should be an easy transition. You're able to trade the stock market indexes, interest rates, metals, energies. There's some major benefits in these futures markets today. We trade electronically. There's additional trading hours to execute your plan. You're able to diversify and trade any market that's moving. There are no limitations, upward, downward markets. There's enormous volume growth and tremendous liquidity. So commodities are a growing market that you want to be able to participate in today.
And the best part of Commodities Explorer, it's only $99 a month.
Visit CommodityExplorer.com for the $99 a month subscription.
Learn to trade commodities with Alan in 30 days or your money back.
For 12 hours each trading day, Wise Trade TV is your ticket to finding great trading opportunities in all of the markets. Now, every Monday through Thursday, the last hour of Wise Trade TV is devoted to personal investor training. Welcome to Wise Trade University. We'll cover all types of topics from general market knowledge to the hottest trading strategies. Wise Trade University brings the classroom and our top market experts right to you. Tune in Monday through Thursday from 6 to 7 Eastern. Class is now in session.
morning. Welcome back to the WTV special, Mind Over Market. I'm your host, Susan DeFore. Now, you've seen some clips from Mark Douglas's DVD series, Trading Psychology. Well, we're running a special right now. You can get the DVD series for the special low price of $895. That's $400 off the regular price. And if you're one of the first 50 people to order it, you'll receive an autographed copy of Mark's book, Trading in the Zone. You can call 1-888-304-8881, extension 1, or go to www.wiseminds.com to order the series. You don't want to miss this great opportunity. Mark and Jared are still here and ready to answer your questions. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can email us to trader@wisetradetv.com. Guys, Mark, that was a great show. I loved all the information you gave everyone.
Thank you, Susan. Thank you very much.
Thank you so much for being here. I know at Wise Fest everybody was thrilled to actually get to meet you and see you in person. So it's a special pleasure to have you as a special on WTV.
Thank you. Different for me. I've never been on live TV before, so this is.
Well, you're doing a great job.
Thanks.
Well, you know, guys, we have lots of callers and emails to No Surprise, so why don't we get right to the phones?
Let's go.
We have a call from Brandon in Massachusetts. Good morning, Brandon.
Hello, guys.
Brandon, hey.
And lady.
Good morning. What's your question for Mark?
It's not really too much of a question. It's mainly I'm a complete clean slate. I learned how to trade through Wise Trade. I didn't know anything before. And I just thought you guys want a perspective of not knowing anything. And your analogies that you used were great. It really made me understand what's going on. And what I just want you to comment on what I've taken from it. That's okay.
Yeah, we'd love to hear it.
These are the things that I've gotten. Why is trading not guaranteed? It's because prices are determined on predictions of what other people will do. And technology can record what other people have done in the past, but cannot predict what people will do in the future. Right?
To a point, yeah.
No, they can predict what people will do in the future, but just not on a trade by trade basis. In other words, you're going to get it's like I'm going to go back to the coin. What Wise Trade or technical methodologies do is give you a weighted coin. Where if I've got a coin that says that 70% of the time that you flip this coin, it's going to come up heads, then that's what your technology, that's what your technical methodology does. It gives you that whatever percentage edge. It just means that on each individual trade, which is what the tendency that most people have to do, is they try to figure out if this trade is going to work, not if the next, not what's my percentage of wins to losses over the next 20 trades or the next 10 trades or the next 100 trades.
That's a good point. Edge.
Edge. That's a good point, Jared.
Edge.
Okay, Brandon, well, thank you for calling on that. We have another caller. It's Miss Amber in California. Good morning, Amber.
Hey, Amber.
Susan, Jared, Mark, hello.
How's it going?
Good to hear from you.
Oh, yes. Hey, you know what? Thank you, Susan. Mark, thank you so much for being here.
Thank you.
Your book,
My pleasure.
Trading in the Zone, I read it cover to cover. I love it. I think it's neurolinguistics for trading and for traders. And I loved what you said about scaling out of positions. That made so much sense to me.
There are little bits and pieces in that book, you know, that a lot of people don't. It's not just, you know, blanket psychology. I mean, there's so many little intricacies in that book that'll help you with your individual trading if you pick them out. Talk about scaling out. Where did you come up with? I mean, obviously.
Where it occurred to me to scale out was back when I first started trading. Well, not exactly when I first started trading, but while I was working at Merrill Lynch at the Chicago Board of Trade as a retail broker, by the way. And I used to keep meticulous records, and I would analyze my trades. And I found that And I found that rarely did I get into a trade where it just stopped me out immediately. In other words, where the market never gave me anything. In other words, I get into a trade, let's say I bought at 10, and next thing you know, price is at 9. It never went to 11, okay? Right. So that was maybe 1 out of 10 times that would happen. And then I saw that there were a certain percentage of my trades where it went, if I bought at 10, it would go to 12 or go to 13, and then go back through my entry point and stop me out at let's say 6 or 7. So it actually gave me something, but I didn't take it because I was looking for something more. And so what I did is I analyzed my trades in this way and put them into categories in terms of the percentage times that it would go in my favor in relationship to when it didn't, and found that I could give myself consistent results if I started scaling out. In other words, I would take a part of my position off at a very small amount. Let's say, just to make it easy, I trade a lot of silver and gold back then, but just to make it easy, where I would take a first third of my position off at, let's say, 3 or 4 cents in silver. Okay. And what that would do is that would not only make me a winner from a psychological perspective. If you really want to look at this, psychologically, what you want to do is you want to create a belief. You actually want to create this belief inside of you that I am a consistent winner. Right. And what will happen is that when that belief gets integrated into your mental, as part of into your mental environment as part of your identity, as long as, of course, the steps that go into making I am a consistent winner are consistent with that belief. In other words, it becomes a part of your identity, and you just function out of that belief in a way that you don't even have to think about it anymore.
That increases your confidence.
That's right. It not increases it. It's just who you are. So in other words, if I want to actually believe that I'm a consistent winner, then I have to do something that creates that. So by taking off at least a third of my position with a small amount, what that would do is that would reduce my risk. So if the market did go back and stop me out, it wasn't stopping me out of my whole position, but if it didn't, then of course I had a spot where the next third came off, and then a predetermined spot where the next third came off. And now the problem with scaling out that a lot of people have is that if they get into a monster trade, they're the loss potential of, if I had the whole thing on, I'd just made so much money. But again, it's like, what's your objective? If your objective is to get those monster trades, then it's going to be inconsistent with producing consistent results. So you have to be clear about what it is that you're trying to accomplish.
I really like that, Mark, because there are a couple of things you said that I really like, and one is setting yourself up for success. And it's sort of like what you do with your children when they're smaller. You want to reinforce the positive things that they're doing correctly, because then they know, you know what, I can do this. And so by taking those profits as they're coming, you do have that mental state.
Absolutely. It's really critical. It's really important. I think it's one of the most. Once people get some of the fundamental skills out of the way, it is probably the most important thing they can do for themselves. Is what I call take money as the market makes it available. Have a plan for taking the money as the market makes it available, because we don't know how far it's going to go.
I do something called kibbles and bits, where I just say, you know what, I could just try and grab 5 and 10 cents. I know that with my trading, from what I've done in the past and based on the tool that I'm using, it's very easy for me to grab 10, 20 cents out of each of my options. Now, if the option costs $2 or $3, that could be 30% or 10% of my trade, depending upon the cost of the option. So little bits and pieces, just trying to eke out small wins, and then again, instills confidence, makes me feel good in my trades.
Absolutely. Well, we have another caller on the line. It is Lee in Ohio. Good morning, Lee.
Hey, how y'all doing today?
Hey, Lee.
It's good to hear from you.
All right. I just, I talked to you when I was down at Wise Fest, and a lot of things that you were talking about, I was telling people and teaching people. But once I talked to you in the way that you really summed some things up, it just really just brought it even to light even more for me. Now, one thing it has did, it made me trade so much from a carefree state that if I see a fresh cross on a day and a good month and a good week, I get in it and I mess around and be in 20 different trades. but
could there be too much of a carefree state of mind?
You say what?
I was asking Mark if there could be too much of a carefree state of mind.
Well, I look at it, and it took me. The only thing that I don't play is earnings. Okay. And it took me to, me and you were just talking about it yesterday, Jared. It took me to the mindset that I don't care what the market is doing. If I see the charts is right, I'm getting in, period.
Right.
I don't even think about nothing else. And it's so funny, when the market went down, I lost some money, and a couple of my friends called me, and they was like, you should sell everything. You should sell everything. Liquidate your account. And I'm laughing. I'm laughing at them. They was like, why are you laughing? I was like, I'm going to win some, I'm going to lose some. I ain't worried about it. I'll make it back. You know, and that was my mindset. And it's just funny that when you get that mindset, you don't just think, you don't even think about nothing else.
Yeah, Lee, it's important for you still to have a plan.
Oh, no, I got a plan. I got a plan now. No, I do have a plan.
And in Lee's defense, if there's one thing Lee has, it's a plan. But it's funny when you said the carefree state of mind. I mean, that's more, now, what you do talk about is something called euphoric trading.
Or euphoria,
That's euphoria, that's different.
Well, there could be something here with, there could be an element of that with you want me to cover that? Or
could you talk?
I think it's a great idea.
Well, you know, all of us, let's put it this way. We talked about expectations in the first segment. It's like, you know, when an expectation is simply, you know, a mental representation of what some future moment in the environment is either going to look like, sound like, feel like, taste like, or smell like, okay? In other words, if the environment, if I believe that the environment is going to be a certain way, the outside environment is a certain way based on my mental representation, if it shows up that way, if it shows up exactly that way, how do I feel? Well, universally, this is a characteristic that runs through all cultures. This is a universal human characteristic. How do I feel? You're going to feel good, right?
Yeah,
you're going to feel satisfied.
Good.
There could be a range of really positive emotions. Okay, and this is universal. And by the same token, the degree to which the environment does not conform to our expectations, how do we feel? A whole range, you know, like I brought up before: disappointment, dissatisfied, betrayed, whatever. Okay.
Yeah, usually it's extremes like omnipotence and like total failure.
Well, the thing is that all of us have this potential to flip into a euphoric state of mind. And a euphoric state of mind is one where, for whatever reason, whatever expectations we had, let's say the environment showed up in a way that far exceeded what we thought, and it's just like we're as high as a kite. And what happens is that these chemicals get in, you know, get released in our mind and our body. And the problem with a genuinely euphoric state of mind can be like heaven, literally like heaven on earth. Yeah. And the problem as traders, when we're in a euphoric state of mind, is that in a state of mind of heaven on earth, it is impossible for us to conceive that anything could go wrong. Anything. Impossible.
That's when the stops come off.
Impossible, exactly.
Risk increases.
And so, and I've worked with so many traders, and I can say that I've worked with traders who have, let's say, their threshold for euphoria was one winning trade. Okay. Oh, wow. And there are others who, you know, maybe a string of 4 or 5 winning trades, or 2 or 3 winners and a big monster or whatever. But the point is that there's a state at which we can operate at normal confidence, in which we can do all the things, stay in the process of trading, meaning that, you know, we're objectively executing our edges, we're predefining our risk, we're cutting our losses, we have a plan for, you know, taking profits on a consistent basis. And then when you flip into this state of euphoria, all that changes, because absolutely nothing can go wrong. And as traders, that's one of the most dangerous places to be, because even though you may perceive that nothing can go wrong, the market may not agree with you. And that's when we have this tendency to violate money management principles, where if we're a 1,000-share trader, we'll put 10,000 shares on, you know, we'll mortgage the house or whatever, because the trade just absolutely, there's no possible way it could be a loser. And in these situations, what happens is that when we've got 10 times the amount of exposure than that we're used to, then all it takes is just a tiny, tiny little bit that the market can come against our position, just a tiny bit. Right. And we can go from the state of euphoria to a state of terror instantaneously.
Because of what you just said. You were a 1,000-share trader who now committed 10,000 shares to this trade because you were in this euphoric state. Wow. When the thing flipped down, your loss is now way outside of what you call the norm.
Well, it doesn't even have to be a big loss. It doesn't even have to be. It could just be the fact that nothing could go wrong, and so therefore, you know, it just shatters the state of euphoria, so that we go from heaven virtually to mental hell instantaneously, and it puts us in a state of mind freeze where we just can't even get out of the trade, and we're just sort of watching the market take our money away and not able to do anything about it until something snaps inside of us and we get out.
So that mid zone, you kind of want to stay in that.
Yeah, you want to stay in normal confidence. And what I was picking up about Lee was that he may not be violating money management principles, but when he realized that he could trade from a carefree state of mind, he was kind of doing many trades. You see, he might not have been planning all these trades out, and just going from, you know, instead of doing, if he was a 1,000-lot trader or a 1,000-share trader, instead of doing 10,000 shares, if he was just trading 1 or 2 markets, he's trading 20. Okay, right. You know.
So we have an email from Ed, the Philly Pip Collector. He said, did most of the knowledge that you're sharing today come to you from your mentor or mentors or from practical experience? How long of a period of time did it take you to trade without fear from the time you started trading with real money? Thank you again for the benefit of your knowledge and expertise.
The first part of the question is how long...
Who did you learn from, and how long did you trade with
Who
your...
did I learn from? I started writing The Disciplined Trader in 1982. There wasn't really back in 1982. There weren't even that many trading books available.
So this was a personal revelation.
Yeah,
so this was from your own experience that you're writing this stuff.
This is all from my own experiences. Yeah, as a matter of fact, it had to do with you know, losing everything that I owned as a trader, and at the same time being in a situation where I was at Merrill Lynch, you know, where I was observing, you know, not only other brokers in the office, but the behavior of my customers, their customers, having relationships with floor traders, noticing these common themes of errors that we were all making, and then when I ended up losing everything that I owned, I was in a state of mind where I didn't have anything else to lose, other than maybe my job, because, you know, Merrill Lynch would have known the situation. I'm sure they would have fired me, but they didn't, and so I was able to not trade anymore because I didn't have any money. But at least I still had access to the markets. I still had access to being a trader, and when people really genuinely tap out, they don't get to trade anymore because they don't have the financial resources to do it. Right. So I was in kind of a unique situation where one, and this I could probably explain it, but I'm not going to do it here, in that I just knew that trading was psychological right from the very start. It just made sense to me that it wasn't technical as much as psychological.
So is it because of your observation of not only what was happening to you, but everybody around you, and then you had bottomed out?
Yes.
So you got rid of the fear there because you had already experienced.
Yes, I had extensive journal work that I did, and so in 1982, you know, when I came to these realizations about myself and about trading, and when I didn't have anything more to lose, everything about my trading changed because it was like the fear dissipated, and it's like I started making consistent money for my customers. Because I was doing the same things, but I was doing it from a different perspective, and not making the errors.
So the second part of his question referred to the time it took you to get over your fear, and you think it was more, or you say it was more like almost an instantaneous...
Well, yeah, it was an instantaneous, maybe an instantaneous realization, but it was because of these experiences.
Right.
And so what I started doing is developing the material that ended up in The Disciplined Trader. What I didn't anticipate, because I never grew up aspiring to be a writer or thought that I would be, is that, I mean, having very much of a trader's mentality back then, I would say, you know, okay, this is going to take me 6 or 8 months to do this. It ended up taking me almost 8 years, and it was tapping basically where this insight comes from. Is I tapped into the creative process. What I mean is that I specifically stayed away from any other material that had anything to do with even psychology or trading. There wasn't really anything on trading psychology anyway, except for one book, Jake Bernstein's Investor's Quotient, that came out in 1980. But otherwise, I specifically stayed away from it because I realized if you ask yourself questions from a sincere space of being open to any answer that comes, you'd get any answer that comes. And so I was really developing this material as I was going along.
Very good. Well, we have another caller on the line. Good morning, Keith. How are you?
Good morning.
Keith,
I'm great.
What question do you have for Mark?
The question I have for Mark is this. You're speaking of learning to get into that carefree state of mind and starting small. You said, example, 10 shares to gain that consistency. When would you then increase it? I mean, 70%, 80%, then increase? what would be your guideline, or would you go by a psychological guideline? That's my question.
Interesting one. Thanks, Keith.
I'd go by a psychological guideline. In other words, when you can trade 10 shares perfectly, in other words, when you can set up a trading plan and execute that plan, when I mean perfectly, I literally mean not just execute the plan perfectly, but execute it without any conflicting or competing thoughts about what you need to do and when you need to do it. In other words, it wouldn't even occur to you to make a trading error. And then what you do is you move up to the next level and see how well you do.
Is P&L an equation here? Profit and loss, is that an equation?
Well, not necessarily. I mean, you can do an exercise like that and not even take profit and loss into consideration. That, in other words, there are many times I've set up for people, trading exercises that really didn't take into consideration how much profit they might have.
It was following the plan.
It was following the plan.
Because we know we're going to lose, Jared.
That's right. Right. It's
so
following
you can
the plan.
live with that loss and just keep moving forward.
Exactly. In other words, how well can you follow the plan? And then if you can follow the plan without any conflicting or competing thoughts to do other than what you set out to do, then you up your size. And if you're real comfortable right off the bat, you can up your size even more. But if you find you're not comfortable and you find yourself making trading errors or even thinking about making trading errors, then stay at that level until that doesn't happen anymore.
That's great advice. Thank you for that. We have another caller. Frank is the first time calling in. Thank you for doing that, Frank. What can we do for you? Frank, are you there?
These are good questions, by the way, that people are giving us.
Good stuff.
They really are, yeah.
Okay.
Yeah.
Well, I don't think we have Frank on the line, so let me go to one of our emails. This it says, since you cannot know that a trade will be a winner when you enter it for the same reason, can I assume that a profit target is the same psychology? Assuming that the next tick after I exit a trade, after reaching my pre-assigned target profit, will be a down tick is the same false assumption as when I enter the trade thinking that the next tick will be an uptick, that I must wait for the market to tell me that the trade is over. So it's kind of the reverse.
Yeah, there's no way to know how far a market's going to go in your favor. You just have to pick these predetermined spots, or if you don't pick predetermined spots, then use some sort of an indicator like another fresh cross or a trailing stop to get you out of your trades.
Very good. Okay, our next email is from Hal in Pennsylvania. And he says, hi, Jared, Mark, and Susan. On behalf of all the wise traders, I want to thank you for this great opportunity to listen to Mark. The question I have for Mark is, over the years, have you found that a day trader can be as successful as a swing trader or long-term trader, provided stops are in place and a good trading plan is in place?
It doesn't. It really how you categorize the way people trade is virtually it isn't even relevant. In other words, it depends on how you think about your trading and what you're most comfortable with. So
I would think that your trading style has to fit your personality and your time allotment.
That's right. Yeah, so a day trader who's got their mind right is going to be just as successful as a swing trader who's got their mind right, and a swing trader who doesn't won't be any more successful than a day trader who doesn't. So.
Well, Jared, you touched on something that earlier when I was watching the program, I thought we would ask Mark. If somebody is new to trading and they watch Wise Trade TV and they see that we have all different trade styles and we even have all different markets, a common question we get is, how do I determine what trade style is suitable for me? And how do you think that from a psychological standpoint? Not necessarily, maybe they can spend all day at the computer and they have time to do that. But for who they are, how do you help determine what type of trader is more suitable for their personality?
That's a good question. And it's kind of tough one to answer, too.
You'd probably have to meet the person.
Yeah, for me, it's like even when you do personal consultations, it's like what I realize is that you can't put people into categories or pigeonhole them into certain boxes. That everyone's mental ecology is unique, and you have to respond to that kind of uniqueness. So how a person goes about determining what trading style is most appropriate for them would pretty much be based on what they're attracted to. In other words, even for me, for an example, for many years, I learned to trade as a swing trader because we didn't have access back in the late 70s and early 80s. We didn't have access to market information. There weren't all these platforms and computer. Because personal computer hadn't even been invented yet. So what we had to do is we had to call our broker for the high, low, and close and keep our own bar charts. So the day trade was absolutely impossible. Right. A day trade away from the market, not being on the floor. However, and so because that's the way I know how to trade, you know, years later, it's like, you know, I'm kind of losing interest in trading, and the reason why is because I don't have the toleration to sit in front of the screen all day long to wait for 2 or 3 trades.
Right.
My nature is that, you know, I want to be active, and if I'm going to sit in front of the screen, I want to trade. So basically, I had to come to the realization for myself that, you know what, even though, yes, I know how to swing trade successfully, I got to learn how to day trade successfully, or otherwise I won't do it at all. So, you know.
So in a way, if you think about somebody that likes to go skydiving and, you know, drive fast cars, and they're really always wanting kind of that high adrenaline, position trading to them would probably be very boring.
That's right. Absolutely.
So kind of take a look at yourself like that.
That's right.
Okay.
Yeah.
Well, let's go to our next caller. It's Doug in California. Thanks for calling in, Doug. What question do you have for Mark?
Well, first, Mark, thanks for being there. And I had a comment and then a question, which is that I read your books, and I saw you at WiseFest, and I've seen the DVD, all the DVDs, and they were wonderful and life-changing and great. So I just wanted to thank you very much about that.
Thank you.
I seem to need one more thing, which is I needed to get smacked.
Mark does that for a small fee, Doug.
I see. Okay, right. Oh, that's all I can afford.
Not anymore.
I worked in high tech, and I understand Google and Apple, and I knew the iPhone was going to be a big deal, and I knew that Google wouldn't be making a hardware phone and all that. And basically, I was really arrogant, and it took those things cratering for it to really hit home that my knowledge was nothing. It was worthless. And it's just exactly what you've been saying, and I had the theoretical knowledge, but now I got it for real. So I'm making some big changes, and you're just a life teacher, Mark. Anyway, my question is, do you know of any, like, lotion for thinning skulls when somebody has a really thick skull? Just kidding.
For thinning skulls. He has a thick skull.
Lotion for thinning a skull. Okay, I'm sorry. Is there a lotion? Is that what you're saying?
Right. Oh. How do you help a thick skull? But so is there any way other than the hard way to get through these lessons that I guess most traders seem to need to get through?
Nothing has to be hard. It's just truly. I've learned that nothing has to be hard. It's just a matter of how strong your desire is. In other words, if you can, and this is one of the reasons why I'm even here in the first place, that if I can say something that makes this connection between where you're at right now and where you'd like to be, more tangible, then let's say the enthusiasm that you might generate to get there will be enough to cause you to focus on whatever it is that you need to do to get there. In other words, to take to take your goal or your objective, break it down, or create a process for yourself, break the process down to its smallest incremental steps, and then just take one step at a time. So it doesn't have to be hard, but you just have to really want to do it, and that wanting has to be genuine. You can't give lip service to that desire. It has to be genuine. And really, and this is really good. I mean, this is really the secret. That when I say it's genuine, what that means is that whatever you need will come into your life. I guarantee you that. If your desire is genuine, whatever you need will come into your life.
And that's because we have the power within us.
That's right.
To bring it out.
That's right.
Okay.
Right.
We have another caller. It's Rich in California. Hi, Rich.
Morning, all. Morning, Mark. How you all doing?
Hey, Rich.
Good.
Hey, Mark, I want to thank you. Boy, you've really made a big difference in the way I trade, too. And one of the things I found was that it forced me to create a worksheet that I follow so that I could follow 20 trades at a time. And I'm following your system to the T. Some of the things that I found that it's done for me is it's made me see my mistakes because they're on paper. Yeah. It's also helped me stay very consistent. And what I'm finding from the consistency is once I get through a certain amount of trades and I go back and now that I have a record of each trade, I look and see what consistently was going wrong, what was consistently going right. Mm-hmm. I then make adjustments for my next 20 trades. The other thing I'm finding now that I'm really becoming very profitable is that I could actually get into what some other people would consider more risky trades, but because I'm staying consistent with my stops and my strategy, it's not a risky trade to me because I know those stops are going to take me out, and it takes the emotion out of it.
Right. Perfect.
I wanted to thank you for everything.
Yeah, you're welcome, Rich. I thank you for calling and sharing that with us. It's like one of the things that you're realizing is that when you take a consistent approach, which most people don't have, they actually have a random approach and don't know it. But when you take a consistent approach, you're learning what works and what doesn't, and you become confident in your ability to be able to assess that. Whereas with people, they're taking a random approach. They don't ever learn what works and what doesn't because they're using an unlimited number of variables to generate a trade. In other words, when they get into a trade, when they get a signal and they start building a case one way or the other to either take the trade or not take the trade, all the let's say the rationale that they're using to build that case or to take it or not take it are these unlimited variables that they're adding into the equation, which prevents them from ever learning what works or what doesn't.
And correcting the proper thing. I mean, you can't,
exactly.
you can't tweak a variable if you don't know what variable you changed.
Absolutely right.
Well,
Absolutely
Mark,
right.
I think it's wonderful that Rich called in. We have a stack of emails, and a huge number of them are not questions for you. They are thanking you because they have read your book, they've watched your DVD, and they are on their way to, making better trades. So that's wonderful.
Wow, thanks.
We have an email here from Roger in Toronto, and he says, "I like to thank Wise Trade TV, the Wise Trade TV team, and Mark for this wonderful enlightening session. Timing is perfect now. I'm in the state of disappointment because of big losses. My question is how a strong and carefree mind, which is a consistent state of mind, can analyze the randomness to create the consistency. What do I have to give up to change my way of thinking?"
There's that question again.
Boy, analyze the consistency. I have to read that question. Can I see that question?
Yeah, it's my question here, right there, Jared.
There you go, Mark. He's referring to accepting randomness to create consistency.
How strong and carefree mind, which is consistent, I can analyze the randomness. Here, first of all, as I kind of break that question down, you're not analyzing the randomness, for one thing. You're not analyzing at all. What you're doing is you're buying or developing a methodology that just finds patterns in collective human behavior. So the idea that you have to analyze anything is probably where the problem is. You're not analyzing randomness. All you're doing is accepting. You're accepting the fact that the outcome to the pattern is random. And that's probably the best I could do without talking to him personally.
Having faith in your tool is what he's saying. The market is a random event. The tool gives you edge, accepting that you don't have, just like Doug's example, you may be a software engineer who worked for Apple for many years, and you may feel that Apple, in this particular situation, because of the way that I feel about it, because of my experience, therefore Apple is bound to work out. You have to realize it's totally random, and each individual event that takes place is random, and that specific event in that moment in time is not any special than the one before it.
Absolutely. Absolutely.
To give you here, can I elaborate on that just a minute?
Sure.
You were down on the floor, okay? And when I was in Chicago doing consulting work, I had a lot of floor trader clients and friends.
You love those guys, didn't you?
Yeah, absolutely. We had a good time. Quite a world. It's changed a lot now. But anyway, it's like so I would be trading from a monitor. And I traded support and resistance, and all support is that it's a previous swing high or swing, support a swing low, and it's a resistance a swing high, where when you look at when you look at what happened, it's like when the market stops at a particular price, it means there wasn't anybody in the world at that point that was willing to bid it one tick higher or offer it on a low one tick lower. Now, when it reaches that point again, you have to ask yourself, is there enough momentum here? Is there enough conviction in the market for someone to actually bid it past that price? And and that's the kind of assessment that, let's say, that you make when you're trading from a subjective point of view, not a what I call a mechanical point of view when you're learning how to think in probabilities. But just to make the example, is that when the market would come up to resistance or down to support, basically all you're looking for is pretty much the same people that supported the price the last time, or chances are they're going to come back in the market because they made money the last time. Right. They absorbed all the sell orders with enough conviction to rally the market, and so they made money. Chances are they're going to do it again. You trade it, and chances are doing it, and trade it until it doesn't work anymore. But the point is that because the reason why I understood that is because I actually knew the traders who did it. You say, just like on the floor.
You could see them and hear them.
Not only did I see it on the charts, but I talked to them later on that day. They were the ones that did it. And there were times, for an example, when I'm thinking, okay, I wonder if so-and-so is going to do this and that. And the trade didn't work, support failed, because guess what? They were at lunch.
Right.
That's simple, okay? They were at lunch.
Very good. Okay, we have an email from Christopher in California. He says, I look at a lot of trades and don't get in. Then I get frustrated because the price that I could have gotten in at would have created a winner for me. This happens all the time, yet I still hesitate to get in. Any recommendations?
Well, I don't know if that person should be paper trading at least. I mean, they can't tell me that they can't get in paper trading. I mean, that would be very unusual. I'm not saying it's not impossible, but, you know,
Right.
but at least paper trading, they should be practicing getting in. And then when they're real comfortable with their ability to do this, you know, just if they trade one share.
It's the fear of pulling the trigger.
Right.
That's a trading error.
That's
And
right.
we used the term trading error before. That's a trading error, not getting in.
That's right. Absolutely. It's not. Yeah, that's a
When you
trading
get your
error.
signal, you don't get in.
That's
That's
right.
a trading error.
So trade it, paper trade it until you can do it really comfortably, and then if it, you know, and then go to one share.
Well, you know, that's something that we talk about at Global Tech. We have clients that get the software, but they forever paper trade.
Right.
And it's like, come on, just go in, do a trade, you know, buy 10 shares, do anything,
Right.
just make a real trade and immediately get out of it just so you have the experience of making a real trade.
Right.
Get your mind over it. It's going to be okay.
Yeah.
Okay, well, we have another caller on the line. It's Mark in New York. Hello, Mark.
Hi, how you doing today?
Hey, Mark.
Great. Thanks for calling in. What do you have for Mark here?
I have a couple of questions and comments for Mark. First of all, I love both your books, Trading in the Zone and The Disciplined Trader. They've helped me tremendously. And what I've done is I'm consistently looking for about 15 pips trading the Forex.
Okay.
And I've calculated that with 2 lots or 2 mini lots or whatever I'm trading, over a period of 2 months that I could double my account if I do that consistently 4 days a week.
Okay.
So, and I've been playing with small amounts of money and staying on track with that. So that mental game has really helped me to not just always be looking at the computer 24 hours a day, seeing what's out there. It's looking for one particular trade at a specific time of day.
Right.
I have a question for you in relation to your background. I have extensive training in NLP and hypnosis and other related fields, and you seem to talk a lot in the same language. Have you studied NLP or hypnosis at all?
No, not really. When I first started developing this material back in like I said, 1982, I think NLP was just beginning, and I don't know exactly when it started, but I did look into NLP at the time. But at that time, it wasn't really very evolved like it is, like I'm sure it is now. In that NLP back in the early 80s was used mostly as a kind of mental manipulative technique for salespeople, and it yeah, really, and it really didn't appeal to me. And when I made up my mind that it didn't appeal to me, I just didn't go back to it ever again. So. And as far as hypnosis is concerned, I mean, I've used self-hypnosis for myself in terms of, you know, making my own self-hypnosis tapes and you know, putting certain affirmations on the tape and listening to it over and over again. But I don't have an educational background in hypnosis, if that's what you're asking.
He was swinging this clock in front of it.
Right.
Okay, well, really good. Guys, we have an interesting email. This is from Susan in Houston, and she says, "Hi, everybody. You are all so great. My question to Mark is that I have been trading about 7 years. I traded early on and learned a lot of what you're saying by trial and error. I have spent several years learning about the market, thinking I could be perfect and get through this with no pain if I did. I have taught my daughter how to trade, and she's making thousands. I sit here and I have this wall and I don't trade. I want to desperately. I can see all the trades and know what to do. I guess I need courage. Somewhere I went wrong for me. What would you say to me? Thanks in advance."
Somewhere you went wrong for me.
She taught her daughter how to trade successfully. She knows what she's doing, but she just can't. She doesn't have the courage to do it.
Was this an event that stopped her from?
No, I would say it's she's probably so much of a perfectionist that it would make it extremely difficult. But people who have a tendency to be extremely, you know, oriented towards perfection would find it very difficult to trade, because you really have to think in probabilities, and a probabilistic mindset is almost the exact opposite of a perfectionist mindset. And so what she's going to be looking is that even though she sees the signals and she sees what her daughter does, and her daughter's being successful at it, the fact is,
and she taught her daughter.
Yeah, and she
so
taught
she
her
knows
daughter.
it.
The fact is, when you get right down to it, she wants every single trade to work.
So maybe accept the fear?
No, just accept the fact that it's all right if it doesn't work.
Right.
That it's all right if it doesn't conform to your expectation, and that's where she has to change.
Okay, Susan, I hope that helps. We have Wayne on the line in Maryland. Good morning, Wayne.
Hi, how you doing? A really good session. I was just listening to it the last hour and a half, and I just wanted to add something, which I agree with Mark 1,000% on trading psychology. The consistency factor, that you're doing something consistent, and if it goes against you, you have to know that it's normal, like the normal cycles and patterns of a stock. And if you're getting into a good stock that goes against you, you shouldn't really panic because it went down. Like, for instance, what's happening with Apple nowadays, it's going through its normal pattern because it went up so much. And to add to that, what could help some people's fears is by doing other measures, buying a protective put or active trade in other stocks to bring in money while they're watching that.
I think, let me actually, I want to ask a question on the heels of your question, Wayne. If normal patterns and cycles, okay, well, first of all, what is normal? But a normal, average trading range of a stock. Mm-hmm. What Wayne's saying is different. I think basically the point that you make is you have to be willing to stop yourself, have a stop loss in place. Mm-hmm. I don't want our traders to think, okay, this is a normal movement for a stock, therefore I'll just let it go down outside of my stop loss, outside of what I thought, because that's normal for the stock itself. In other words, if a stock has a certain volatility factor, and you can't tolerate that volatility factor, you probably shouldn't be trading that stock. Mm-hmm.
Right.
Does that make sense?
Yeah, absolutely. Anything that causes you to let's say experience market information being potentially painful will take you out of an objective state of mind. Now, as long as he's in an objective state of mind and he's making an objective assessments as to what the possibilities are, and he's still looking at it from a perspective of, there's a catastrophic loss. In other words, there's a level at which, no matter what I think, I'm not going to tolerate being in this trade if Apple trades beyond this level. Then he's fine. He's making what I call subjective decisions. In other words, you can trade mechanically, you can trade subjectively, and subjectively analogy would be people who play Texas Hold'em, for an example. When you start playing poker, what you're doing is you're playing your hand. And you're not really, because you're learning, you're not really paying attention to what possibly other people are doing. But actually, you'll eventually evolve to the point where you'll play your hand in combination with what you learn about the way other poker players at the table are behaving. In other words, they're tells. And then you'll get to the point where you can actually not even have to look at your cards, you're just going to play the players. You can evolve as a trader to actually trade in a way where you can trade subjectively by asking yourself several if-then questions and determine pretty much what people are thinking in a way where you can make these objective assessments about what the potential is for a particular stock or commodity or whatever to do what it's going to do. But at the same time, you always have in mind, what does the market have to do to tell me that whatever I think isn't working?
So you've got your basic objective criteria,
right.
And once you become more advanced, you can use the
right.
subjective mind
That's right.
to influence.
Right, but I would not suggest people get into subjective trading until they've got this mechanical part down pat.
Right.
Absolutely. Otherwise, they're just going to get really screwed up.
Yeah.
Absolutely. Okay, well, we have another caller on the line. It's Kevin in Florida, and this is your first time calling. Thanks for calling in, Kevin.
Hi, Susan. How are you? I'm watching Wise Trade. It's first time caller, so I'm a little bit nervous.
Oh, welcome.
I'd like to say hi to Jared and Mr. Douglas. The question I have is that, I've been trading since November of last year, paper trading, and then I went live trade in October. I was listening to Mark, and I've been reading his book, Disciplined Trader. The question I have for him, he said that don't think on your trades. The problem I've been having is that you seem like you have so much information, Wise Trade, and then I'm watching CNN on my TV. I have a laptop which I'm watching my trading company trading my stock,
right.
And it just seems like it's overwhelming. And he come out with just a simple thing, don't think when you trade, but you're getting all bombarded from Kramer on CNN, and you just don't know where to go.
Sometimes.
is there any way where you can just like settle your mind down to where you can just go to one area and take information? I don't know if you understood what I was.
No, I understand exactly what you're saying. You're right. It's overwhelming and it's completely unnecessary.
Wise Trade and Wise Trade TV?
No.
You know?
No, what I'm saying is that pick whatever edge you're going to trade and do not expose yourself to all the extraneous information surrounding it. It isn't necessary. The edge is either going to work or it's not. And if it's a good edge, it's going to work a higher percentage of time that it's not. And all the other information that you think that you need is not necessary. Yes. And when I say don't think, I'm not saying don't think about the risk. Don't think. In other words, I'm saying yes. Think about how much it's going to cost to find out that trade's going to work. Think about a profit, a way to take profits. But as far as the relationship about what you need to think about when that edge appears is that there's nothing to think about. There's nothing to consider. There's nothing to evaluate. There's nothing to analyze.
Some of the most successful, I'm going to chime in here, some of the most successful traders that I found were very, very simple and straightforward to the point. They had one tool, they acted on it, period,
That's right.
the end.
Right.
All the guys that aren't making money, I can tell you that I remember specifically, there was this one guy, I'm not going to mention any names, I'd walk into his office, he had Bloomberg, bar charts,
Right.
all these 15 million screens going on, he's analyzing, picking, I see him and all this. And the guy's driving around a 1982 Honda. This is 1998. He's got a 1982 Honda, and and what you drive doesn't mean anything about what kind of money you're making. But the guy just couldn't make a buck.
Right.
And he would commit all of his money towards these types of tools that cost thousands of dollars a month, and just couldn't make a decision because it was just an overload for him.
Well, and I know that a lot of people that are new to Wise Trade and watching Wise Trade TV, I mean, we talk, a little bit about, be aware if the stock you're about to trade has some news story on it that could affect if it's earnings or, some big drug announcement. But for the most part, keep it simple.
Yeah.
Can I interrupt you just for a second, Sue? Because what you're bringing up is really important. What you do is you take that news story and factor it into how much you're going to risk.
Right.
Factor it into where you set your stop. Exactly.
Very good. Yeah. Okay. We have another caller. It's Molly in California. Good morning, Molly.
Good morning,
Hi,
Susan,
Molly.
Jared, and Mark.
Good morning.
What question do you have for us?
Okay. Well, first I want to tell you thank you to Wise Trade TV for bringing Mark on the show because it's really helped me a lot. My question has to do with what he was first talking about. Are you there?
No, we're here.
Okay, sorry. I started looking at the TV. I'm so sorry. Okay, he was talking about what a pro sees. He said a pro sees his entry. If you could just go back over just what else the pro does. After he sees his entry, what does he do? I got the part where you said he has a money plan. But what else does he do?
He acts
immediately.
Yeah, really, it's pretty simple. When a professional trader, when his edge appears, he doesn't think about whether the edge is going to work or not. But what he does think about is how much is it going to cost him to find out if the trade's going to work. In other words, he assesses the risk, puts the appropriate stops in the market, and develops a plan for how he's going to take his profits if the trade goes in his favor. Does that help?
Sure. You're saying he actually goes in, puts his stops in place.
Not all pros put their stops in place, by the way. There are people, for example, I often don't put stops in the market. I just wait for the market to come to my price, and I just get out. I just don't have to put it, because I know I'm not going to violate that principle.
That's a personality
That's just well, that's me. In other words, I know there's no possible way I'm going to violate the issue. So sometimes I'll put a stop in the market, sometimes I won't. But oftentimes I don't. It doesn't matter. If I'm sitting at the screen, I won't bother doing it.
But you're the disciplined trader.
Well, yeah, absolutely.
So you can do that.
You really are like the disciplined trader.
Well, yeah.
I mean, literally.
Literally, yeah.
Okay, well, we have a good email from Bruce, and it says, wonderful show. I find myself making a few trades successfully, and then I have a larger losing trade. Sometimes it is caused by a sudden market move on the opening, which I am hoping that market will come down to my entry or even worse, where I had my original stop loss. This has been very disappointing over the years. My wife and friends think I'm the most intelligent investor, and yet I've never had a profitable year trading, and I've been trading and trying to learn how to be profitable for over 30 years. Please help, and yes, I'll do anything.
Yes, I'll do it. You know what? I'm gonna have to read that.
Okay.
I'm not sure if I followed all of it, so.
One of the tools, or one of the techniques that I recommend, if you've had a series of wins and taking losses, is to take your wins you've had in your paper trading account. Let's just say you're very consistent at making $1. And don't let your losers exceed the maximum that you've been winning. Go ahead, Mark.
Okay, first of all, to address this email, I find myself making a few trades successfully, and then I have a larger losing trade. Sometimes it's caused by sudden market move on the opening, which I'm hoping that the market will come down. Okay, now, first of all, there's something we didn't have time to address, and we really don't even have a lot of time to do it now, but I'm going to bring it up. And that's consistency just isn't a function of learning how to think in probabilities. In other words, it isn't learning, to train your mind to understand and believe that there's a random outcome to these consistent patterns. There's also other factors involved, and that's what I call self-sabotaging beliefs, where not everyone, we don't grow up with this unlimited capacity of self-valuation. In other words, how much money am I really worth, and what can end up happening is that there could be a self-valuation issue. So in other words, if we end up making money as trading, we might not feel we deserve the money for some reason, and then make a trading error, which in this case he's saying on the opening, which I then hope the market. Okay, he shouldn't be hoping anything. He should have his risk already predefined and in the market, and the market either conforms to the pattern or not. But the thing is that it isn't just a matter of self-valuation. There are a lot of things we learn when we grow up that are completely inconsistent with or in conflict with making money as a trader. And if we're not aware that these other mental components can come into play, in other words, like for an example, there are traders that I've worked with who have really strong religious beliefs that even though they might not consciously remember when they're in their middle ages, let's in their middle age, that they were taught that anything that even remotely looks like gambling is bad and evil, okay? Right. And here they're attracted to trading, and then they learned when they were kids that that's making money where you're not providing a service for somebody, okay? In other words, where you're not providing some sort of service.
A commodity,
yeah, exactly. Where trading is basically, you're going in the market and just making money based on your assessment to determine if the market is going to go up or down. That money isn't made legitimately, therefore not deserved, and so we are susceptible to making a trading error that gives it back. And so
subconsciously.
Subconsciously, right. So what we also have to do is we have to learn how to be consistent, learn how to identify when these kind of self-sabotaging beliefs are acting on our consciousness, causing us to compel us to make a trading error. Mm-hmm. And if we're not trading in a consistent manner in the first place, it's almost going to be impossible to recognize this. You see the connection here? It'd be impossible to recognize that it isn't my methodology that's causing me a problem anymore. It's the fact that I'm making these errors because I have these self-sabotaging beliefs.
Absolutely. Well, Mark, we just have a few more minutes, and I have to read this one email if you'll allow me. This is from Pip Pip Hooray, Carrie in Canada. And she says, good morning. I just had to send a note to say thank you very much to Mr. Douglas. I just finished trading in the zone last night, and I'm totally overwhelmed. I have learned so much. I am having difficulty putting into words how much I have gained from investing the time to truly study his book. I was challenged in many areas of my life. As Mr. Douglas shared his unique insight, it shined a light on several areas I was struggling with fear. This book has started a process that I sense will change my life. I am now excited about trying new things, letting go of discouragements, and switching negative energy to positive energy thoughts about the past experiences that were choking my ability to move forward. I know it will take me time to apply this to my trading, but I'm actually excited, not petrified. I want to encourage anyone who is considering purchasing the book or the training set. The amount of information, the life lessons, and the passion with which it is presented has the potential to bring on transformation. Mr. Douglas, thank you for offering a training that has brought about revelation in my life. God bless you. Thanks for doing this program today. We are so fortunate to you and WTV for providing this valuable training. Pip, pip, hooray.
Thank you very much for that email.
Yeah.
I would like to have a copy of that.
You may have this one.
Wow, thank you. That's very nice.
So, it is really powerful. And, Mark and Jared, you guys have been trading in the deepest of the trading pits, and you know how hard it can be to get your mindset right.
Thanks, Susan.
Thanks,
That's
Susan.
absolutely
Thank you very
great.
much.
Well, guys,
Thanks for having me.
Again, I know Mark has taught a lot of people the importance of putting their mind over the market. And, guys, that's all the time we have for today. But remember, you can get Mark's DVD training series, How to Think Like a Professional Trader, for the special low price of $895. That is $400 off the regular price. So call and order. Call 1-888-304-8881, extension 1, or go to wiseminds.com. And remember, the first 50 people to order will get an autographed copy of Mark's book, Trading in the Zone. For Mark Douglas and Jared Levy, I'm Susan Dufour. We wish you all the very best in your trading.
For 12 hours each trading day, Wise Trade TV is your ticket to finding great trading opportunities in all of the markets. Now, every Monday through Thursday, the last hour of Wise Trade TV is devoted to personal investor training. Welcome to Wise Trade University. We'll cover all types of topics from general market knowledge to the hottest trading strategies. Wise Trade University brings the classroom and our top market experts right to you. Tune in Monday through Thursday from 6 to 7 Eastern. Class is now in session.
What is a swing trade? People that you swing and you trade?
Sounds to me like somebody swinging on a swing set, trading stuff together. Something you swing on.
That's a tray hanging from a tree limb that you could set two kits on and swing them.
A swing trade is something you do on Wall Street.
Trading swings?
Like this kind of Wall Street or something.
Swing trade?
Well, it's like when we're plumbing and we put a joint in the air and we swing it around like our boss don't want us to. I imagine you jump from being a carpenter to being a plumber, to some other trade.
Swinging. Is it when you trade partners in swing dancing?
Swing trading has nothing to do with swing dancing or trading partners. It actually has to do with trading your stock issues for less time than you're used to. And indeed, you're only going to hang on to that thing for 3 or 4 days. That's it.
Of course I watch Wise Trade TV.
I love Wise Trade TV.
It's like a partner. It's like somebody who's there with you. They care about what you're doing on your trading.
It's my friend. It's my support. If you have a question and you're not sure about something, you can call in, you can email, and your question is answered.
It's exciting to be part of it, a live part of it.
You learn something every day.
If they're serious about wanting to trade, they need to watch the program.
Chat with Traders, episode 65.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
All right, what's up, traders? Aaron Fifield here, host of the Chat with Traders podcast. Thank you very much for tuning in to this week's episode. And for this episode, I interviewed Dr. Brett Steenbarger after many, many requests from listeners. Brett is a very well-known trading psychology coach and has consulted to some of the biggest names in the industry. He's also a respected author who has now published 4 books, some which have been recommended reading by previous guests on this podcast. During our conversation, I asked Brett how to break bad trading habits and introduce new best practices, to explain why traders need to be adaptable in markets, plus how we should think about goal setting and measure progress. And of course, much more about how to enhance your performance as a trader. Now, if you do enjoy the interview, please go ahead and leave an iTunes review. Like I've said in the past, it literally takes you 2 minutes. You can do it while you're listening, and it really helps to boost our rankings in iTunes and attract more listeners. So if you'd like to support the podcast, please go to chatwithtraders.com/iTunes. Okay, folks, let's skip to the interview. You're listening to the Chat with Traders podcast, and here is a very special guest for episode 65, Dr. Brett Steenbarger. Brett, many people have been asking for this, so I have to say straight off the bat, thanks a million for being here. I appreciate it, and I know listeners will also. How's your day been? What's going on?
The day's been good. Thank you very much, Aaron, and I appreciate the opportunity to be here and to share some ideas with the listeners.
Sure thing. The pleasure is mine. So, as most traders already know, you are the go-to guy for all things related to trading psychology. So, of course, that will be the ultimate focus for our chat today. But starting from the get-go, Brett, if you could, give us a little insight to your background. Like, how did you get into the psychology field, and where did you initially start out after getting your PhD?
Okay, yes, the initial impetus for my entering psychology was an unconventional one. I came to psychology via philosophy. As a sophomore in college, I was interested in psychology and indeed had declared psychology as my major, but I never really considered it a career field until I read a novel called The Fountainhead by Ayn Rand. And that novel illustrated something that I hadn't encountered before, and that is the vision of people as heroic, as reaching their ideals, their potential. And the thought came to me, it was during a winter break in my sophomore year, the thought came to me that this was a proper role for psychology to not just treat mental illness, but to expand the best of people's potentials. And that's what has interested me in psychology ever since. And what I do now in working with traders and portfolio managers, and earlier, before that, working with medical students and residents in the medical field, it really has been working with healthy people, people who are bright and creative and energetic, and helping them make the most out of what they do.
Okay, great answer, and very interesting to get your backstory there. So where did the interest in trading come from? Like, when did that creep into the picture?
You know, the trading thing is something that I first expressed an interest in a project when I was in grade school, and later became more interested in a formal way during my graduate school education at the University of Kansas. And I actually opened a trading account and began trading individual stocks. And that was in the late 1970s. But that was completely separate from my interest in psychology. My degree was in clinical psychology, and my interest was in becoming a psychologist. The trading was a side interest, a challenge, and something I found stimulating and interesting. And those two proceeded in parallel for a number of years. I pursued trading as an avocation, and I pursued psychology as my vocation. And it wasn't until around the year 2000 that I seriously contemplated putting the two of them together and began writing a book. It was my first book in the area called The Psychology of Trading, which was later published by Wiley. And that was encouraged by my good friend and mentor, Victor Niederhofer. So that's how the two came together. But up to that point, for a number of years, they were completely parallel interests. The book became popular, and was discovered by a trading firm in Chicago. And they began asking me to work with their traders and then made me a full-time offer. So I left the academic setting that I was in. I was teaching at that time in a medical school in Syracuse and also running a counseling program, and went full-time to working with traders in Chicago. And that's when the psychology and the trading interest truly came together.
Okay, excellent. So let's talk a little bit about your time in Chicago. Like, what were you doing? Like, how were you actually helping these traders with the mental aspect, the psychology, and everything that goes on that side of the field?
Well, in Chicago, I was working primarily with market makers in electronic futures. These were people placing dozens, if not more, trades per day. So trading on a very short time frame. The average holding period for many of the traders was around 3 minutes. So they are very actively engaged in markets. And it fascinated me because they were trading in ways that were completely different from what I had read in the textbooks. The books on trading talked about technical analysis, fundamental analysis, and these traders who I was encountering in Chicago did none of it. Obviously, they did no fundamental analysis because the fundamentals don't change in 3 minutes. But technical analysis in terms of chart patterns and indicator readings, those were much too slow for these traders. These traders were entering positions and exiting positions very quickly, and they were working off a depth of market screen. They were working off the order flow, not backward-looking technical information. So that was an education in itself and sensitized me to the psychological challenges that they faced in making decisions so rapidly. It was easy for them to become frustrated, to become overconfident, and for all of those emotional factors to slant their decision making. And so my work as a trading coach was to help them keep a level head, keep focused, and make good decisions in real time. And the fact that I was full-time working with them, and so on site watching them trade and standing with them and helping them really helped the psychology become part of the trading.
Right. Yeah, that's very interesting, Brett. And we're going to dig deeper into that in just a moment. A question I have for you is, like, over the years, you've been in the field for a long time now. You've worked with many, top traders, like some very, very hard-hitting heavyweight traders, asset managers, fund managers, they're a pretty broad spectrum of market participants. Now, these aren't all guys who are struggling. Some of these guys are extremely profitable and make huge amounts of money. Why do they come to you for your help on the psychology side?
It's a great question, Aaron, and it's the same reason that successful professional athletes work with coaches as well. At that point, they're not struggling. They would have never gotten to that point for in a large majority of cases if they were marginal participants. So these are people with real experience, real strengths. But what happens is that markets are always changing. And even the most talented participants have to evolve with the markets. And that need to evolve itself brings its own psychological challenges. The need to be creative, the need to be resilient in the face of frustrations, and also the need to identify and build upon strengths. So many times, the portfolio managers are seeking me out when they are doing very well because they want to stay grounded in their strengths. They want to make sure they understand what they're doing well so that they can be more consistent going forward in making use of those strengths. And so that's the difference with working with someone who is struggling and wants to work on their weaknesses or vulnerabilities.
Okay, that's a great answer, and it makes total sense. I really like how you explained that. So, Brett, let's bring this up to speed now. What are you doing today? Like, what's your work involve, in current times?
Well, I work with several hedge funds and other financial firms. So I'm not full-time at any one place. I consult with a variety of funds. And what that's done is expose me to a variety of trading strategies. Some of those strategies are discretionary. Some are more systematic. Some of the strategies are more directional. Some are more based on relative value movement. Some are in macro markets, the big liquid markets, and some of them are very specialized in individual markets, such as commodity markets or rates markets. So I've been exposed to a variety of trading strategies and trading settings. And it's been a great, great, great education as a result. But in all cases, my main work is to help the traders, the money managers, with their performance, help them build on their strengths and help them learn from their mistakes so that they keep improving. A secondary focus has been at most of the places where I've worked, we've conducted internal research about what makes traders successful. And so I've been able to help the trading firms with their hiring processes and help them make better decisions about who to bring on board. So that's been a separate kind of work, but a very fulfilling area as well.
Sure. Okay. Now that's really cool. Now that we're caught up on your background, let's really hone in on the subject of trader psychology. So one of the things many traders will admit and are well aware of is that they take profits too soon and they cut losses too late. That's mostly due to psychological reasons, I'd imagine. What advice would you give to those traders in that situation?
Well, it's a good question, Aaron. And as Ayn Rand would say, I would encourage you and listeners to check your premises with respect to the question, because I think that it can be a psychological issue, but is not always a psychological issue. I mentioned that markets are always changing, and one of the ways that they change is in their volatility. And so the market, as we are talking right now, the market is trading with a VIX of, which is implied volatility, of 14 and change. It wasn't so long ago that we were seeing VIX readings well into the 20s. So markets were moving much more a few weeks ago than they are currently. What happens is that traders don't adapt to that, either in their trading or emotionally, and so they're likely to take profits too quickly or likely to allow things to move against them because they are operating from an old regime, from an old set of assumptions that don't apply to the current market. So a good example, when volatility comes down, traders will start to make some money, and then when they try to let the position go, it eventually just reverses against them because the volatility isn't there, and you get much more mean reversion on a short time frame, and so they end up scratching the trade. Whereas in a higher volatility regime, that might have been profitable. So sometimes a problem that trader might have is logical, not psychological. It's a function of not adapting to markets. It's a function of not trading well. But you're right. There are other times where traders respond emotionally to making money, losing money. And as we know from the behavioral finance research, people are much more sensitive to losing money than they are making money. And so they're likely to be threatened by losses and not want to take those. They're likely to be afraid of losing whatever they gain and exiting trades early and so forth. So a huge issue in trading psychology is identifying when is a trading problem a logical problem, a problem with one's trading methods, and when is it the result of a psychological problem, the result of being in a wrong mindset that biases your information processing.
Okay, that's an awesome answer. that was really, really good. So, I mean, I guess that is an example of a lack of adaptability, and in some cases, possibly even a bad habit. But in general, when we recognize bad habits in our trading, what's the best way to break these habits?
The first step in breaking any habit, whether it's a trading habit or a personal habit, is to become exquisitely aware of its presence. So we want to become mindful. We want to be self-aware. We want to realize that a habit pattern is playing out as it is starting. So let's say my habit pattern is overeating. The first step in change is to recognize when I'm starting to feel a craving for food or when I'm starting to reach for the refrigerator. If I can't identify it at the time it's happening, how can I possibly control it? So building awareness and self-awareness is the first step in the change process. Then, once you have that self-awareness, once you can become an observer to your habit patterns, rather than someone who is caught up in those patterns, then you want to make a conscious effort to rechannel yourself. So let's say, for argument's sake, I have this habit of overeating, and I tend to overeat most when I'm bored. So I catch myself reaching for the refrigerator, and then I calm myself down, I focus myself, and I purposely engage in an activity that I will find engaging, that will absorb my energy. Maybe it will be some physical exercise. Maybe I'll go play with one of my 4 cats. But the idea is I would address the boredom so that I no longer feel the need to compensate with food. The same principle is relevant with trading. So my habit with trading might be to place trades out of frustration after I've taken a loss. Revenge trading. And so that comes from frustration. I have a losing trade, I'm frustrated, and I want to make that money back. So I want to become self-aware about that frustration. I want to catch myself being frustrated and rechannel that emotion. So stepping away from the screen temporarily, calming myself down, and doing something that is gratifying, that's fulfilling, to counteract the frustration will help put me in the right state of mind so that I can go back to the screen and make good decisions.
Okay, sure. And I like how you mentioned earlier in that answer about more being an observer to your bad habits than getting caught up in the middle of it. I think that was a really cool concept.
Yeah, the important one that shows up actually in Eastern philosophy as well as in the psychology research, that we can't change something if we're not aware of it. If the pattern controls us, if the habit controls us, then we're passive. We have no say in what happens. So the first element of control is being able to step apart from the habit pattern, whether it's a habit of drinking, a habit in trading, a habit in our relationships. We stand apart from it and we recognize that this is causing us pain, this is causing us losses, and then we're able to try and do something differently.
Right. Okay. Now, the intro to Trading Psychology 2.0, you mentioned that all the traders you've worked with varied greatly in how they actually traded, yet they had many commonalities in how they did what they did. So here you were, of course, referring to process and habits. Could you elaborate on these observations for us?
Yes, absolutely. Obviously, the traders I work with have very different strategies. Some are more short-term, some are more long-term. Some are long-short investors building very large portfolios among individual stocks. Some of them are trading macro assets globally and trading macroeconomic themes. So they're very, very different in their approach to markets and in their trading styles. But at a process level, there's some real similarity. And that's what I talk about in the Trading Psychology 2.0 book with those basic A, B, C, D themes. A being adapting to markets, B being building on strengths, C being cultivating creativity, and D being developing best practices. And so what the really successful traders are doing is studying themselves and figuring out what works, what they're good at, and where their vulnerabilities lie, where their weaknesses lie. And they do more of what works. They act in ways that make them more of who they actually are. And they may be different strengths in different markets, but all of them study themselves just as they study markets and stay grounded in what makes them successful.
Okay, so the A, B, C, D that you mentioned there, could you just walk us through each one of those in a little more detail, just so we can understand, get a better grasp of each point?
Yeah, absolutely. Yeah, so A, is adapting to changing markets. And this, as I point out in the book, is no different than it would be for any entrepreneur. You start a business and your marketplace is always changing. And so at one point in time, if you're starting a restaurant, your marketplace may have one set of tastes, and then something else will become popular. And so you have to adapt by changing your menu, by changing your decor, by changing how you deliver service. Successful businesses never stay static. We see this in the technology industry. New smartphones are coming out with regularity because the marketplace demands new features and functionality. So we're always having to adapt. Markets change in their trend. Markets change in their volatility, as I mentioned. Markets change in their patterns of participation. The people who dominate markets now are not the people who dominated 10 years ago or 20 years ago. And so we see different patterns in markets. To assume that markets are static and that our edge will last forever does not work any better in financial markets than it does in the business world. A great way to go out of business in the business world is to assume that what you're doing well will last forever and you never have to change. That's how to become a dinosaur. That's how to become obsolete. And that happens in financial markets as well. So the successful traders are always studying markets and always studying how markets are changing. And the interesting part, Aaron, is that many times our mistakes in trading, our losses, our setbacks, our drawdowns tell us about changing markets. Because we do what we did do when we were making money, and suddenly it's not making money for us. And if we're reasonably disciplined in doing what we had been doing when we made money, then we have to ask ourselves, well, how come it's not working anymore? What has changed? And that helps us go back to the market, learn from our mistakes, and adapt. So we're using our drawdowns, we're using our losses as real information that helps us adapt to markets that have changed their correlation patterns or their trend patterns and so forth. So that's adapt. That's the A part, adapting to changing markets. The B part is building on strengths, and I alluded to this earlier. What I found in my research with successful traders and portfolio managers is that all of them have different strengths, but all of them have at least one distinctive strength. And it could be a personality strength, it could be a cognitive strength, but the really successful traders are really strong in some areas. As a rule, the higher frequency traders, the day traders, are very good at fast thinking skills. They see things broadly. They see many things across different stocks or markets, and they process real-time information across a wide area very quickly so that they can make quick decisions. The traders I worked with in Chicago were very much like that. They were great at pattern recognition. On the other hand, traders with a longer time horizon behave more like investors. They're slower thinkers, but deeper thinkers. They're more analytical. And so they are going into depth in different areas and finding out information that other people just aren't looking at. And so that becomes their strength and helps them, let's say, find an undervalued company that they can invest in over a longer time horizon. So we all have strengths, and the really distinctive traders, the traders who make distinctive returns, have distinctive strengths. And so the success is based on making the most of your strengths, not just correcting your weak areas. The C stands for cultivating creativity. And that's a topic that I have found tremendously neglected in the trading psychology research and writing. Creativity is all about seeing the world through fresh eyes. If we trade the same way that everyone trades, we're going to get the same returns that everyone gets. We have to see some fresh opportunity. We have to see the world differently from others if we're going to achieve distinctive results. Again, it's like the entrepreneur. The entrepreneur sees an opportunity that others don't see and is able to build a business based on that perception of opportunity. The successful traders that I work with have very distinctive strategies. I've been involved, as I mentioned, in hiring traders and successful traders at different firms. And I always know who has the potential to be a successful trader because we talk about their strategy. And when I hear the strategy, it hits me upside the head. It smacks me in the face. And I say, wow, why didn't I think of that? It's something unique. It's something different. If what they tell me is something I could have read in any of a dozen books, I know that that's not a distinctive skill set. So cultivating creativity is essential for success. And of course, creativity is a big part of what helps us adapt to changing markets. And finally, the fourth topic is developing best practices and turning best practices into best processes. So when we look at best practices, we want to look at them in every facet of trading. How we generate our trade ideas, how we manage our positions and how we manage our risk, how we review our results and learn from those. All of these are separate elements of a trading process. And we want to identify our best practices in each area. Our best practices in generating ideas, our best practices in managing positions, our best practices in managing risk and reward, our best practices in managing ourselves as performers, and we weave those together, those best practices, into best processes. And the successful traders I work with are always working on themselves and improving their processes over time.
That's awesome, Brett, and very, very insightful. Thanks a lot for taking the time to flesh that out for us. And obviously, if guys want to learn more about that, definitely check out your book, Trading Psychology 2.0. I'll link to that in the show notes. at chatwithtraders.com. And just a couple questions to bounce off your answer there. Firstly, one about habits. Earlier we covered bad habits, how to break bad habits. What's the best way to form new habits and implement those, introduce new habits?
Yes, and you're absolutely right. We want to develop best practices by turning those into habit patterns. So often we hear that traders need to motivate themselves. And, they'll do various things with imagery. They'll do various things like have sticky notes on their computer screen to motivate them to do the right thing. But in fact, motivating ourselves is not the best source of influencing behavior, the best method for influencing behavior. If you look at the things we do consistently in life, it's not things we do through motivation, it's things we do through habit. So I don't have to motivate myself to eat breakfast, take a shower in the morning. I don't have to motivate myself to do the right things for the people I work with as a psychologist, because that is part of me and part of my routine. And so we want to take our best practices, our trading practices that work well, and repeat them with fidelity, repeat them in a routine way so that time and time again, with repetition, they start to become habit patterns. So repetition is really the source of developing positive habits. Once we identify a best practice, once we identify something that works for us, we want to be very conscious about employing that day after day after day after day. Tony Robbins, the well-known motivational speaker, makes the case that if we repeat something for 30 consecutive days in a reliable way, it eventually becomes part of us. And I think there's some truth to that by doing things again and again, they start to feel familiar and they start to become part of us.
Mm-hmm. Very, very great points there, Brett. Thank you very much. Now, you also mentioned weaknesses. So, every single one of us, we have our own weaknesses. How should we treat our weaknesses? I mean, some people with this school of thought that you should just focus on your strong points and really drill down on those. Others say you should, improve on your weaknesses. How do you feel on this subject?
Yeah, no, it's a great question. And, our strong areas, our strengths are there because those are competencies we've built over time, and they're also talents that we've been born with. And so we want to make the most of those. And, when you see people who have been distinctively successful, there are people who have really made the most of their competencies. With the weaknesses, it's rare that you could ever turn a weakness into a strength. But we can work around our weaknesses. So there are some kinds of trading that I personally am not good at. In fact, the trading that we were talking about in Chicago, very high frequency trading, making rapid decisions. I don't have the same kind of fast information processing skills that the very successful traders in Chicago had. And if I try to do that, I quickly hit a point of saturation, both cognitively and emotionally. And so that's not a strength of mine. So I want to avoid having to make rapid decisions and process lots of information in a short amount of time. So in my own trading, I will trade short term, but those tend to be intraday swings, or maybe swings from one day to the next, where I have enough time to process relevant information and not get overloaded. So by altering my time frame of holding positions, I'm able to dodge or avoid some of my weaker areas and play to some of my strengths, some of which are more research oriented.
Okay, so this might be, just to continue on this tangent here, this might be a little bit of a strange question, but how do you know that was a weakness of yours, that you wouldn't actually be able to trade like the guys you worked with in Chicago? Because, I mean, all of us, even those who could process information very rapidly, even on day one, we would still struggle in, for the first few months, maybe for the first few years. Even guys who could process information very quickly might still struggle in the beginning. How do you know when it's a weakness of yours and just not a skill that you're yet to develop?
Great question. It wasn't simply that I tried it initially and didn't make money from it. It's that I rapidly hit a point of cognitive overload. And in fact, that had happened to me in other areas of my life apart from trading. If I was in a situation where I had to process too much information at one time and make rapid decisions, I often would not make my best decisions. So let's say, for argument's sake, that I was in a situation in a relationship and there was some disagreement or some issue in the relationship. If I tried to deal with that right then and right there, often I was not as effective as if I took a step back, really thought about what was going on, really reflected upon myself, and then responded in the way that I felt and knew was best. And that typically wasn't a huge amount of time, but it wasn't spur of the moment either. So I had recognized in myself that I do well when I'm able to reflect. And the pattern recognition that the people were doing in Chicago was relatively instantaneous and really a remarkable skill. I admire people who can do that. And when I try to do anything similar, I just hit a point of cognitive overload. And that's how I know that I'm just not wired that way. I don't operate that way in any area of my life. And when I'm pushed to process information that way, it's unpleasant. Whereas when we act on our strengths, there's an intrinsic pleasure to that because we're doing what we're really good at. It feels fulfilling to us. So some kinds of analysis I really enjoy doing. I look at markets in a rather quantitative way, and being able to solve the puzzle, so to speak, and see quantitative patterns in markets is very gratifying for me, very fulfilling. And then being able to trade based on those and see them work out, that's very fulfilling and gratifying to me. So when we act on our strengths, we feel strong, we feel good, we feel fulfilled. And when we act counter to our strengths, it's intrinsically frustrating. And that's a big part of how we can know.
Right. Okay. I like how you mentioned there that you pull on, your strengths and weaknesses, and you find those in other areas of your life. And the crossover to trading is all very relevant. So no, excellent point.
Yeah. Let me just add another point that I've mentioned in my writings. I have never traded full time in my career. And a couple of times I tried to do it. I tried to trade full time. And I actually was making money. And I hated it. I absolutely hated the experience of trading full time. Why? Because one of my strengths is working with people. And one of the things that drew me to psychology was the opportunity to be a meaningful part of people's lives. And so trading full time wasn't playing to one of my greatest strengths and became frustrating. So we have to know ourselves, and often it's our feelings of happiness and fulfillment that tell us whether we're playing to our strengths or not.
Okay. Yeah, that's really interesting, Brett, again. Now, something I'm curious about, when you're working with other traders and you're implementing techniques to get them closer to peak performance, do any of the techniques that you work on operate on a subconscious level to provoke change?
It depends on what you mean by that. When you say subconscious, any technique that, as you were saying, develops a habit pattern is making that pattern automatic and therefore out of consciousness. And so using techniques, let's say like guided imagery. Let's say a trader is afraid to lose money. And we will do some guided imagery to have them mentally rehearse scenarios in which they hit their stop levels. And they keep themselves calm and they keep themselves focused while they're going through this guided imagery. And they do that again and again and again and again. And pretty soon, the feeling of hitting your stop and getting stopped out is something that becomes familiar to them, not threatening to them, and they're able to keep themselves calm and controlled. And so it is, in a sense, reprogramming their emotional responses to a situation they had experienced as threatening. And that is happening at an emotional level. And so you could say that it's subconscious.
Okay, sure.
But what you're really trying to do, in a sense, is rewire a person. You're trying to reprogram their responses to certain situations.
Right. Now, Brett, one of the things I'd like to ask you more about is goal setting. I think your advice on this topic would be really valuable. So how do you suggest developing traders best go about setting goals for themselves?
Yeah, there's actually research, and I've written on this on the Trader Feed blog. There's research on effective goal setting. What happens a lot of times is that people set a goal, but they don't follow up the goal with a specific plan. And so if I have a goal, let's say my goal is to lose weight. Well, that's only going to work if it's part of a day-to-day plan. And that's only going to work if it's meal by meal. I have to eat less calories. I have to do more exercise. And that's day in, day out. And so the goal is the big picture, but what makes it happen, what makes it effective, is the day-to-day implementation of a plan. And what traders often miss is they'll set a goal for themselves to make a certain amount of money or to avoid losing a certain amount of money or to trade a certain way, but they don't drill down so that the goal is something they are concretely working on each day in each trade. So we want to be effective in goal setting by being very planned and very consistent in working those plans. A goal without a plan is a wish. If you have a goal and you don't have a specific plan, that's just a good intention. That's a wish. And it's nice, but it's like New Year's resolutions. For the most part, they're not going to happen unless we have a concrete plan to actualize them.
Okay, so you brought up an interesting point there in your answer about traders wanting to make a certain amount of money. What's your take on goals that have a monetary value attached to them?
I'm not a fan. One of the problems that affects traders and affects people in all performance fields is something called performance anxiety. And performance anxiety arises when we become so concerned about the outcome of the performance that it starts to interfere with the process of performing. And so if I'm a public speaker and I become very worried about how my audience is going to think of me and whether they're going to be interested in my topic, well, pretty soon I'll forget what I'm speaking about. So by putting the profit and loss, the P&L, front and center in our goals, we're emphasizing outcomes, and that can put pressure on us and interfere with processes. Sometimes markets offer more opportunity than others, and to have a fixed P&L goal doesn't really take that into account. What I would rather do as an outcome-related goal is look at improvement. So, am I improving from month to month, year to year in my trading performance? And I would look not only at P&L in absolute terms, but I would look at it the way that hedge funds look at it and the way most financial professionals look at it in terms of risk-adjusted returns. How much money am I making per unit of risk that I'm taking? And try to improve not only in my absolute returns, but in my Sharpe ratio or in my risk-adjusted returns. And that, I think, is meaningful.
Okay, good point. Now, just continuing on this path, how do you think traders should think about failure or loss? Because I know that some people are genuinely afraid to fail. So in your work, do you ever try to get traders to reframe negative thought patterns or anything similar to this?
Yes, and I think an important part of trading is it's funny, making friends with loss, and in a sense, making friends with failure. That it's, as I mentioned earlier, it's often our losing trades that teach us about how markets have changed. Look at it this way. If we follow a best practice and we are relatively diligent, if we're relatively consistent in our trading, and we follow our best practice, and then we start losing money, well, something has changed in the market. We're doing the same thing, but something has changed in the market. We want to use those losses as a prod, as a stimulus to learn about what has changed in markets so that we can adapt. Our losses are information. They're telling us something. If I'm running a store, let's say I own a department store, and I normally sell 500 pair of blue jeans in a week. And now suddenly I'm selling 150 in a week. And that happens in week 1, that happens in week 2, that happens in week 3. And pretty soon I say to myself, what the heck? Why aren't people buying blue jeans? And sure enough, I go to the fashion magazines and people are into something else. And I realize I have to adapt. I have to change my inventory as a retailer. That's how business works. That's how trading works. Our losses, our mistakes are there for a reason. They are there to teach us something. And if we embrace them, if we don't push them away, we can learn from our mistakes. It makes us stronger. It makes us more adaptable. So yes, it's frustrating. Yes, it sets us back temporarily. But ultimately, that's how we become better, by learning from our mistakes.
Absolutely. Now, Brett, I'd like to ask you about the actual subject of money. So let me ask you this. When you're coaching and working with traders, do you try to change how they think about and how they view money? Because straight away, by default, many people have a tight psychological attachment to money. So how do you treat this?
Gosh, it's a great question. And the answer, I don't know, maybe it'll surprise people. No one ever thinks about money where I work. The minimum portfolio size for a regular trader at one of the funds where I work is $200 million. But no one thinks about money. You think in percentages and basis points. And so whenever you ask someone, how much did you make or lose today or this week or this month, they'll always say, I made 50 basis points. I made 1%. So they're not thinking in dollar terms. And that's very, very helpful. Because if you start to think of it in dollar terms, it'll drive you crazy. That if you have a $200 million portfolio and you lose 1%, you've just lost $2 million. But by putting it in basis points, then when you grow your capital, a 30 basis point loss is the same when you're trading a smaller book as when you're trading a larger one. And so that's a big part of how professional traders get around thinking about money. They think in those percentage terms.
That's a really great pointer there, Brett. Many of us often feel, many developing traders often feel a great amount of pressure to succeed and become great traders. How do you feel about pressure? I mean, is it a good thing to place, sometimes quite a lot of pressure on yourself to succeed, or can it have negative effects?
Oh, it definitely can have negative effects, and it's hard to take risk, when you feel under the gun. It's hard to make good decisions under conditions of pressure. So I absolutely think that is a challenge associated with trading. One of the things I've commonly told traders, and I've written about, is that for me, a element of success in trading is making sure that you have something in your life more important to you than trading. Because if you have something in your life that's more important to you than markets, than trading, than profits, then during periods of drawdown, you'll always have something to turn to renew you and inspire you and keep you positive. Sometimes I hear traders say to me, I have a passion for trading, and trading is the most important thing to me, and I work on it, 14 hours a day. And, that's being vulnerable. Trading should not be the only part or the major part in your life, because then you'll have nothing to balance yourself and to balance the pressures during inevitable drawdowns. So I think living a balanced life, having sources of happiness and fulfillment and energy and closeness to people apart from markets, very, very important to trading success.
Right. Well, this leads into an interesting topic. So from what you've observed, what factors have the greatest contribution to a trader's satisfaction and sense of accomplishment?
What contributes to satisfaction and accomplishment?
Like, do they get excited about making huge profits in, a month, or do they find satisfaction in other areas of their business? I don't know. Is that an appropriate question?
It's a great question, and I'm pausing to reflect, which is what I mentioned I do, and why I don't process information super quickly, because I like to reflect. And I'm thinking about specific traders, and I'm thinking about my work with them. And, and if I look, and I certainly know traders who get a lot of excitement and satisfaction from making money in markets, and I certainly find that to be gratifying. But the ones who have longevity in the business, who have been at this for a while, have some source of satisfaction in trading that is separate from their profitability. In other words, it's not that they find fulfillment in trading, they find fulfillment in markets. And I think that's an important distinction. That if you find your fulfillment in markets and learning about markets and learning new strategies and trying new things, then you can find gratification. You find your intellectual curiosity is gratified, your sense of puzzle solving and challenges are satisfied, even during those periods of drawdown. If your only source of gratification and fulfillment comes from the profitability, then psychologically you're barren, so to speak. You're bereft. You don't have anything to sustain you during those periods of drawdown. So I think it's important to have sources of fulfillment in trading that are separate from profitability, even though profitability is obviously one of the important drivers of our satisfaction.
Okay, I like it. Really, really good answer there, Brett, and an awesome one to take us out. So let's wind things down now. Where can listeners go to find out more about you?
Well, the easiest way would be through the two blogs that I write. One is Trader Feed. The address is Trader Feed, all one word, TraderFeed.blogspot.com. And the second is the blogs that I write for Forbes online. And if you go to the Forbes online site and type it by name, you'll see a lot of articles pertaining to positive psychology and financial markets. So those are two ways that are free and that you'll find more information than you care to know. And obviously, I've written 4 books in the area of trading psychology, and those go more into depth into the topics that we're discussing today.
For sure. And you're also on Twitter, I know. So what's your Twitter handle?
Oh, yeah. So Steenbab, Steenbab, is my Twitter handle. And so I try to post at least once a day.
Excellent. Now, like you mentioned, you've got several books out, the most recent one being Trading Psychology 2.0, which came out towards the end of last year. I'll be sure to include all the links that Brett has mentioned just now at chatwithtraders.com, including a link to his book and some of his prior books. Is there anything that really separates your most recent book from your previous material?
Yeah, that's why I called it the Trading Psychology 2.0, because I really wanted to touch upon themes that were not traditional in the writings on trading psychology. So there are many topics related to positive psychology and building on strengths. There are many topics related to building creativity and well-being that typically we don't hear about when we read books on trading psychology. A lot of the traditional trading psychology dealt with controlling your emotions, being disciplined, and all of those are great. I would say those are necessary, but not sufficient. In the Trading Psychology 2.0 book, I tried to go beyond those traditional themes.
Good one. Okay. All right, guys. We'll check that out at chatwithtraders.com. Brett, thank you so much for doing this. I really appreciate you taking the time out of your day. I hope listeners get a lot of value from this, and I have no doubt that they will. So, again, thank you.
Well, thank you for having me. I appreciate the opportunity.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Good morning, traders. Thank you for joining us on this WTV special on putting your mind over the market. I'm Jared Levy, Chief Options Strategist here on Wise Trade TV, and using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, you know, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, you know, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy. Right. Or because it's easy to find yourself in a winning trade, exactly. Which many people do.
Right.
That they think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are two completely different animals, two different things. And in some ways, there isn't even a relationship between the two.
It almost seems like there's no relationship between the two.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that the being able to click a mouse button or tap a pad is a skill, right. And we don't have to have a reason or good reason or actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're going to get into that, but at the most general level, I'm going to say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's not
see that all the
out of the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method,
right.
And not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now. Trying to stay focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
Well, you're doing fantastic.
Anyway, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know, that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about when we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, a result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis, and not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, you know, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he will undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
You know, and I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because, you know, they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique.
Right.
They have to be able to view that as random and unique. You know, that's I think the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. and that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner, right. This trade, even if the charts are the same, right. Even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner, and does that mean that the next trade's going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser, and does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to... For us up here, you know, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, you know, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, you know, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learned how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of, you know, the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, you know, okay, so I've got all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or you know, how do they begin to remedy these issues?
Well, we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this is because their initial exposure to the markets themselves is through electronics. Right. In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing, you know, you to want to participate in the first place. In other words, you know, markets started as exchanges, and there were, and so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way.
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay?
Right.
So now I get exposed to a technical method. Now what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human behavior, the human belief in if I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, correct, or it's going to go to 12. Right. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, you know, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are traders, there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is this, is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Right. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? Is this the first step for them getting control and understanding how the markets work and getting
they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any number. Fresh cross. Yeah, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. Right. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money.
Using all of your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software, to find those common entries. But again, it's a random event. But we're putting the edge, you said, in our favor.
Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done is we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads heads to tails.
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which flips are going to
heads.
Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, which, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails. The next one's tails. The next one's tails. In other words, we could have streaks of heads or tails. Okay, we could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have 70%.
So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, this makes a whole lot of sense to me, and I hope it's getting through to you guys. We have a tool that gives us an edge, whatever it is. Right. Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as so maybe 55 or 56% of the time. Right. Let's just say.
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make, at the most at one point, I think around 1987 or 1988, he had $400 million.
Is that using his edge? Or his money management, or a combination of both?
A combination of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things, I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows, he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay. Right. But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan. Or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think when
it's going to be a winner.
It's going to go on forever.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk.
Right.
Exactly. Now, does he put a cap on the upside? Does he put a cap on his win side?
Well, it's not a matter of a cap. It's a matter of how, his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk to reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time. As I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV. Welcome back to the WTV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads. Right. Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern. Right. You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information. Right. So, for an example, if I'm in a losing trade, and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case. Right. It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right. I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks that I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to?
Yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13, and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good.
Right.
And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. That you know, my reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, you know, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you
by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
Whatever reason you don't like it, doesn matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do people betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's a
random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly, because the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play.
Right.
So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in the machine.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? And then what we do is we wait for a pattern to show up. And if the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market.
First.
The pattern shows up first. Okay? Then what we have to do is put up our money. Meaning, how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning.
Right.
How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it. But they haven't really accepted the risk.
We see that every day. Every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which is another problem on itself.
Oh, yeah. But see, the thing is, it's like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong, and so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
And how does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise they can do?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just like anything else in our lives. When we realize that there's a particular goal that we have, and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay? And that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
What's that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate that potential is by understanding that trading is not about being right or wrong. It's a probability game.
Right.
If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do evolve.
We got an hour and a half, by the way. Keep going.
We do? Oh, okay. Well, yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right.
On.
And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some other traders didn't come into the market that had the same belief that you had or the same conviction that you had about this market doing whatever it is that you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? In someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter, okay?
Exactly.
They find themselves doing things that, what am I doing this for, And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade-by-trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology, at the very most fundamental level, what this is telling me is that
fresh cross.
There's a higher there's a high, or let's say the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now, they're either going to come or they're not. And so, as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out. It's not worth the cost of finding out. That's all it means.
Do you talk about stop losses You talk about stop losses and management in your DVD.
Yeah, absolutely, but not like very specific. Not the kind of specifics that like if you're in a half an hour time frame, how much.
Well, that's the trader's decision.
Yeah,
but the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to the risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely. Yeah, absolutely. I mean, and that's what I suggest to people, all the time. Especially, when I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and they'd get into a situation where they're on a pretty good losing streak, and often it required that they actually go back to a risk level that they hadn't. Meaning that if they were trading 10,000 or 100,000 shares, or willing to take $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that I mean, look at it this way: paper trading. Okay, a lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology, but more so, it is a graphic representation of the mental skills that you don't have. That's
an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills?
Look at your paper trading.
Yeah, look at your paper trading in relationship to your real trading. Yeah. Now, if there's, and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss.
Right.
Because the way our minds think, in other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendencies to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares, and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly, based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. And that's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at WiseFest and earlier we talked about some events of pain, pain in your life. And a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there, does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication actually? And I'm not trying to be rhetorical here. I really want a serious answer because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You aren't in pain right now, are you, Jared?
What's that? Yeah. I'm good. I've been out of the market all week.
I'm just kidding. Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring to?
Explain the gutter principle.
The gutter principle, in other words, how much in the gutter do you have to be before you're willing to say, I'll do anything? As a matter of fact, this kind of brings something up. Is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine tuning. Okay, they wanted creative ways of fine tuning themselves so that they could actually increase the amount of money that they make over a year, whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated, they're so frustrated because of the potential that it's so obvious what the potential is, and yet there seems to be these invisible barriers that keep them from getting into that potential. That they come to me saying, "I'll do anything." And that's, now everyone has different tolerances of pain before they get to the point where they say, "I'll do anything," and mean it, and be sincere,
and mean it. Well,
that's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up this show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders or any final thoughts, maybe a mantra, something?
No, just basically, just to kind of, sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profits. But I'm saying the pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the objective part about trading.
You can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said, so we've got plenty more time to go. One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10. How do you define edge as a closing thought?
Just simply, an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, like for example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back in a couple minutes. Guys, it is time for a break. We want you to get your questions in for Mark. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can send us an email to trader@wisetradetv.com. When we come back, we will answer your questions and talk more about psychology in today's markets. We'll see you back here in 5 minutes.
This is kind of maybe a long drawn-out introduction to the fact that what we're talking about here is that you guys have a really wonderful trading methodology where there is an enormous amount of potential for you to be able to make a consistent income from being able to take full advantage of the potential that this trading methodology offers you. But I would say that there's probably, it wouldn't be unfair for me to say that there's probably what I'm going to call the profit gap. The gap between the potential and your bottom line results. This is the potential, and this is your bottom line results. Most people think that when they realize that this gap exists, that somehow learning more about the markets is what's going to fill it. And what you're here today to learn is that that is categorically not the case. You have to learn more about yourself and how you interact with your trading platform and the market to be able to fill this gap. There are psychological skills involved.
The rare exceptions are usually those who were born into successful trading families or who started their trading careers under the guidance of someone who understood the true nature of trading and, just as important, knew how to teach it. Why are emotional pain and financial disaster common among traders? The simple answer is that most of us weren't fortunate enough to start our trading careers with the proper guidance. However, the reasons go much deeper than this. I have spent the last 17 years dissecting the psychological dynamics behind trading so that I could develop effective methods for teaching the principles of success. What I've discovered is that trading is chock full of paradoxes and contradictions in thinking that make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates the nature of trading, it would be paradox. According to the dictionary, a paradox is something that seems to have contradictory qualities or that is contrary to common belief or what generally makes sense to people. Financial and emotional disaster are common among traders because many of the perspectives, attitudes, and principles that would otherwise make perfect sense and work quite well in our daily lives have the opposite effect in the trading environment. They just don't work. Not knowing this, most traders start their careers with a fundamental lack of understanding of what it means to be a trader, the skills that are involved, and the depth to which those skills need to be developed. Here is a prime example of what I am talking about. Trading is inherently risky. To my knowledge, no trade has a guaranteed outcome. Therefore, the possibility of being wrong and losing money is always present. So, when you put on a trade, can you consider yourself a risk taker? Even though this may sound like a trick question, it is not. The logical answer to the question is, unequivocally, yes. If I engage in an activity that is inherently risky, then I must be a risk taker. This is a perfectly reasonable assumption for any trader to make. In fact, not only do virtually all traders make this assumption, but most traders take pride in thinking of themselves as risk takers. The problem is that this assumption couldn't be further from the truth. Of course, any trader is taking a risk when you put on a trade, but that doesn't mean that you are correspondingly accepting that risk. In other words, all trades are risky because the outcomes are probable, not guaranteed. But do most traders really believe they are taking a risk when they put on a trade? Have they really accepted that the trade has a non-guaranteed, probable outcome? Furthermore, have they fully accepted the possible consequences? The answer is unequivocally no. Most traders have absolutely no concept of what it means to be a risk taker in the way a successful trader thinks about risk. The best traders not only take the risk, they have also learned to accept and embrace that risk. There is a huge psychological gap between assuming you are a risk taker because you put on trades and fully accepting the risks inherent in each trade. When you fully accept the risks, it will have profound implications on your bottom-line performance. The best traders can put on a trade without the slightest bit of hesitation or conflict, and just as freely and without hesitation or conflict admit it isn't working. They can get out of the trade, even with a loss, and doing so doesn't resonate in the slightest bit of emotional discomfort. In other words, the risks inherent in trading do not cause the best traders to lose their discipline, focus, or sense of confidence. If you are unable to trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned how to accept the risks inherent in trading. This is a big problem, because to whatever degree you haven't accepted the risk is the same degree to which you will avoid the risk. Trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully. Learning to truly accept the risks in any endeavor can be difficult, but it is extremely difficult for traders, especially considering what's at stake. What are we generally most afraid of, besides dying or public speaking? Certainly, losing money and being wrong both rank close to the top of the list. Admitting we are wrong and losing money to boot can be extremely painful, and certainly something to avoid. Yet, as traders, we are confronted with these two possibilities virtually every moment we are in a trade. Now, you might be saying to yourself, apart from the fact that it hurts so much, it's natural not to want to be wrong and lose something. Therefore, it's appropriate for me to do whatever I can to avoid it. I agree with you, but it is also this natural tendency that makes trading, which looks like it should be easy, extremely difficult. Trading presents us with a fundamental paradox. How do we remain disciplined, focused, and confident in the face of constant uncertainty? When you have learned how to think like a trader, that's exactly what you'll be able to do. Learning how to redefine your trading activities in a way that allows you to completely accept the risk is the key to thinking like a successful trader. Learning to accept the risk is a trading skill, the most important skill you can learn. Yet, it's rare that developing traders focus any attention or expend any effort to learn it. When you learn the trading skill of acceptance, the market will not be able to generate information that you define or interpret as painful. If the information the market generates doesn't have the potential to cause you emotional pain, there's nothing to avoid. It's just information, telling you what the possibilities are. This is called an objective perspective, one that is not skewed or distorted by what you are afraid is going to happen or not happen. I'm sure there isn't one trader listening to this audiobook who hasn't gotten into trades too soon, before the market has actually generated a signal, or too late, long after the market has generated a signal. What trader hasn't convinced himself not to take a loss, and as a result, had it turn into a bigger one? Or got out of winning trades too soon? Or found himself in winning trades but didn't take any profits at all, and then let the trades turn into losers? Or moved stop losses closer to his entry point, only to get stopped out and have the market go back in his direction? These are but a few of the many errors traders perpetuate upon themselves time and time again. These are not market-generated errors. That is, these errors do not come from the market. The market is neutral, in the sense that it moves and generates information about itself. Movement and information provide each of us with the opportunity to do something, but that's all. The markets don't have any power over the unique way in which each of us perceives and interprets this information, or control the decisions and actions we take as a result. The errors I already mentioned, and many more, are strictly the result of what I call faulty trading attitudes and perspectives. Faulty attitudes that foster fear instead of trust and confidence. I don't think I could put the difference between the consistent winners and everyone else more simply than this. The best traders aren't afraid. They aren't afraid because they have developed attitudes that give them the greatest degree of mental flexibility to flow in and out of trades based on what the market is telling them about the possibilities from its perspective. At the same time, the best traders have developed attitudes that prevent them from getting reckless. Everyone else is afraid, to some degree or another. When they're not afraid, they have the tendency to become reckless and to create the kind of experience for themselves that will cause them to be afraid from that point on. 95% of the trading errors you are likely to make, causing the money to just evaporate before your eyes, will stem from your attitudes about being wrong, losing money, missing out, and leaving money on the table. What I call the 4 primary trading fears. Now, you may be saying to yourself, I don't know about this. I've always thought traders should have a healthy fear of the markets. Again, this is a perfectly logical and reasonable assumption. But when it comes to trading, your fears will act against you in such a way that will cause you the very thing you are afraid of to actually happen. If you're afraid of being wrong, your fear will act upon your perception of market information in a way that will cause you to do something that ends up making you wrong. When you are fearful, no other possibilities exist. You can't perceive other possibilities or act on them properly even if you did manage to perceive them, because fear is immobilizing. Physically, it causes us to freeze or run. Mentally, it causes us to narrow our focus of attention to the object of our fear. This means that thoughts about other possibilities, as well as other available information from the market, get blocked. You won't think about all the rational things you've learned about the market until you are no longer afraid, and the event is over. Then you will think to yourself, I knew that. Why didn't I think of it then? Or, why couldn't I act on it then? It's extremely difficult to perceive that the source of these problems is our own inappropriate attitudes. That's what makes fear so insidious. Many of the thinking patterns that adversely affect our trading are a function of the natural ways in which we were brought up to think and see the world. These thinking patterns are so deeply ingrained that it rarely occurs to us that the source of our trading difficulties is internal, derived from our state of mind. Indeed, it seems much more natural to see the source of a problem as external, in the market, because it feels like the market is causing our pain, frustration, and dissatisfaction. Obviously, these are abstract concepts and certainly not something most traders are going to concern themselves with. Yet, understanding the relationship between beliefs, attitudes, and perception is as fundamental to trading as learning how to serve is to tennis, or as learning how to swing a club is to golf. Put another way, understanding and controlling your perception of market information is important only to the extent that you want to achieve consistent results. I say this because there is something else about trading that is as true as the statement I just made. You don't have to know anything about yourself or the markets to put on a winning trade. Just as you don't have to know the proper way to swing a tennis racket or golf club in order to hit a good shot from time to time. The first time I played golf, I hit several good shots throughout the game, even though I hadn't learned any particular technique. But my score was still over 120 for 18 holes. Obviously, to improve my overall score, I needed to learn technique. Of course, the same is true for trading. We need technique to achieve consistency. But what technique? This is truly one of the most perplexing aspects of learning how to trade effectively. If we aren't aware of, or don't understand, how our beliefs and attitudes affect our perception of market information, it will seem as if it is the market's behavior that is causing the lack of consistency. As a result, it would stand to reason that the best way to avoid losses and become consistent would be to learn more about the markets. This bit of logic is a trap that almost all traders fall into at some point, and it seems to make perfect sense. But this approach doesn't work. The market simply offers too many, often conflicting variables to consider. Furthermore, there are no limits to the market's behavior. It can do anything at any moment. As a matter of fact, because every person who trades is a market variable, it can be said that any single trader can cause virtually anything to happen. This means that no matter how much you learn about the market's behavior, no matter how brilliant an analyst you become, you will never learn enough to anticipate every possible way that the market can make you wrong or cause you to lose money. So, if you are afraid of being wrong or losing money, it means you will never learn enough to compensate for the negative effects these fears will have on your ability to be objective and your ability to act without hesitation. In other words, you won't be confident in the face of constant uncertainty. The hard, cold reality of trading is that every trade has an uncertain outcome. Unless you learn to completely accept the possibility of an uncertain outcome, you will try either consciously or unconsciously to avoid any possibility you define as painful. In the process, you will subject yourself to any number of self-generated, costly errors. Now, I am not suggesting that we don't need some form of market analysis or methodology to define opportunities and allow us to recognize them. We certainly do. However, market analysis is not the path to consistent results. It will not solve the trading problems created by lack of confidence, lack of discipline, or improper focus. When you operate from the assumption that more or better analysis will create consistency, you will be driven to gather as many market variables as possible into your arsenal of trading tools. But what happens then? You are still disappointed and betrayed by the markets, time and again, because of something you didn't see or give enough consideration to. It will feel like you can't trust the markets. But the reality is, you can't trust yourself. Confidence and fear are contradictory states of mind that both stem from our beliefs and attitudes. To be confident, functioning in an environment where you can easily lose more than you intended to risk, requires absolute trust in yourself. However, you won't be able to achieve that trust until you have trained your mind to override your natural inclination to think in ways that are counterproductive to being a consistently successful trader. Learning how to analyze the market's behavior is simply not the appropriate training. You have two choices. You can try to eliminate risk by learning about as many market variables as possible. I call this the black hole of analysis because it is the path of ultimate frustration. Or, you can learn how to redefine your trading activities in such a way that you truly accept the risk, and you're no longer afraid. When you've achieved a state of mind where you truly accept the risk, you won't have the potential to define and interpret market information in painful ways. When you eliminate the potential to define market information in painful ways, you also eliminate the tendency to rationalize, hesitate, jump the gun, hope that the market will give you money, or hope that the market will save you from your inability to cut your losses. As long as you are susceptible to the kinds of errors that are the result of rationalizing, justifying, hesitating, hoping, and jumping the gun, you will not be able to trust yourself. If you can't trust yourself to be objective and to always act in your own best interests, achieving consistent results will be next to impossible. Trying to do something that looks so simple may well be the most exasperating thing you will ever attempt to do. The irony is that when you have the appropriate attitude, when you have acquired a trader's mindset and can remain confident in the face of constant uncertainty, trading will be as easy and simple as you probably thought it was when you first started out. So, what's the solution? You will need to learn how to adjust your attitudes and beliefs about trading in such a way that you can trade without the slightest bit of fear, but, at the same time, keep a framework in place that does not allow you to become reckless. That's exactly what this audiobook is designed to teach you. As you move ahead, I would like you to keep something in mind. The successful trader that you want to become is a future projection of yourself that you have to grow into. Growth implies expansion, learning, and creating a new way of expressing yourself. This is true even if you're already a successful trader and are listening to this audiobook to become more successful. Many of the new ways in which you will learn to express yourself will be in direct conflict with ideas and beliefs you presently hold about the nature of trading. You may or may not already be aware of some of these beliefs. In any case, what you currently hold to be true about the nature of trading will argue to keep things just the way they are, in spite of your frustrations and unsatisfying results. These internal arguments are natural. My challenge in this audio program is to help you resolve these arguments as efficiently as possible. Your willingness to consider that other possibilities exist, possibilities that you may not be aware of or may not have given enough consideration to, will obviously make the learning process faster and easier. Chapter 2: The Lure and the Dangers of Trading. In January 1994, I was asked to speak at a trading conference in Chicago, sponsored by Futures magazine. At one of the luncheons, I happened to be sitting next to an editor for one of the major publishers of books about trading. We were having a lively conversation about why so few people became successful at trading, even people who are otherwise very accomplished. At one point, the editor asked me if a possible explanation for this phenomenon might be that people were getting into trading for the wrong reasons. The attraction. I had to pause for a moment to think about this. I agree that many of the typical reasons people are motivated to trade, the action, euphoria, desire to be a hero, the attention one can draw to himself by winning, or the self-pity that comes from losing, create problems that will ultimately detract from a trader's performance and overall success. But the true underlying attraction for trading is far more fundamental and universal. Trading is an activity that offers the individual unlimited freedom of creative expression, a freedom of expression that has been denied most of us for most of our lives. Of course, the editor asked me what I meant by this. I explained that in the trading environment, we make almost all of the rules. This means that there are very few restrictions or boundaries on how we can choose to express ourselves. Of course, there are some formalities, such as having to become a member of an exchange to be a floor trader, or meeting the minimum financial requirements to open a brokerage account if you're an off-the-floor trader. But otherwise, once you are in a position to start trading, the possibilities that exist for how you go about doing it are virtually limitless. I went on to give him an example from a seminar I attended several years ago. Someone had calculated that if you combined bond futures, bond options, and the cash bond markets, there would be over 8 billion possible spread combinations. Now add the timing considerations based on how you read the prevailing market conditions, and the various ways to trade become virtually limitless. The editor paused for a moment and asked, "But why would having access to such an unrestricted environment result in fairly consistent failure?" I answered, "Because unlimited possibilities, coupled with the unlimited freedom to take advantage of those possibilities, present the individual with unique and specialized psychological challenges. Challenges that very few people are properly equipped to deal with, or have any awareness of for that matter. And people can't exactly work on overcoming something if they don't even know it's a problem." The freedom is great. All of us seem to naturally want it, strive for it, even crave it. But that doesn't mean that we have the appropriate psychological resources to operate effectively in an environment that has few, if any, boundaries, and where the potential to do enormous damage to ourselves exists. Almost everyone needs to make some mental adjustments, regardless of their educational background, intelligence, or how successful they've been in other endeavors. The kinds of adjustments I'm talking about have to do with creating an internal mental structure that provides the trader with the greatest degree of balance between the freedom to do anything and the potential that exists to experience both financial and psychological damage that can be a direct result of that freedom. Creating a mental structure can be difficult enough, especially if what you want to instill is in conflict with what you already believe. But for those of us who want to be traders, the difficulty of creating the appropriate structure is invariably compounded by a backlog of mental resistance that starts developing at the very earliest stages of our lives.
There probably isn't a person in this room who doesn't understand probabilities. It's being able to function from a probabilistic perspective. There can be a huge reality gap between, let's say, our understanding of what it means, of what probabilities mean. Like, saying, hey, our pattern gives us an edge, over a series of trades, over a series of 10 trades, 7 are going to be winners, 3 are going to be losers. The problem is we don't know which ones are going to win and which ones are going to lose. So if I'm going to actually extract the profit potential in that edge, it requires that I be able to take every single trade in the series or the sequence without making errors. Makes sense, right? Okay, understanding that and believing it at the core of your personality so that you can actually do it are two completely different things. We can say we can think of ourselves as a probabilistic thinker. Say, yeah, oh yeah, I get it, I understand it. But if you can't execute all 10 trades flawlessly, then I can guarantee you you can't function at a probabilistic perspective. Because when you can, you will be able to lose without thinking you're a loser. You will be able to be wrong without thinking there's anything wrong with you. Because that's in essence where we're going. This is what makes trading so hard. We live in a society that's completely obsessed with winning is everything. Avoid losses at all costs. Winning is everything. Avoid losses at all costs. These are very powerful belief systems. You think they're just going to go away and not assert themselves on what you do and how you behave just because you have this understanding in probabilities? Just because you might read a book or go to a conference and say, hey, you know what, this is a probabilistic environment that we're dealing in, and you got to think in odds. Oh yeah, that makes sense, I can see that. Try doing it. Because what you do is going to be a function of what you believe. And if you can't do it, it means that there are conflicting beliefs that say that, you know what, no, this is not right. I think my analysis should tell me what's going on. And even though at a conscious level you're thinking, no, that's not what this is all about, it doesn't mean that that energy isn't asserting itself on how you behave. Otherwise, you wouldn't be afraid. You were at the casinos last night. How is it that if we lose, it taps us into, we have a losing experience, it can tap us into all the accumulated negative energy, like I put yesterday, of what it means to lose in our life. Losing has a potential to tap us into all this negative emotional energy. I don't want to feel that way. Most people with, let's say, a normal psychological makeup also don't want to feel that way. We will avoid this at all costs. I don't like the feeling of what it means to be wrong, all the negative energy. Brings up all the times we're berated as kids, someone ridiculing us, teachers, coaches, whatever. So if my experiences, if my trading experiences have the potential to tap me in to these two belief systems or these memories, the memories of what it means to lose and what it means to be wrong, well, you know what? I've got big problems, because you know what? If I can't lose and I can't be wrong without it resonating, negative emotional energy, there's only one other way that I can think of to help me avoid tapping into all this, and this through analysis. So in one sense, we're going to say, oh, I'm a trader, which means I'm a risk taker. But the reality is we're using analysis to do everything to avoid tapping into the memories of losing and the memories of what it means to be wrong. And it doesn't work. What we're trying to tell you is this doesn't work. Because there isn't any analytical regimen or system that you can come up with that will guarantee that the next trade is going to work. What technical analysis does is it defines patterns. In other words, when we got the order flow, we got buys coming into the exchange, we got a flow of sells coming into the exchange. When there's an imbalance between the buys and the sells and there's no buys, the price has to tick up. When there's an imbalance between the sells in relationship to the buys, the price has to tick down. As these price up and down, as the price ticks up and down, up and down, up and down, up and down, it creates what we call collective behavior patterns. I say collective because everyone who submits an order to the exchange contributes to the pattern. And what we found is that not only can these patterns be identified, quantified, but they repeat themselves with statistical reliability over and over and over again in every time frame. You guys with me on this? Where's the problem? What? Go ahead, Tony. Oh, well, yeah. No, the problem is the patterns repeat themselves over and over again with statistical reliability. The outcomes that the patterns are predicting are random. I want you to get this. This is big. Okay? The patterns repeat themselves with statistical reliability, but the outcome that the pattern is predicting is random in relationship to the previous outcomes. There's a completely random distribution between wins and losses over a series of edges, or the criteria that define your edges. Exactly. That's right. That's how casinos make money. They're gambling on each individual. They know that's a gamble. Each individual outcome is unpredictable and unknowable, but over a series of events, the law of probabilities will work its magic, and they don't need to worry about the outcome to each individual event. So now you tell me, nobody likes tapping into the pain. No one likes tapping into the pain, and yet walk into the casino and watch people sit in front of a slot machine for hours and pump money into that machine knowing they're going to lose. Not only knowing they're going to lose, experience losing. And why is it that they're not experiencing emotional pain? They are losing. Why aren't they experiencing emotional pain? Well, it's one at a time. Somebody raise their hand. Whatever. Go ahead. Yeah, well, let's put it this way. You say they're expecting the next one. They don't know if the next one's going to be a winner. The next one may be a winner, and the whole idea of it being fun is because they're going to be surprised if it is. But the point is, they are expecting wins and losses. As a matter of fact, if you watch somebody play slots or you experience playing slots, you know that you're going to lose more times than you win. And as long as you accept the risk, meaning, and how do you know you accept the risk? Your behavior will tell you accept the risk because you don't have any problems putting the money in the machine. See, if you couldn't accept the risk, then you would find it difficult to actually put the money in the machine. Gambling forces us to accept the risk in advance because if we don't, we can't play. You can't sit down at a blackjack table and just decide to play and without putting your money out there first. They won't let you.
But at the moment, it's not my base case, in part because I think that we ultimately
will end
will
up. But the illusion
that
analysis creates with trading is that I can actually...
Stephen Myron speaking to Bloomberg Surveillance there. Now, for a look at some of the other stories we're following this morning. A senior Russian general has been killed after a bomb exploded in his car in Moscow. Finil Saravov was in charge of the operational trading department in the Russian general staff. Investigators have opened a murder inquiry and are looking into Ukrainian involvement as a potential theory. And Russia's liquefied natural gas exports to China surged to a record in November as buyers shrugged off the risk of Western sanctions. Deliveries more than doubled from a year earlier to 1.6 million metric tons. That means Russia is now China's second biggest LNG supplier after Qatar. And Cambodia and Thailand have agreed to meet on Wednesday to discuss conditions for a ceasefire. The decision came after foreign ministers from Southeast Asian nations met in Kuala Lumpur. At least 40 people have been killed and 500,000 displaced since hostilities resumed this month, ending a July truce that halted an earlier round of fighting. Well, just going back to the rate story, and I tip my hat to our colleague Garfield Reynolds for this chart. You can see here how 2026 may not be as dovish as expected. Disappointing Governor Myron, perhaps, and perhaps not giving equities as much of a tailwind as hoped for in 2026. For now, though, the S&P is up for an 8th straight month, and if we check in on your futures picture, we are pretty flat at the moment when it comes to the outlook for Wall Street in today's session. But going all the way back to 1950, these last 2 weeks of the year are typically the best on the calendar. So that Santa rally is a genuine tradition. It's not just wishful thinking, though, not looking like it's going to be added to enthusiastically at the moment by the looks of the futures picture. Just flipping over to the Treasury space, and we have the yield on the 2-year down a basis point, same for the 10-year, and at the very long end, at the 30-year, we're down 2 basis points at 4.82%. Also, just checking in on your oil space, and we've got Brent this morning at $61.89 a barrel, down 0.3%. Of course, we've been weighing the geopolitical tensions around Venezuela and Ukraine, Russia, against the oversupply concerns, and indeed oil on the back foot this morning. Will the oversupply concerns continue into 2026? When is OPEC going to pivot to cutting supply? A question that we'll be discussing with Rachel Ziemba next up in the programme of Ziemba Insights, of course, as oil prices hold steady, really, after 4 days of gains. The US continuing its blockade of shipments of crude from Venezuela. So we'll get Rachel's insights next. Stay with us for that conversation. This is Horizons, and this is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Horizon's Middle East and Africa, our top stories this morning. Stocks in Asia gain for a third day after bullish momentum lifts Wall Street, indicating a Santa rally may be taking hold. And gold sets its 50th daily record this year as traders bet on more US rate cuts, as well as escalating geopolitical tensions. And US President Donald Trump is warning Venezuela's Nicolas Maduro not to play tough, while vowing to keep oil seized from a supertanker. It's just gone 9:30 a.m. across the Emirates, 5:30 a.m. here in London. I'm Lizzie Burden, in for Jumana Versace, and a very good morning to you. Welcome to the programme. And I mentioned that Santa rally starting to take hold. Not a lot of enthusiasm when it comes to the futures picture this morning. We actually have S&P E-mini futures pointing south, NASDAQ futures flat to the upside. Pretty similar here in Europe, but already seeing gains of 0.6% in the Asian equity session. We'll get to more on that with Min Lo in just a moment, but flip the board over to the cross-asset picture. And I also mentioned gold there setting a new record, its 50th record of the year. Oil pretty steady after 4 days of gains, the 10-year yield at 4.15 and euro dollar there at a 1.17 handle, up 0.1%. We've discussed with Aisha Tariq already on this programme whether AI is going to be a bubble that bursts. Is it even a bubble in 2026? Well, on our look ahead theme, here's another chart on that, and you can see the hyperscalers are seen to spend over $500 billion in terms of capex over the next 12 months. So very much a question about whether there will be returns on that investment, whether they can return enough to justify all of that capex in 2026. Another chart from our charts team. Well, let's check in on how Asia markets are faring now. Min Lo is on standby for us in Hong Kong. Min.
Hey, Lizzie, we're taking a look at the currency markets because the yen is absolutely making waves in Asia today. Take a look at this 0.7% gain against the greenback after the finance minister made her strongest verbal intervention yet, saying that Japan has free hand in making bold interventions against currency speculators. So we have broken below 156, essentially erasing the spike in the yen that we saw since last Friday after the BOJ rate hike, after Ueda's comments, which investors had interpreted as not being hawkish enough. But analysts are saying it's not just because of the finance ministry's jawbone, it's also because of the broader dollar weakness, because take a look at the euro. It's at the 117 handle now. That's lifting broader G10 currencies, Asian currencies as well, with the yuan being the vanguard here. We are inching ever so closer to that 7 per dollar level. So something to keep an eye on. And taking a look at how the yen is impacting equity markets as well. If you flip the board, and we can see the impact on the Nikkei, which is the laggard here in Asia today, down by 0.1%. Obviously, the Nikkei is an index composed of many companies that are export-driven. Topics is doing better, and of course, the banks obviously benefiting from higher rates as well. The 10-year yields coming off slightly, but still remaining pretty elevated at the 2.03% level.
All right, nice one, Min Lo in Hong Kong. Thank you so much for the update there on Asia markets. Well, we mentioned oil edging slightly lower after a 4-day run of gains as the US continues its blockade of shipments of crude from Venezuela. The US has taken control of 2 tankers and is in pursuit of a 3rd now as Washington intensifies pressure on the government of Nicolas Maduro. Joining us for analysis across these commodity markets is Rachel Ziemba, founder of Ziemba Insights. Always good to see you, Rachel. And we'll start with oil, shall we? Because, as I say, we've got the geopolitical tensions around Russia and Venezuela kind of competing with the oversupply concerns. I wonder who wins over the next few months. What's the floor potentially for oil prices?
Yeah, great to be with you, Lizzie. In this time that's not really a holiday quiet time in the markets, or not yet. So look, I think it really depends on if the U.S. is serious about enforcement, not only about Venezuela, but also about Iran and Russia. Venezuela itself is less than 1% of global oil supplies, especially the sanctioned supplies that are going to China. But this is at a time where the Ukrainians are hitting Russian tankers, where the U.S. is sanctioning more Iranian vessels. And so if we were to see tightening of several sanctioned jurisdictions at the same time, that could definitely bring oil prices up and offset what would otherwise be a decline. As for floors, my view is that I think if we sort of got below 50, it wouldn't stay, so we're a long way from that now, but it wouldn't stay there. And that has a lot to do with the fact that China continues to add to its stockpiles, and we might well see others in that context and at lower price points. Yeah.
I mean, we were discussing with Aisha earlier, when does OPEC pivot to cuts?
Yeah, and we might not see OPEC as a whole pivot to cut. I'm really watching Saudi Arabia, the UAE, the countries with the surplus capacity, whether they, both what price they're willing to sell at and whether we might see some tempering. We already know they announced plans not to keep adding new supplies in the first quarter of next year, right? Traditionally a soft time in the oil markets. So I'd be watching. Also, Kazakhstan has pledged to finally do its compensation cuts next year. You can tell I'm not too optimistic that they'll actually do that, but I do think in those 50, in those sort of lower 50s or especially sub 50 range, and the U.S. producers are price sensitive as well. But overall, the markets are going into 2026 expecting a pretty big glut, and we're waiting to see whether it will actually be as big as they anticipate.
On the flip side, we've got gold hitting fresh records again this week on the geopolitics. I'm looking at it up 0.9% at $4,483 a troy ounce right now, Rachel. Is that rally going to continue into 2026?
Yeah, I think the general trend will be upward. This is, gold continues to be a way to play the weaker dollar, the lower U.S. rates. We might see some bumps along the way. It's rarely linear, but ultimately, I think we're seeing a number of institutional investors still looking to get into gold, and that might lift up some other metals, including silver. And we've definitely seen that gold as this sort of store of value really outpaces Bitcoin and other sort of digital assets in that way.
So you don't think silver's overreaching here?
Well, we'll see. I mean, I think both gold and silver look a little stretched for me in the short term. They've seen a big jump. But I think the structural driver is still supportive.
And you mentioned the weak dollar. You don't see the dollar recovering in 2026?
I think not. I think we're going to see weaker financial conditions, slightly softer U.S. economy. But, you highlighted it with Minmin a moment ago. The real question is about dollar Asia. This 2025 has been a strong year for the dollar against some G10 currencies and some emerging market currencies. But the real question is whether the Chinese are going to allow their currency to appreciate to sort of ease some of the pressure from the big trade surplus and current account surplus. They probably want to allow a lot. But I think if we see the renminbi appreciating, we might see some other Asian emerging market currencies following suit or being pushed up in that way. And then I'm also watching EM currencies that are beneficiaries of the cheaper oil prices, even places like Turkey, but also other importers like India, for example.
Okay, really interesting. Glad to get your take before we close out 2025. Rachel Ziemba there, founder of Ziemba Insights. Thank you so much. Well, let's get back to the geopolitics. Fresh clashes between the Syrian army and the US-backed group SDF have erupted in northern Syria. The clashes coincide with the visit of Turkish ministers to Syria for talks over different issues. The renewed violence could also further diminish hopes to meet a year-end deadline to integrate the armed faction into state institutions. We can get more on this now with Patrick Sykes, who's, of course, Bloomberg's breaking news editor in Istanbul. He joins us now. Patrick, how big of a threat are these clashes to Syria's stability and security?
Morning, Lizzie. Yeah, I think the real threat here is from the timing, right? You mentioned we've got that year-end deadline for the folding in, the integration of the SDF into the new national Syrian military. That was already a pretty contentious deadline. There had already been a lot of public debate about what form it might take, what it might look like. And now we're seeing the outbreak of outright violence, which I think suggests that, if anything, that deadline is going to have to move, or there's going to have to be some flexibility there. That would be a symbolic blow to President Shara. He's spent all these months since the downfall of Assad trying to unify the country, and that is one of the main stumbling blocks still to be overcome. It's also a real sore spot for Turkey, right? Turkey just over the border sees the SDF, a Kurdish-led force, as an extension of the PKK that Ankara fought on its own soil for several decades. If that integration doesn't happen, Turkey's already hinted that it could consider military action to dismantle the SDF. And if it weren't to happen, I think it's only going to strengthen the argument in some parts of Ankara for that.
Well, yeah, you've got the Turkish foreign minister, Patrick, accusing the Kurdish SDF of coordinating with Israel. Could that risk a different confrontation between Israel and Turkey?
Yeah, the timing was really awkward there, right? Just yesterday, Fidan, along with the Turkish defense minister and the top intelligence chief, were all visiting Syria, trying to present this united front, and no doubt discussing things like the integration of the SDF. I think the reason that allegation is important and potentially escalatory is that it taps into this broader Turkey-Israel rivalry that's emerging in the region at the moment more broadly, right? You've got the Turkey backing the new national government, the new central government in Syria, which obviously emerged from the north. And then in the south, you've got Israel backing some Druze factions, where we've seen clashes earlier in the year, and also occupying some territory. So these two countries, powerfully armed, both of them, are literally facing off, over Syria through kind of proxy groups in the region. Those tensions in Syria, I think themselves, also an extension of the country's tensions over Gaza. Obviously, the war there in which Israel's been trying to destroy Hamas, and Turkey views Hamas as a legitimate resistance organization. So it's just another layer of tension between the two sides. I don't think we're looking at the possibility of outright confrontation between the two of them at this stage, but it is another front on which their kind of effective proxies are coming to literal blows.
All right, Patrick, really appreciate you bringing all that together for us. Patrick Sykes there, Bloomberg's breaking news editor out of Istanbul. We thank you. Now, for a look at some of the other stories we're following in the region. Israeli Prime Minister Benjamin Netanyahu has warned Iran of a very fierce response if it attacks Israel. Speaking alongside Greek and Cypriot leaders in Jerusalem, Netanyahu noted that Iran has recently been conducting military drills, adding that upcoming talks with President Trump will touch on Iran, but will focus primarily on the next stage of the Gaza ceasefire plan. And Iran's foreign ministry spokesman says its missile program is strictly for national defense and deterrence. He made the comments in response to an NBC report about a potential Israeli attack. The spokesman also said that Iran's missile program is not up for discussion in any diplomatic negotiations. Well, coming up, we'll turn to Africa. Nigeria's secured a $500 million loan from the World Bank to boost lending to small and medium-sized businesses. So we'll bring you that story next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Nigeria has secured a $500 million loan from the World Bank in order to boost lending to small and medium-sized businesses. The lending giant says that the programme could mobilise nearly $1.9 billion in private capital and support 250,000 firms. Well, for more, we're joined by Bloomberg's Anthony Osei-Brown, who joins us now. Anthony, just walk us through how significant this loan actually is for Nigerian companies. Good morning.
Good morning, Z. Yeah, I think it's quite significant. 9 out of every 10 businesses in Nigeria are small businesses. You could do mom and pop shops and other forms of small business run mainly by families who depend on it to support their daily living and everything. So it's quite significant. They generate about 8 out of every 10 jobs in the country and contribute about half of economic output, account for about half of economic output. So this is a significant sector that needs financing, and their biggest challenge is actually access to capital. Research after research has shown that one of their biggest challenges is access to capital. So where any form of financing to this sector makes quite a lot of difference, because you're targeting about 50% of your capital base, 80% of your the sector that generates employment, and 90% of businesses, or more than 90% of businesses, but that don't have capital to expand or develop further. And that's basically most of them can't provide the collateral. Cost of funds is quite high, or interest rates are quite high in the 30s, and most of them struggle to get access to this capital. So this funding that is targeted specifically at them could make quite a difference for the economy.
Yeah, and of course the backdrop is tight public finances, and you allude to this, but how important is this kind of support then for Nigeria's growth outlook? How much of a difference is it going to make economically?
Yeah, so if you're looking at mobilizing about $1.8 billion for this sector, because the funds will also provide some partial guarantees to provide additional funding for the sector, and this sector makes up about contributes about half of your economy. And considering that the government is struggling with its finances, almost 50% of government finances goes into servicing debt alone. Another maybe 30 to 80%, actually almost 40% goes into funding personnel costs. So little is left over for funding small businesses or providing assistance to small business, either as grants or even loans. So this money coming from the World Bank will make a lot of difference, support a vital sector and help them expand growth, which of course is about half of the economy. So our economic output is likely to be strengthened if this facility is well implemented and supported. And a key part is also targeted at women-led businesses, and most of the small businesses are women-led businesses, and they are the ones that struggle the most to get access to capital. So when you get this loan and you direct it to women-led businesses, as you know how important women are to the society in terms of providing support to the family, that could make a lot of significant difference to economic growth going forward.
Okay, so gender equality as well as economic benefits. Anthony, great to see you. Thank you so much for bringing us this story. Anthony Osei-Brown there, Bloomberg's Nigeria Bureau Chief. Thank you. Well, coming up on the programme, another top interview of ours to bring you. The Bank of America CEO Brian Moynihan says that the US economy will be strong next year as companies ramp up their AI investments. We'll get you more on that next. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
Not a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in London. Now, Bank of America's CEO Brian Moynihan says that the US economy will be strong next year due to, in part, companies ramping up their AI investments. He spoke to Bloomberg about the new technology's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at customer or client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in a 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
That was the Bank of America CEO Brian Moynihan there on Bloomberg's Wall Street Week with David Weston. Well, in our last few moments here, let's check in on these markets. 2 sleeps to Christmas. It's a shorter trading week than usual, and the Santa rally does seem to be taking hold. You had equities erasing their December losses in yesterday's session. Futures pointing a touch lower, though, at the moment. That does it for Horizons Middle East and Africa. I'm Lizzie Burden in London. Do stay with us for Daybreak Europe. Oliver Crooks coming up next. This is Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Oliver Crook in London, and these are the stories that set your agenda. Stocks in Asia gain for a third day. The yen rallies as Japan's finance minister leaves the door open for intervention. Gold hits its 50th daily record this year. Oil steady as President Trump warns Venezuela's Nicolas Maduro not to play tough, but stops short of calling for his removal. Plus, Novo Nordisk surges after it wins U.S. approval to sell a pill version of its blockbuster weight loss drug, Wegovy. Happy Tuesday morning here. Looking at the futures across Europe, not really doing a whole lot. Euro Stoxx 50 futures dead flat this morning, unchanged after a slightly darker session yesterday for the European stocks. FTSE 100 futures down about 1/8 of a percentage point this morning. S&P giving back just ever so slightly some of the gains that we saw yesterday and Friday, but basically let's call it flat for the S&P futures and NASDAQ futures, both of which did reasonably well in yesterday's session. Going cross-asset, a lot of focus this morning on the yen after our interview with the Japanese finance minister, saying that the Japanese government has a free hand to play in the currency market against speculators. That was after we saw a BOJ rate hike that actually caused the yen to decline. And so we're seeing yen strength now for 2 days, down about 0.5 percentage point. This morning, Brent crude has steadied a little bit after that action we saw off of the border, off of the coast of Venezuela. Gold, unflaggable this morning. Again, up almost 1 percentage point, adding to the gains yesterday. We're talking about 50 record for gold throughout the year. And platinum also. We don't get a lot of platinum action on the board this morning. 1 percentage point higher this morning, seeing it across the commodity complex. Let's see how the Asian markets are faring this morning with Winnie Su in Taipei. Winnie.
Yeah, so we do see some modest gains when it comes to the Asian stocks. In fact, the benchmark is rising for a third day. So today, mainly that's being led by the financial sector, with Japanese banks rising, specifically on further expectation for the Bank of Japan to raise rates further. Now, we are also closely watching the Chinese stocks because the onshore benchmark CSI 300 also rising for a third day, despite a downgrade from Citi to neutral on the earnings revision, and also expectation for a weaker macro outlook to continue. And that strength in stocks also pushed the yuan higher to now still around that 14-month high and hovering around that 7 levels that we're closely watching. Now, we also just want to take a closer look into that divergence between the performance when it comes to the onshore and offshore Chinese stocks, because that is quite a reversal from what we've been seeing from earlier this year, where we saw offshore stocks really leading gains because of that deep-seek optimism. But that has really faded a little bit with that tech valuation concerns. On the other hand, you really see that onshore stocks picking up these momentum, especially with these successful IPOs on the mainland market, with more threats. And even last week, we had Meta X. So that has really revived the optimism in terms of the AI strength when it comes to the Chinese market.
Yeah, and Winnie, a lot of attention on the currency market, specifically attention on the yen, and that's in large part due to our interview that we had a little bit earlier. What do we hear there?
Yeah, exactly. That is quite a swing when it comes to the moves of the yen, right? Because today we are seeing that rebound in the Japanese yen, where we're looking at about 0.7% gains there. And now I believe hovering around that 156 level against the dollar. And that rebound, as you mentioned, has come from Satsuki Katayama, who is Japan's finance minister, had that strongest verbal warning against the moves in the currency. And she is saying that to our exclusive interview from Bloomberg that the government pretty much has that free hand in terms of kind of intervening into the market if we see moves that goes against the fundamentals. And that's exactly what we saw on Friday, because we did see the yen weakening past that 157 levels on Friday after the Bank of Japan raised rates. And that is mainly due to traders not seeing much of a hawkish move, or pretty much not seeing a lot of clarity when it comes to the further moves from the Bank of Japan. And hence that weakening trend really caught investors and also authorities by surprise. And remember, previously when the Ministry of Finance intervened, it used to be around that 160 levels, and that's still the level that we're closely watching in terms of intervention risks.
Well, Winnie Su, thank you so much for that in Taipei. And let's get more on those comments from Japan's finance minister that has issued her strongest warning yet to currency speculators, telling Bloomberg exclusively that officials have a free hand to take action.
まあ為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
いやだから私たちはいつでもそういう状況になったら
We have an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10 yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I
can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
Japan's finance minister speaking there exclusively with Bloomberg. From the currency market to the commodities market, gold and silver keep hitting record highs amid geopolitical tension and prospects for more U.S. rate cuts. In 2025, silver has rallied 140%. Gold today hits its 50th record of the year. Here to shine some light on the metal trade is Bloomberg's metals and mining reporter Martin Ritchie. Martin, gold 70% this year. Have we reached max gold here, or do we have more to run?
Very good question. It has been an extraordinary year for gold. I think we counted today, there's been 50 days this year where gold has set a new record high. So it's been a fairly steady climb, and it's been resurgent again after a little dip in the last month. We're now close to 4,500. As to whether this continues, look, I think the kind of balance of opinion, if we sort of distill everyone we speak to, is that gold still looks strong into next year, and this is underpinned by, as you said, the expectations of more monetary easing, continued sort of, I guess what you call sort of fracturing of how people think about the global economy. We talk about the debasement trade with people feeling less committed to sovereign bonds and currencies, which is driving people to precious metals. And then we've got the central banks buying a lot of gold as well. And on top of that, gold's not like a huge market. If you look at the number of exchange-traded funds holding gold, if you look at the reserves there, the volumes are still relatively small. It would take only, a fairly small proportion of total private investment funds flowing into there to sort of ratchet up the prices even more. So I think the balance of opinion that we speak to anyway, certainly for the short-term future, is still fairly bullish.
And Martin, is that the same story across the commodity complex for precious metals? I mean, we're seeing copper's had big gains this year. Silver's doing very well. Is there something else underpinning, for example, the copper trade?
I would actually make a pretty clear distinction between the precious metals and the rest. If you take copper, for example, demand's actually been pretty soft this year. Even while it's racking up these big gains, because there's some quite kind of esoteric factors in play there. A lot of metal being shipped to the US to front-run potential tariffs next year, which is sort of giving the perception of a tighter market elsewhere. That could easily kind of peter out towards into next year. And there have been warnings that that you can't really rely on a rally that's only supply driven. You also need that demand to come through. And yes, demand for copper is growing, but generally it's not as powerful as we've seen in previous years.
Well, Martin Ritchie, thank you so much for your time this morning. I'm sure you'll be staying on your toes over the next couple of days and weeks and into 26, looking at all these metal trades going ahead. Now, let's get some data a little bit later today, 8 a.m. UK time. Spain, final third quarter GDP, PPI inflation for the month of November as well. We will get also later this afternoon at 1:30 p.m. that delayed U.S. third quarter GDP figure, watching that very closely a little bit later this afternoon. And also at the same time in Canada, we're going to get the October GDP number. So a lot of growth figures to look ahead to a little bit later in the day. And you can get a roundup of all the stories you need to know and get your day going. In today's edition of Daybreak, it's all about Novo Nordisk getting approval to sell their weight loss pill in the U.S. ADR is up about 10% in the after hours in U.S. trade. We'll be watching that very closely as the market opens here in Europe. Gold, the unstoppable rally. We were just speaking about that with Martin Ritchie. 50 different record highs this year alone on the days of trading. And Trump telling defense firms to spend more on weapons. That'll be some of the sort of key stories there for Bloomberg Daybreak Europe. Terminal subscribers can go to DAYB to sign up. But up next, the Bitcoin breakdown. We'll be diving deep into the market and looking at the rise and fall of Bitcoin in 2025 and what to expect next year. That's next, and this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
To see price actually slide this year on Bitcoin and generally in crypto markets. People are talking about the cycles, of course, of the crypto markets. But my view on capital markets and Bitcoin markets is always a long-term view. I've no doubt that this is a correction eventually into higher prices in Bitcoin and into the transition of more than $100 trillion becoming digital assets over the next 20 years.
When we look at where we are a year from now, it's been overall very positive for the space, and we've seen much more regulatory clarity coming out of this. And I think getting into next year, it's we're past a point of no return when it comes to regulation and institutions interacting with crypto markets.
Past a point of no return, some of the views from our guests on volatility in the crypto space we've been seeing over the last couple of months. But Bitcoin really sprinted into 2025 full of potential. But since reaching that all-time high back in October, the largest cryptocurrency remains fragile, with traders sort of revamping their approaches heading into 2026. For more, let's bring in crypto market reporter at Bloomberg, Siddhartha Shukla. Thank you so much, Siddhartha, for joining us this morning. It's been a wild ride for Bitcoin this year. I think that's a pretty fair assessment. What did we learn about crypto and Bitcoin in 2025?
Yes, Oliver, thanks a lot for having me. Absolutely. This has been a very interesting year. Certainly, this has been different from the past rallies that we have seen, because Bitcoin started off on a very positive and strong note. We've seen the rapid institutionalization of the space. Investors have poured in more than $21 billion in the spot Bitcoin ETFs. In fact, the kind of regulatory clarity and acceptance that we have seen, it's unprecedented in the space. In fact, Bitcoin has found its biggest backer in US President Donald Trump as well. So starting off the year, we had all the tailwinds that the sector was demanding for years, even in fact more. But come October, we saw that the token hit an all-time high, but it was also a reminder that despite the institutionalization of the space, the market structure remains very fragile, right? In a matter of hours on October 10th, we saw $19 billion worth of liquidations. And since then, more than $1 trillion in market value has been erased across tokens, and the market hasn't recovered since. In fact, Bitcoin hasn't really lived up to its reputation of digital gold. As you can see, gold is, I think, above 70% this year, on track for its best year since 1979, whereas Bitcoin is on track to end the year in red, which is different from the past cycles because, like, for example, in 2022, we saw that the collapse of Sam Bankman-Fried's FTX, the collapse of Terra Luna, they were the catalysts for the sell-off, right? But this year, the token and the sector had all the tailwinds it ever demanded for, but a fragile market structure led to the drawdown that we are in right now.
Well, that's a good assessment of where we've been kind of in 2025 and where we are going into 2026. Give us a bit of a preview for what you're looking at going into next year for stablecoins. What will be driving the action there?
Certainly, yeah. So 2026 will be quite an interesting year because we saw that the Genius Act passed in the US earlier this year, and that has led to a phenomenal growth in stablecoin adoption and usage across the world. One of the trends that we have our eyes on is how the broader FX market also evolves around stablecoins. Like, for example, at this stage, the total market circulation of stablecoins is above $300 billion, out of which 99% are denominated in US dollars, right? So we don't have a vibrant stablecoin market for other fiat currencies, whereas the expectation is that going into 2026, we should see more jurisdictions come out with regulatory clarity around stablecoins, and hence we should see more fiat currencies also adopting this stablecoin wrapper. And people are expecting that, we should see quite the growth of more like a parallel 24/7 FX market on stablecoin blockchain rails in 2026.
Well, Siddhartha, thank you so much for that roundup and looking ahead into the year ahead for cryptocurrency. That's Bloomberg's crypto market reporter, Siddhartha Shukla. Thank you so much for your time this morning. Coming up, Bank of America says the AI effect is kicking in, and you'll feel it even more in the economy next year. More from our interview with CEO Brian Moynihan. That's next, and this is Bloomberg.
bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back to Bloomberg Daybreak Europe. Bank of America CEO Brian Moynihan says the U.S. economy will be strong next year due, in part, to companies ramping up their AI investments. He spoke to Bloomberg about what he sees as AI's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer, and you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in a 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
Bank of America CEO Brian Moynihan speaking to Bloomberg's Wall Street Week with David Weston. Now, let's get to some other stories making some news. Alphabet shares closed higher after the company said it's buying clean energy developer Intersect Power. The move will allow Alphabet to expand its AI data center footprint. Aging U.S. grids are struggling to meet power demand that's booming for the first time in decades, thanks in part to artificial intelligence. Bloomberg has learned that the U.S. government is investigating whether a Singaporean firm, Megaspeed, has smuggled NVIDIA chips into China, which would be a major breach of curbs imposed to limit Beijing's AI and military prowess. Megaspeed, which is now Southeast Asia's biggest buyer of NVIDIA chips, denies any wrongdoing and says it abides by all regulations from the United States and elsewhere relevant to its operations. And Larry Ellison is throwing his personal fortune behind Paramount's bid for Warner Brothers, providing an irrevocable personal guarantee of about $40 billion. The aim is to give his son David the edge in the takeover battle with Netflix. The Warner Brothers board has previously urged shareholders to reject Paramount's bid, but says it's now evaluating the amended offer. Coming up, the U.S. president announces a new class of warship named after himself. More on the so-called Golden Fleet next. This is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Oliver Crook in London. These are the stories that set your agenda. Stocks in Asia gain for a third day. The yen rallies as Japan's finance minister tells us that the door is open for intervention. Gold hits its 50th daily record of the year. Oil steady as President Trump warns Venezuela's Nicolas Maduro not to play tough, but stops short of calling for his removal. Plus, Novo Nordisk surges after it wins U.S. approval to sell a pill version of its blockbuster weight loss drug, Wegovy. Let's get into the futures this morning as we head into the session for Tuesday morning. As you can see across the board there, a very slight bit of red. Euro Stoxx 50 futures basically dead flat, catching a little bit of a sell, but not a huge amount. FTSE 100 futures down about 1/8% at about 9,885. S&P futures after two really strong sessions in the United States on Friday and Monday down about 10 basis points there. And the NASDAQ 100 futures down about the same after a fairly strong session yesterday. Going to the cross-asset board, the picture across different asset classes, as we were mentioning, the yen there gaining some strength this morning against the U.S. dollar. Dollar yen down about 0.6%. Brent crude basically steady this morning after most of the action yesterday moved through the market after those headlines from the United States moving on some of that Venezuelan crude and some of those ships off of the coast. Gold still powering forward, up for another record, the 50th daily record of the year, and MSCI World up just a hair there, just a couple points away from an all-time record high for global stocks. The U.S. President Donald Trump has warned the Venezuelan president not to challenge the United States. At a press conference, the United States president was also asked what he plans to do with the oil tankers and cargo seized during the continuing blockade of Venezuela.
The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it.
Where's it going? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
A lot to unpack there, and we're joined now by Brian Fowler from Bloomberg to help us sort of through some of the things we heard from the president yesterday in Tokyo. There is Brian. So listen, President Trump avoided saying whether he wanted to overthrow Maduro. What is the latest with the U.S. blockade of Venezuela?
Yeah, so this U.S. campaign in the Caribbean continues to evolve. It started, of course, as an anti-drug trafficking operation and has now become something a little bit more amorphous. The U.S. over the weekend boarded a second vessel, a Panamanian flagged ship that had recently loaded Venezuelan oil. Apparently, it had turned off its transponder, so that's been boarded. And the U.S. is also currently in pursuit of a third ship, the Bella 1, which it has determined is not flying a valid national flag. That ship has resisted efforts, all calls to stop, and a pursuit is underway. And as we had heard earlier, Trump is saying that he's going to keep the oil. He's also threatening President Maduro not to fight back. If he fights back, he will never be able to fight back again. Trump has stopped short of saying that this is all about regime change, but people in his cabinet have been a lot more clear on that. Homeland Security Secretary Kristi Noem said that this is about much more than just seizing the oil. He has to be gone, she said. So all these actions, they've been criticized at home and abroad. China, which is the biggest importer of Venezuelan oil, has criticized the actions as illegal. And then at home, Kentucky Senator Rand Paul has said this looks like a prelude to war.
Yeah, and we got some sort of immediate headlines there for what is going on off the coast of Venezuela, but there was also some announcement about much longer sort of strategic ambitions for the warships of the United States. What did the president have to say about that?
Well, I mean, he's announced a new class of battleship that's named after him. They've even got the name of the first vessel, which is called the USS Defiant, which seems, I'm sure, he named personally, it sounds like. But this is all about advancing the capabilities of the U.S. Navy. This new class of battleship apparently would be firing laser beams at targets, and it's meant to make the whole Navy much more efficient, is what Trump said.
Well, Bloomberg's Brian Fowler, thank you so much for that. The update, important update there off the coast of Venezuela and everything that we're watching long-term for the U.S. military. Now, Novo Nordisk U.S.-listed shares jumping in late trading after it secured FDA approval for a pill version of its weight loss jab, Wegovy. The pill is expected to launch in the U.S. in January. Let's get more from Bloomberg's pharma reporter Amber Tong. Amber, walk us through the significance of this. We've had, of course, the injection for quite some time. Why is a pill so important?
Yeah, Oliver, this is really something that many people have been waiting for a long time. As you said, Wegovy and Novo Nordisk diabetes drug Ozempic, these are huge. They both contain the same active ingredient, semaglutide, and they belong to this blockbuster GLP-1 class that has become really multi-billion-dollar drugs. And Novo Nordisk also has a pill form of semaglutide that's already approved for diabetes. But this new approval really completes the quartet. This is the first of its kind approval for an oral GLP-1 pill that's approved for weight loss. And while the injectables have been hugely successful, there's been a lot of talk that an oral pill would provide a much more convenient option for patients. There are people who may be afraid of needles and they don't want to get injections. They would prefer to take a pill once a day instead to meet their weight management needs. And a pill form of the obesity drug is also much easier to transport and store because it doesn't require refrigerators, unlike the injectables. So this is really a crucial win for Novo Nordisk as it takes on Eli Lilly, its chief rival.
Yeah, and a Novo Nordisk that seems increasingly in need of a major win. Shares are down about 53% this year from the higher point a little bit earlier in February. Put this in a larger context for Novo Nordisk and whether or not this will turn its fortunes around.
Sure, yeah. This, as we see, it seems like investors are quite excited about it, judging from the after-markets trading. And this approval certainly provides a near-term, much-needed boost, a potential growth driver. But the execution of this commercial rollout of the obesity pill would be really critical. Eli Lilly, Novo Nordisk's chief rival, also has an obesity pill in the works. And the company has said that it anticipates an approval as early as March. So Novo Nordisk really only has a few months of head start to kind of establish this market and to take lead in this really critical oral market. And on the other hand, Novo has also really been under pressure on a lot of fronts, not just from Eli Lilly. It's battling the compounding pharmacies that are selling kind of legally gray area obesity drugs in the US. And there's a crop of newly emerging companies, and whether it's startups or big pharma, that's also eyeing this huge obesity market. So there's still a lot for Novo Nordisk executives to prove.
Well, thank you so much, Amber. That's Bloomberg's Amber Tong for your update there on Novo Nordisk, and something we'll be watching very closely at the opening of trade today. What else we'll be watching is an interview with the CEO of Novo Nordisk a little bit later today. He'll be on Bloomberg Surveillance at 1:15 p.m. London time. Don't miss that conversation. But coming up here, we'll discuss the impact of Russia's attack on Ukraine's energy infrastructure. The CEO of Ukraine's biggest private energy company will join us next from Kyiv, and this is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Well, welcome back to Bloomberg Daybreak Europe. Former head of Britain's spy agency has told Bloomberg that intelligence suggests that Vladimir Putin is not ready to end the war in Ukraine. The former MI6 chief Richard Moore spoke to the Michel Hussein show last month.
Our voice is one that is listened to in Washington. So things change, move around a bit. That's the style of the current administration, but we are always there, and it's our responsibility to use that to convey exactly what the intelligence is telling us, and it's telling us, for example, that Putin has no intention of doing a deal, that this is not an issue for him purely of territory. This is about dominating Ukraine and turning Ukraine into something that looks rather like its neighbor, Belarus. So all of that stuff we talk to the Americans about all the time.
So
and I think you can see sometimes the impact of
doing
that.
A deal, Vladimir Putin, if he has no intention of doing a deal, then how do you see this ending? This
at the moment. So I don't think under current conditions that Putin. Well, I mean, I'm basing this on access as I had a few weeks ago to our understanding of the intelligence on it, and that is that he's not ready to do a deal. So for me, the answer to that is he needs to be put under more pressure. So he is prepared to do a deal. The president of Ukraine is clearly ready to do a deal. He's remarkably, in the pursuit of peace, prepared to give away up to 20% of his country de facto, and yet Putin is not. So what's going to change that? More pressure on the battlefield. Ukrainians have an undercapitalized defense industry. They have spare capacity that cash would solve. There is more that we can give them. There is more that we can give them in terms of permission to use long-range weaponry, for example. There's all of that, as well as giving them the sort of, the basics of air defense and all that. And there's an opportunity to put a lot more pressure on Putin at home. And I don't pretend that is going to give immediate results. One of the things I would say in this space is we have to be patient. We have to be prepared to see this off.
The former head of MI6, Richard Moore, speaking to Michelle Hussein there. And we'll keep it on Ukraine and Russia. Russia is continuing to pummel Ukraine's energy system. This week, around 120,000 people in the Odessa region were left without power. And last weekend, a series of Russian missiles and drones attacks left parts of the region without power for several days at a time of the year when temperatures are always around freezing or below. For more on the power situation in Ukraine, we're joined by the CEO of the nation's biggest private energy infrastructure developer, DTEC, Maxim Timchenko. Thank you so much for joining us. I'm speaking today in a very cold day in Ukraine and across the country in a very challenging moment. Can you give us an overview of what the power situation is today in Ukraine?
Good morning, Oliver. Unfortunately, just in these minutes, we are under massive attacks of Russians, and the major target of today's attack is power station. So, as you know, we been attacked. Only power station of the attack more than 6 times since September this year. And I believe that this coming winter will be the hardest winter since full-scale invasion.
And to try to explain to that a little bit further what it means to have the hardest winter, you've had many hard winters. Explain to us the sort of degree. What are we talking about in terms of power coverage across Ukraine? Can you quantify that for our audience?
Right. To make it simple, people already, even with the temperature around zero, staying without electricity for 15 to 20 hours in some regions of Ukraine. So more than 50% of our power generation facilities are damaged or destroyed since September. And definitely we have deficit of generation capacity. Russians attacking everything, generation, transmission, gas infrastructure, coal production, all energy infrastructure under constant attacks of Russians since September. And it's incomparable attacks in terms of intensity for the last 4 years. And as I said, literally these minutes, 2 of our power stations under attacks, we will see the outcome of this.
And how able are you to reestablish some of these links? I know from the very beginning of the war, your teams have been putting themselves in great danger to try to reconnect, to try to rebuild. Are you still able to do that? Is that becoming more and more difficult as more and more is being knocked out?
Yeah, absolutely. It's become more and more difficult because unfortunately we run out of stock of our equipment, the used equipment. Today there's the major problem. We have thousands of people working on the site after each attack. But the problem is that we don't have additional transformers or generators or turbines, and this is what we need now. We don't have time to place it in production. For this winter, we need to find used equipment. That's why our teams traveling across Europe to decommission thermal power stations to find any pieces of equipment we can bring back to Ukraine to restore power station as soon as possible. So today, what we need, number 1, air defense, number 2, used equipment, and number 3, funding of this equipment.
And are you getting some, in conversations with some of the leaders from the Commission, from other sort of forms of investors and businesses, are you finding the support that you need, or does that effort need to be stepped up massively, just given the size of the situation that it appears that you're dealing with at the moment?
Yeah, absolutely. We are very grateful to all our partners for this constant support we have since February 2022. Unfortunately, not everything can be done in such a short period of time as we needed, but definitely we are in very close communication with the European Commission, Energy Support Fund, with our partners from the United States, not only for supply for the coming winter, but also for mid and long-term solution for Ukraine. And this solution is in distributed generation, in solar, wind, battery storage technologies, which make us much more resistant.
Yeah, and I want to talk about that medium-term solution. Obviously, there's the immediacy of this winter, but there's also, we've talked about this in the past, your efforts to redistribute kind of how power is generated. It's very easy to knock out a coal-fired power plant. It's much more difficult to get a distributed grid down. How are your efforts in building out that solar and wind capacity? Has that been helpful to your efforts in trying to keep the lights on in Ukraine?
Yeah, absolutely. Today, we can, based on our own experience, compare how resistant is solar farm and coal-fired power station. To restore the same capacity for solar or wind power station, we need days. If you're talking about coal-fired, it's about months or years. That's what is happening now. That's why we made a decision to continue construction the largest wind farm, not only Ukraine, but in Eastern Europe. Just in September, we commissioned the largest battery storage system, which is extremely important for resistance of our power grid. And in general, investing more in renewables seen from energy security rather than climate change. But it gets both.
And I also want to talk about some of the longer term. So we're talking about the medium term, the immediacy, but longer term reconstruction, the dialogues that you're having with partners from outside of Ukraine, whether or not you're able to attract that investment for a sort of day after. I know there's been a lot of discussions, including with President Zelensky and the head of BlackRock, the Treasury Secretary. Are you part of those discussions? Or is there investor interest in trying to rebuild Ukraine to make sure that it has power in the future?
Absolutely. We didn't stop these discussions, and basically our position that recovery of Ukraine started from the new projects we and other investors in Ukraine realizing since 2022. So today we are building so-called coalition of the willing to quickly restore power system in Ukraine, to build even bigger wind park in Ukraine, which we developed for 3 years, and now it's ready to go. Also, we're offering projects in energy battery storage. We're offering project to our American partners to drill ultra deep wells to unlock huge potential in gas production in Ukraine. So all these areas in energy sector open for partnership. And this is basically a philosophy of our company, be one of the preferred local partner in Ukraine to, as I said, unlock huge potential in energy sector of Ukraine.
And as we speak, you know, there are these negotiations happening at the highest level to try to end the war in Ukraine. Can I just end the conversation by asking you how optimistic you are that President Trump and the U.S. administration will be able to bring this war to an end in these negotiations with Russia and with Ukraine?
So probably it's hard to say about optimism. It should be just and lasting peace. Security guarantees extremely important, especially for investment we just discussed. So I can understand all international partners asking about security situation in Ukraine. And I think that part of this negotiation should be economic development of Ukraine under strong security guarantees which we need. So I hope that all this negotiation and leadership of President Trump can bring us to the peace. But as I said, it should be just and lasting peace.
Well, Maxim Timchenko, the CEO of energy infrastructure developer DTEK, thank you so much for joining us this morning from Kyiv. And just to sort of illustrate the situation there, Kyiv today will have a low of -8 degrees. Tomorrow it will have a high of -7 degrees and a low of -9 degrees. That is just illustrating how cold it is as all these sort of blackouts rip across Ukraine. Now let's get to some other stories that are making news elsewhere. Shares in offshore wind companies slumped after the U.S. announced that it's suspending all 5 wind farms under construction off the East Coast. The U.S. Interior Department cited national security concerns, saying that massive turbines may interfere with radar systems. And new car registrations in Europe ticked up for a 5th straight month in November, putting the region on course for a 4th year of gains. According to the European Automobile Manufacturers Association, buyers registered 2.5% more vehicles from a year earlier, led by growth across electrified models. Spain and Germany recorded the biggest gains among the major markets. And UK businesses are ending the year feeling more upbeat about the economy's prospects after being spared much of the tax pain from last year's budget. Lloyd's Business Barometer rose to a net balance of 47%, with optimism over the wider economy hitting a 4-month peak. It comes despite figures confirming that the economy slowed sharply in the second half of the year, with forecasts warning it could contract in the final 3 months. Plenty more coming up. This is Bloomberg.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
If we don't adjust policy down, then I think that we do run risks of rising recession. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction.
That Fed Governor Steve Myron there speaking to Bloomberg Surveillance a little bit earlier yesterday, and getting into the end of the year and then the end of the show today, we're going into some of the sort of charts we're paying attention to. The global stocks near a record high today, just a couple of points shy away from a global high after what was a very turbulent year for world stocks. Remember, reaching the low there after Liberation Day back in April, but has just stormed ahead into the end of the year and just a shy of an all-time record high. And that's not only the only place where we're seeing record highs today. We're seeing, of course, in gold, another session of positive moves for gold, up almost 70% in the year, 71% now as we close in on the year. That is along with all the rest of the commodity complex across metals. We've seen a similar story in silver, similar story in platinum, and copper giving a little bit some of that back today, but really overall just a very tremendously positive year for metals across the globe. And ending the year also on another issue that we have been dealing with, particularly in Germany, which is European bond issuance. You'll remember that also at the beginning of this year, we had a major shift in European policy in the Bundestag within Germany, saying that they would release the debt brake for some spending. That is going to unleash literally hundreds of billions, if not trillion, more than €1 trillion of spending. And what we have seen this year is European bond issuance begin to just absolutely skyrocket. €2.54 trillion in European bond issuance. That is both sovereign as well as corporate. But going into next year, we're going to get a record from the German government. They will issue more than €500 billion worth of bonds going into next year. And that is going to be seen really by most analysts as the big catalyst, the big driver for growth in Europe, really looking for the Bundestag and Friedrich Merz to help bring that turnaround here in the German economy and, of course, in the European economy more broadly. But going into the session a little bit later today, European futures down basically a couple of points, more or less flat for the day. That's it for the show today. The opening trade is next. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did there.
You didn't know he was an actor?
No, I don't know what he doing. Because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning from London. I'm Anna Edwards alongside Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. Gold sets its 50th daily record this year as traders weigh geopolitical tensions and prospects for more U.S. rate cuts next year. Elsewhere, the dollar weakens for a second day as the yen leads G10 currencies higher after Japan's finance minister repeats Monday's stern intervention warning. Plus, Danish pharma giant Novo Nordisk wins approval to sell a pill version of its blockbuster Wegovy drug in the United States. The company's CEO joins Bloomberg TV later today.
Well, Anna, it's 2 sleeps till Christmas, and that Santa rally does appear to be taking hold. You've got global stocks on a tear. Futures pretty flat this morning, but don't mind that. It looks like it's going to continue, as it usually does in these last 2 weeks of the year. As you say, gold hitting another record high, and we have the yen strengthening for a second day on those comments from the finance minister to Bloomberg TV. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. Welcome to Bloomberg TV. So, Lizzie, we have a lot to talk about when it comes to an end-of-year possible Santa rally in stocks. Certainly gold is getting a boost. And the fact we've got gold and stocks moving upwards at the same time, it's been a feature of this year's markets. It's been a feature of actually just the end of last year's markets, ever since inflation was something of a market concern and a market worry. But this dynamic has taken gold to its 50th record in 2025. It's up 70% year to date. It's having its best year since 1979.
Yeah, part of this is the rate cut bets, of course, stoked partly by the governor of the Fed, one of the Fed governors, Stephen Myron, speaking to Bloomberg, saying that you'd get a recession if the rate cut bets don't materialise into actual cuts next year. In terms of global stocks, of course, it is a shorter than usual trading week. I'm very excited about the end of this week, can you tell? But yesterday was significant because you had stocks erasing their December losses stateside, and so now the S&P up for an 8th straight month.
Yeah, absolutely. So we've got stocks and precious metals gaining at the same time. Silver, of course, also having a very strong period, waiting to see what tariff impact we get from the Trump administration there. But in terms of gold, it's a well-rehearsed list of reasons why we're getting higher on the gold price. Of course, geopolitics is in there, rate cut expectations, as you were referencing. But there's also this question of Fed independence and the debasement trade, whether the markets are going to be increasingly concerned about maybe the United States, but maybe more broadly, developed markets and their debt levels, and whether that means that you need to seek out other kinds of havens other than the dollar, for example, or developed market debt. And so that takes us into gold, and certainly central banks and ETFs have also been leaning in that direction. So that's precious metals. Shall we deal with some more of the FX moves this morning?
Yeah, because the yen very much in focus. It's up for a second day. I'm just checking on it. It was 156 per dollar the last time I looked, and that is where it is at the moment. As I say, we had the Japanese finance minister Satsuki Katayama saying to us that Japan has a free hand, the wording very important, to take bold action against currency moves. So that's the strongest warning yet against traders betting against the yen. And we have this fantastic piece on the terminal, the Trader's Guide to Japanese policymakers' language on the yen. They say, first of all, you get commentary on where the market's at, and then they start warning about an intervention. I feel like it's a parent's way of telling the child off.
Or it's some kind of DEFCON scale in another field of life. But yes, you go from this sort of what we're watching description to levels of discomfort to action being possible to action being imminent and needed. And I'm not entirely sure where we are in that, where free hand fits, but it certainly has some an active sound about it. So maybe we're towards the end of that. And certainly we are reminded by colleagues that intervention in 2024 happened 4 times, and it was always around the 160 level. So we're not there right now, and Japanese officials will always deny that there is a particular level they're worried about. It's more about the speed of change, the volatility that they see in FX markets.
Yeah, we should also say that it was partly the euro's strength that helped because of the dollar weakness on the flip side, and then yen strength on the flip side again of that. But of course it is, as I say, a light pre-Christmas trading environment. Nonetheless, dollar weakness seeming to persist.
Yes, and this is certainly having an impact on JGBs, where we've been concerned about yields. Those yields are coming down. Let's talk about some corporate news, where we have a bit of news flow to talk about this morning, Lizzie, and this is in the shape of Novo Nordisk. So the ADRs over in the United States were up by nearly 8% by the close of that trading because they have received US approval for a pill version of Wegovy. And of course, this is all about taking the competition back from Eli Lilly. So they've been in this fierce battle with Eli Lilly for market share, in particular in the really important US market. Now, if they start selling their pill version in January, which is what they've been suggesting, then that crucially gives them a few months advantage over Eli Lilly, who have a drug coming, an oral drug coming, but not until the spring. And so we are looking at that battle heating up in the first quarter of next year.
Yeah, so they've got the approval for the US. They've applied for approval in Europe and other parts of the world. Shares indicated higher on Tradegate ahead of the session. And of course, if this can boost Novo, so crucial to the Danish economy, could have serious economic consequences for them if they can get back, as you say, in that race against Eli Lilly.
Absolutely, and a lot of the focus in the States will be on the pricing of this. Politically, that's going to be a really important conversation, so they're out there already with some information about how this works in terms of pricing under insurance policies, but also if you're paying for yourself, and also the distribution channels. Will it go through the usual distribution channels, or will there be more direct to consumer, of course, with medical oversight? But that's where we are on the Novo Nordisk story, and we have a CEO to talk about then.
Yeah, indeed,
with that in mind.
very CEO, the Novo boss, Mike Doodstart, later on will be appearing on Surveillance. That's at 1:15 p.m. London time. But after that, we'll get at 1:30 p.m. London time US GDP numbers and durable goods. Then at 2:15 p.m. US industrial production numbers. At 3 p.m. US consumer confidence figures. And then at 6:30 p.m. UK time, a Bank of Canada policy summary.
Yeah, I mean, in terms of the consumer confidence, this is Conference Board consumer confidence, of course, so we're expecting that number to go up from 88 to 91, so we'll see if we get a pop higher there. We're expecting industrial production to stay exactly where it was. Durable goods orders, I find this interesting because we've got so much capital expenditure being devoted to AI build-out, so, you know, if you take out transportation, for example, what does that mean for the broader durables investment conversation? Well, we are expecting that number to come down from 0.6 to 0.3%. So we might be near the end of the year, but there are a few data points still to watch for. Lots still to talk about then when it comes to our guests on the programme. I'm really pleased that we've got Jordan Rochester with us from Mizuho, fixed strategy head. So we'll certainly get into a conversation about the yen and JGBs in the wake of our interview with the finance minister over in Japan. Rufaro Chiriseri will be with us, RBC fixed income head for UK and Europe. Not a great deal of progress, it would seem, coming out of that French cabinet meeting yesterday, but still French debt in focus for markets as we head into next year. Ben Gutteridge, Invesco portfolio manager, will be with us with thoughts about 2026. And Christopher Evans joins us, the Collinson International CEO, to talk about exclusive travel. I guess is one way to sum that up. Access to lounges whilst travelling.
Lovely. Just what we need at Christmas. Well, here's what else you need to know this morning. US President Donald Trump has warned that the Venezuelan president warned him not to challenge the US. At a press conference, the US president was also asked what he plans to do with the oil tankers and cargo seized during the continued blockade of Venezuela.
The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it.
Where's it going? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
Here in Europe, new car registrations ticked up for a fifth straight month in November, putting the region on course for a fourth year of gains. According to the European Automobile Manufacturers Association, buyers registered 2.4% more vehicles from a year earlier, led by growth across electrified models. Spain and Germany recorded the biggest gains among major markets. And finally, Larry Ellison is throwing his personal fortune behind Paramount's bid for Warner Brothers, providing an irrevocable personal guarantee of more than $40 billion. The aim is to give his son David the edge in the takeover battle with Netflix. The Warner Brothers board had previously urged shareholders to reject Paramount's bid, but says it's now evaluating the amended offer. Isn't it nice to have the world's fifth richest man as your daddy?
Well, and backing your deal, yes, importantly. And this is important, actually, the way that this is being done now, the fact that he's stepping in, throwing his personal fortune behind the Paramount bid, because it could actually make quite a big difference to the Warner Brothers perspective on the Paramount bid, because they previously said, they previously rejected that offer from David Ellison and co. Because it relied on equity finance with a revocable, not irrevocable, but revocable trust that could, as the name implies, be withdrawn or amended at any time. And so that didn't give the board of Warner Brothers sufficient confidence that that actually was worth relying on. One assumes that this guarantee would be.
Well, yeah, notably neither Netflix nor Paramount's upped their bids yet, but Netflix has done some stuff to its financing as well. It's refinanced some of its debt to try to keep that investment grade listing. So Paramount via Ellison doing his bit as well to shore up the bid.
Yes, absolutely. So we'll look to see what kind of response we get from Warner Brothers as we go through the end of the year and into next. Coming up, we've already been hearing a little bit about European new car registrations. Well, those new car sales rise for a fifth straight month in November, with lower-priced EVs gaining more market share. Bloomberg's Oliver Crook will be back with us with the details on what we need to know about the auto sector right now. Plus, Michael Saylor's Bitcoin treasury company Strategy raises its cash reserve to $2.19 billion and pauses purchases of the cryptocurrency. What does that mean for Bitcoin? We'll take a look at whether Bitcoin has the ingredients to rebound next year. Up next, we'll have more on Japan and possible yen intervention and take another look at wider markets with Jordan Rochester from Mizuho. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
We are 46 minutes away from the opening trade, and futures are pointing a touch lower here in Europe. It's not big moves, really, when it comes to US futures, either flat to the downside as things stand. But this is in the context of global stocks actually up for a fourth straight day, and it does look like that Santa rally is starting to take hold. So don't be too discouraged by the futures picture. Elsewhere in the world, we have a focus on Japan, of course. The finance minister earlier on just warning that issuing her strongest warning yet to currency speculators, telling Bloomberg exclusively that officials have a free hand to take action.
まあ為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have
an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10-yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I
can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market, did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
By
switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
Japan's finance minister there speaking exclusively with Bloomberg's Takashi Umekawa. Great conversation there and a perfect place to start with Jordan Rochester, a fixed strategy head at Mizuho EMEA. Jordan, really nice to have you with us. So let's lean into your knowledge of the yen and JGBs and what's happening here. We've heard from the finance minister then talking about that government, the Japanese government, having a free hand. How much of a signal is this to you that there's going to be some kind of intervention to stop the weakness that we're seeing in the yen?
Well, as interviews go, that was gold dust for FX traders. The Bloomberg reporter there asked all the piercing questions that we wanted to know. Does the Japanese have a free hand to go ahead with intervention from the US, the sort of nod of approval if they need to go ahead? And the answer is yes. So that's kind of the news information for me there. There was some uncertainty whether Scott Bessent in the past had said that the BOJ was behind the curve in rate hikes, so we weren't sure whether he was going to approve FX intervention without more aggressive BOJ hikes. That's probably the most informative part of that interview for me. But there's also the other points about how in the past you had the Ministry of Finance's FX chief Kanda-san said around a 4% move over 2 weeks. Your reporter said 10 big figures, something similar to that amount, was a disorderly move and that would trigger intervention. Well, she didn't really put the same sort of benchmark on it, so we perhaps don't need to use that metric all the time to figure things out. And also the point about the levels of dollar yen being detached from fundamentals. at the moment, if you use interest rate spreads, absolutely, dollar yen is detached. It should be trading more like 151 or even lower. You could argue in the low 140s if you were using the classic 10-year FX spreads on swaps. But when it comes to the Japanese and whether they will intervene, for us, it's more about the level, and it's around 158 to 162 that the market has in its mind for when FX intervention will happen or could happen, because those are the levels, Anna, that they did it back in 2024. Now, over Christmas, this is fin trading. If they were to intervene, they'll get a lot of money, a lot of bang for their buck. You could at least see a 3% move lower in dollar yen historically on these interventions in low liquidity sessions.
So, Jordan, yes, I was going to ask you about whether it is the level or the pace of change or the volatility that we see that you think is still front of mind. Now, we have a new administration in Japan, as you pointed out. There are certain things we can rely on from the previous administration and maybe certain things that are evolving. So previously, they've said it's not about the level, it's about the volatility. Is that just a bit of a smokescreen? Do FX traders just still think it is about the level and it's about 160?
They would say it depends. If we got to 162 during the Christmas session, then it's going to be a volatile move. So the level and the volatility are tied. Obviously, if we creep up there over the course of 12 months, it's not exactly alarm bells for the Ministry of Finance. So it really depends, Anna. But I'm talking more specifically over the next few weeks. So if we were at 162, you could argue that's a pretty outsized move over a session where there's not much information to get us there.
And just staying with Japan, Jordan, do you expect the weakening of Japanese government finances to be temporary, as the finance minister just told us there? Or what is it that actually brings foreign buyers back to JGBs?
Well, actually, there is tons of foreign buyers in JGBs. They are holding up the JGB market. Something that is not discussed enough is that actually there's a buyer's strike amongst the life insurance and the sort of less so the pension fund industry, but we've had net selling of ultra long end JGBs from the life insurance companies domestically. And who's been mopping up that supply? It's been foreigners. And that is why JGB yields have been edging higher, as foreigners demand higher yields. It's also another problem. It's why dollar yen has decorrelated from interest rate spreads. It's because foreigners are FX hedging their exposure and getting a big pickup in the FX carry as a result of that. And if you look at a sort of 30-year JGB, a US-based investor is getting close to 6.5% after doing a foreign exchange hedge. So that's why dollar yen is detached from its interest rate spreads, because the foreigners are involved in big size. Historically, we've never seen anything like it. And the FX hedge is making it detach the sort of classic correlation between fundamentals and foreign exchange.
OK, really interesting. We also got some comments from Isabel Schnabel yesterday saying that, this is at the ECB, of course, saying that she doesn't expect rate hikes in the foreseeable future. What an about turn, Jordan. We had such a repricing after her last set of comments, indicating that hikes would be the next direction of move. When do you expect the ECB to pivot?
I think the pivot will probably come in the second half of next year when they start talking about the idea of rate hikes in 2027, probably Q4. The sort of story for Europe has been that we've been very gloomy for years. And the mistakes I made in 2025 was being too gloomy on the ECB, probably in the first half and maybe Q3 as well. And what's clear to me now is that the German data is going to significantly outperform those gloomy expectations, especially thanks to the fiscal spending. And we've just had a cutting cycle, Liz. So what tends to happen at the end of a cutting cycle is you're on hold for a while and the next move is a rate hike. Because of the recency bias of the sort of lost decade of inflation and QE, we're all sort of thinking maybe it's not going to be such an aggressive hiking cycle. But I can see it's quite possible. 2027, the market will be happy with the idea of higher interest rates for the ECB.
Yeah, what does the German economy, what's the upside risk, I suppose, for the German economy, Jordan, in 2026, given the amount of fiscal spend we're going to see on infrastructure, on defence? How are we going to see that shape the German story?
Well, the upside is that we're seeing this big spend on defence and infrastructure, and I'd expect to see that in the manufacturing figures. But what we're actually seeing is, yeah, sure, manufacturing has been supported in the surveys, but it's the services sector that has responded more in kind to the sort of optimism in Germany. Is that connected to the defence spending, the sort of ancillary services underneath it? You need engineering works, you need sort of contractors. Is that due to the infrastructure as well? Similar story, the ancillary services. If that's the case, Anna, if the service sector rebounds, that's the largest employer rather than manufacturing for Germany, because the manufacturing story is pretty miserable for Germany. They've got industrial production recession, really. The other upside is peace in Ukraine and Russia. That could see massive drops in natural gas prices. The UK stands out as one of the worst in terms of highest electricity prices for manufacturing processes in the OECD. Germany's in number 2 spot for that, so it's not really a good place to be. So if energy prices come down, maybe that's another upside for Germany. Whilst that would be a deflationary story for the ECB, it would definitely boost growth. And it'd be a nice Christmas treat as well for everybody. You can wrap up your Christmas presents, pass over your teddy bears to family and friends. That's the sort of moment that the market's been long waiting for. If it was to happen, you'd have a reconstruction effort for Germany. Lower inflation initially, but you could see a big rebound in optimism.
What a thought, Jordan. I just want to end on the UK briefly, because we had that perhaps unexpected vote split from the Bank of England, less dovish than we might have thought after the inflation reading. What is the bar for the BOE to cut rates again? When do you expect them to move?
Well, they're now off the sort of gradual cycle that they were, and they've made life more complicated for themselves. Personally, I think Andrew Bailey should have gone ahead with a rate cut in November. He just was wanting to hold out for that budget to see what it would do. And the budget's done exactly what we thought it would do. It's done a fiscal tightening. It also lowers inflation next year with targeted measures on energy prices. It could knock off around 0.3 to 0.5% from the Bank of England's inflation forecast. We didn't get an update of those forecasts at this meeting, even though they will internally have seen some numbers. What I can see happening is I think they go ahead and do a rate cut in February. Now that is not priced in at all. It's around 2 basis points or less. And I think that's a high conviction view for me. We've got a CPI figure, we've got a labour market report and a PMI. It would get the Bank of England back on their quarterly path, which they shouldn't have deviated from in the first place. And if you read the individual members' vote splits, Catherine Mann could have even voted for a cut at this last meeting, so it's possible.
All right, Jordan, great to see you. Merry Christmas. Jordan Rochester there, fixed strategy head over at Mizuho EMEA. More next. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Welcome back. 30 minutes from the start of cash equities trade here in Europe, and we have here on the opening trade a look at the futures picture for you, and it looks pretty uninspiring, pretty flat this morning. We've got this narrative around a global Santa rally taking place in equity markets. Is that under threat a little bit? US futures are a touch weaker, down 0.1% on E-minis and Nasdaq futures, so we'll keep that in mind. That said, I mean, there could have been reasons for European stocks to go higher this morning, Lizzie, because we actually closed out the European session with a little bit more to go in US stocks to the upside, but not a huge amount.
Well, in your bond space this morning, let's check in on that. We have the 10-year bund yield down 2 basis points at 2.88. With similar moves across the rest of the curve and across the continent. But if we focus in on French bonds, they have been slipping as the nation's 10-year yield was pushed to the highest level since 2011. So that's the broader context. Of course, the political backdrop is that the French government's urging lawmakers to approve emergency legislation to keep the state running. We can get more on this now round the desk with Rufaro Chiriceri, who is head of fixed income for the UK and Europe over at RBC Wealth Management. Nice to see you, Rufaro.
Good morning.
Let's start with French bonds because, of course, you've been underweight OATs for a little while now. What's your kind of outlook over the coming months with all of this political turmoil in the backdrop?
So generally, our view for France is we've been underweight since sort of the start of, I suppose, the fiscal troubles that we'd seen, and we continue to see sort of French bonds trading with some sort of premium around that sort of fiscal and political stability aspect. And we have seen now that Italian BTPs are now actually trading through French OATs. So that's just a reflection of just a risk sentiment in the market. So that continues to be a view of ours for some time.
But is it that much different to other countries? I mean, I'm thinking about the UK, right? And I'm surprised, perhaps unfairly so, whenever anyone comes around and says that they're up for gilts, when, you know, I've got to focus on the May elections next year, and I'm hearing so much uncertainty about whether Keir Starmer, the Prime Minister, will still be in office in the summer next year. How does your OATs view compare to that for gilts?
Well, we're actually a lot more positive for the UK. So we think some of those fiscal troubles, I think they're sort of behind the UK. We've now have a much bigger headroom than we previously had. We've also got the budget itself is not necessarily too inflationary. It's actually taking back away from inflation. And it's also not sort of taking away from growth too much either. So we think some of those fiscal concerns are now behind us. We also have issuance that is now skewed more towards the short end, which is positive for markets, given that sort of longer end demand is now diminishing. And we also have a profile that is a lot more attractive for the UK in terms of more easing from the BOE. So we think gilts in that dynamic have the potential to outperform.
But where that fiscal consolidation's been backloaded, you have faith that that's going to actually materialise?
I think what we've seen from the budget and from the comments from the Chancellor is that they're pretty much sort of with the view that fiscal consolidation does need to occur and they need to show some restraint. And I think with some of these measures that we've seen, that the market is now believing that. So we think actually the fiscal picture is not too much of a risk for the UK at the moment.
OK, Rufaro, good morning. So sticking with this European theme then, I mean, European Central Bank, your outlook there is that we get no change in interest rates in 2026, and that seems to be quite consensus. Lots of people saying that. What's the risk to your view? Are you concerned that actually maybe there is some inflation or growth outperformance risk because of what Germany is doing, or is there some risk of underperformance?
I think that the risks are sort of two-sided. I think if we look at it on the angle where perhaps if there are some delays in some of that fiscal stimulus coming through, then of course that growth picture doesn't look as good as currently forecast. We actually think growth is going to be about 1.6% in the euro area next year. But I suppose part of the aspects around that is if inflation does undershoot quite meaningfully from the ECB target. We can see that the ECB has some tolerance around that, but if we continuously see, I suppose, large downside surprises, then it may start to make the ECB think that perhaps inflation is now getting too far away from their 2% target. But for now, it seems like there's a fairly high bar for tolerance for movement around that 2% target.
And so that's the risk, is it, that inflation undershoots? And what would drive that? Would that be because of imported goods from China, and there's that risk that China exports its deflation not so much to America but to other parts of the world now? Is that the driver that you're concerned about?
We think there could be multiple drivers. It could be partly to do with, say, perhaps if it's a weaker growth outlook, that just naturally sort of draws down demand and inflation in tow. It could also be a stronger euro, potentially, or it could be also that influx of imports coming into the region. And perhaps some of the aspects that we sort of thought about the growth story is really that decline in savings that we're going to see from households. And if, say, households do continue to hold some of those savings and not spend, then perhaps that sort of doesn't feed into that stimulus look that we're sort of thinking about.
What about the Bank of England? We were just discussing the last vote split with Jordan Rochester there. Why do you still see 3 more cuts from the BOE in 2026 when surely what that vote split last week taught us was that the hawks are really stubborn no matter what's happening on inflation?
So interestingly, I suppose on the surface with that 5-4 split, it does sort of seem like that there is still quite a strong hawkish cohort. But when we sort of look through the comments, we can sort of see from the 2 hawks, their language has softened a little bit. And so we think that language softening a little bit. Then we also look at the doves, the most dovish members, their languages also sort of become even more dovish. So I suppose perhaps sort of looking through the comments, it is a bit of a tricky time in terms of for the BO to determine where that neutral rate should be. And I think part of that is sort of what's feeding into perhaps what we've seen in the vote split. But we do think that weakening growth outlook into next year, we continue to see the labour market continuing to loosen, that feeding positively into wage inflation. We think the BOE in that scenario would actually ease more than what's currently priced in the market.
Yeah, Catherine Mann's been warning about higher inflation expectations, that feeding into wage demands. Why are you less concerned about that?
I think part of that is that we had seen that some of these household inflation expectations have been running around 4% for about 6 months or so, which is a fairly high level. And of course, that was feeding through from food inflation. So we started to see that come down. And so perhaps maybe that's why we've seen a bit of softening in language from Mann in the statement, just in terms of perhaps some of those risks are starting to diminish. And that's one of the risks that we've seen, that if household inflation expectations continue to be somewhat anchored where they are, that can potentially keep pushing sort of wage pressures.
So, Rufaro, some of these narratives are very domestic, some of these markets are very global. So let's think about the global influence. Thinking about US growth, for example, and where you see that going. Q3 GDP 3.2%. You actually see upside risks to the growth story, though, going into 2026. That sounds to be in contrast to the downside risks that you see to inflation in the Eurozone. So what's driving that sort of discrepancy? Is this all about the AI trade and what that might deliver?
I think there are a number of aspects that we're thinking of for growth in the US. You have some of that fiscal stimulus coming through. You have some of that deregulation. You have some of that fading away of, I suppose, some of the tariff concerns. And, of course, the AI CapEx boom as well. So we do think we'll see sort of trend growth in the US next year. And we also continue to expect that the euro area next year will also have pretty decent growth as well.
And the Fed, will they keep cutting? We had a couple of conversations yesterday with people saying to us, next year's not going to be half as much about central banks. It's going to be much more about fiscal actors. We talked a bit about the fiscal stories here in Europe. Will that same narrative play out in the States? What will be the relationship between the Fed and the fiscal?
I think there'll be key focus on both aspects. I think we're expecting sort of some of those aspects from the One Big Beautiful Bill to sort of filter through. There've also been discussions about some of those tariff rebate checks and sort of some of those sort of aspects that may be fiscally stimulative. So we think that will continue to be a big focus for the US. But then also more so around what is the Fed going to do. We're seeing quite a big dispersion in terms of where the Fed expects rates to be next year. And we continue to expect one more cut from the Fed next year. And think that'll be in the first half of the year rather than in the latter part of the year. We think it'll become a bit tougher for the Fed to continue cutting rates into the second half of the year, into next year.
OK, thank you so much. Thanks, Rufaro. Thanks for joining us. Rufaro Chiriseri, Head of Fixed Income for UK and Europe at RBC Wealth Management. Well, thinking about the US and views on where the Fed might go, Fed Governor Stephen Myron says the central bank risks sparking a recession unless it continues lowering interest rates next year. He also told Bloomberg that data on housing costs was impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown, but it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that, just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We've got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, you know, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech at Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's the kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance? So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
Fed Governor Stephen Miron speaking there, warning that unless there are more rate cuts, there could be a recession, Anna. I thought it was really interesting speaking to Rafaro a moment ago on the Fed, and her saying that actually she expects the Fed to cut in the first half of the year, not the second. And that's the opposite of what lots of analysts are saying, that if there's an expectation of a dovish replacement for Chair Fed Powell, Jerome Powell in the second half, that actually Powell himself will try to hold back the FOMC in the first half.
Well, yeah, let's see. The timing of those meetings and when that new chair wants to make their mark, I suppose, is part of it. It will be interesting to see. I mean, I liked Anne-Marie's question, actually. I thought that was really interesting about cherry-picking from data, and I wonder if that's just increasingly, if we are in a slightly more politicised world in central banking broadly, if politicians are going to be more outspoken with their views on what central bankers do, are we going to see central bankers falling into that trap of maybe perhaps cherry-picking a little bit from some of the data?
And that's the danger when you have flawed and delayed data, isn't it?
Yes, certainly with that inflation print, that could tell you anything you wanted, basically, because it was so flawed and so partial.
More easily write it off. Well, coming up, we're going to get back to the corporate story, turning away from central banks for a moment. Novo Nordisk winning approval to sell a pill version of its blockbuster obesity shot Wegovy in the US. It's just one of our stocks to watch. That's next. This is Bloomberg.
game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation. Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Welcome back. This is the opening trade at 7:46 in London, which means 14 minutes until the start of the trading day for Tuesday, the 23rd of December here in London. And European equity market futures looking flat to negative. That's kind of in keeping with what we're seeing stateside, where futures are a little bit weaker. Let's talk about these markets with Adam Linton from Bloomberg Markets Live blog, who joins us on set this Tuesday morning. Adam, very nice to have you with us today. So let's start with what we're seeing in bond markets here in Europe. They've been trading for 15 minutes or so. Yields a little bit lower this morning, and sort of maybe unwinding some of the higher yield narrative that we've been dealing with over the last couple of weeks. Some of it sparked by Isabel Schnabel, and then she was busy speaking again yesterday. What are we thinking about the European bond market story?
Yeah, I think at the front end, yields could potentially be capped for now. I mean, a lot of it, part of the story, obviously, has been global dynamics as well, but a lot of it has been some of these remarks we did see earlier in the month for Schnabel, potentially talking about the prospect of a rate hike sometime in 2026. And, you know, we've kind of seen her walk these comments back to some extent, and she's basically more kind of wants to make the point that she doesn't think there'll be any more cuts, but she wasn't necessarily making the case for hikes. And then also, I think a part of the macro narrative that we've kind of seen over the past week is some people got quite excited about this Bundesbank report, saying we could see markedly stronger growth in 2026. But if you look at some of the Bloomberg survey data, economists are actually a lot more measured in their expectations for what we could see in the first half of the year. So things, you know, like domestic demand that could potentially be relatively weak. And as I've kind of mentioned previously as well, some of the structural issues facing Germany still linger. And also these fiscal plans, given the government situation there, they could also face a bit of a delay in implementation.
OK. I do wonder if someone's had a word with Isabel Schnabel. She wants to throw her hat in the ring to be the next ECB president. I wonder if someone's told her off for being too hawkish. But that aside, Adam, you've had the yen moves as well that we were discussing earlier in the programme, the euro strength helping the yen. Do you think that there's too much optimism priced into the euro at the moment?
Yeah, I think that is fair. I mean, part of it, obviously, that, you know, I mean, I've been kind of downplaying this rate hike story that we're looking at for 2026. I think that part can be parked as well. But a lot of it is, again, upbeat view of European growth. And I think 2025 has been a year of Eurozone resilience. But I don't think, you know, the economy is running hot. I think there's severe problems in Germany. The France fiscal situation is a source of concern. And also as well, we're not out of the woods on tariffs. Yes, we've been more resilient, but, you know, we need to see how what the longer, medium-term effects of these tariffs are, because they're facing an unfavourable trade situation, and I don't think the market's really pricing that at the moment.
You're quite constructive on the dollar. Is that because the US does well or badly? Because you can make links between either scenario to dollar gains.
Yeah, I think I'd say I'm constructive on the dollar because of, relative growth prospects. I mean, if you look at a product like Dixie, basically that is almost a trade on euro-dollar with a bit of yen thrown in. And, I think, OK, we've seen a bit of yen strength creep in recent sessions, but I don't think that's going to be sustained. And then I think, the US growth outlook, I think, is a lot more upbeat than that of the Eurozone. And I think that's a trade that kind of will potentially focus minds next year. And if US growth does hold up quite well, that could potentially temper some expectations for Fed easing in 2026. And I think that will be reflected in the dollar.
Just finally, given your view on ECB cuts, where would that leave European stocks in 2026?
I think the problem for European stocks is a lot of the upside has been driven by this phenomenal rally that we've seen in financials. And so I think you're looking for, potentially European stocks to try to extend from somewhere. And I think that source of strength will potentially wane because it's been on such a long run. And also the lack of IT sector is also a problem for Europe.
All right, perfect. Adam Linton, Bloomberg's Live blogger Adam Linton there. We thank you so much. And let's dive into some of those individual stocks that could be on the move at the European Cash Open. Louise Moon is here with that. Louise.
First one we're looking at that's really in focus today is Novo Nordisk, the Danish pharmaceutical companies. They've won approval for a pill version of their blockbuster obesity drug Wegovy, and that's in the US starting from January next year. You can see, this is really crucial in their kind of fight to stay competitive against their US rival Eli Lilly. You can see how much divergence there is between their stock prices this year. We've got Eli Lilly in the white at the top and Novo down below, really lost in their share price so far this year. So expect this to be a bit of a boost. So that's going to start from January next year. They've also put in approvals for Europe and elsewhere for 2026. So we'll expect this to be a bit of a boost for Novo today. Some good news in terms of their progress into the US market. Next one we're looking is Ørsted, the Danish wind company. Now, some potentially some news that's going to weigh on their stock today. The Trump administration has banned leases for all 5 wind farms off the east coast of America that are currently under construction. And this is a big deal. Their total commitments are about $28 billion. It's been a tumultuous year, and this is kind of the latest, I guess you could say, almost attack from the Trump administration on clean energy. And this has really been hitting Ørsted. You can see this, there's this big slump in August on various things that have happened from the Trump administration towards the industry, and this could weigh on their stock today. But there was this note from Jefferies analyst saying that the language used and prior experience should bring some optimism that the projects potentially could restart quickly. So we'll have to wait and see how that pans out. But for the moment, the likes of Ørsted, Vestas, you would expect to see their stock kind of dropping on that news this morning. And then the final stocks that we're looking at are European automakers. Now, this is on the back that new car registrations rose for the 5th straight month. You can see these gains that we've been having for the last few months, and it would put Europe on course for the 4th straight year of gains for new car registrations. So good news for the industry, and this is all being led by electric vehicles. So you'd expect this to benefit the likes of Volkswagen, Stellantis, Renault, BMW. They've had a bit of a mixed picture so far this year, but expect this to be a bit of a gain, and it kind of adds to wider recent relief for the industry. So we'll be keeping a close eye on those today.
OK, Louise, thank you very much. Our equities reporter, Louise Moon. And important to point out, Louise was right that we are focused on all of those sectors, including the wind sector, but important to say that story broke in the middle of the European trading day yesterday. So we saw some impact on Ørsted already. So I guess the question for today is whether we see another day of losses or whether we've seen all the selling around that story, whether there's more to come, whether the market thinks that's it. They're happy to linger where they are right now.
Yeah, and it's interesting that 2 of those stocks to watch are Danish. I was also just musing about when I was covering Donald Trump at his golf courses in Scotland and just how much he hates the wind farms.
Yes.
So perhaps unsurprising that we got that decision for all. exhausted.
Yes, and this time it's around security, national security concerns, isn't
No,
it?
but
About
he
the way
thinks they're an eyesore.
Well, that too. There is that. But this particular story is about national security, according to the US administration. So we'll watch that sector. We'll watch Novo Nordisk as well, because this, again, another US story and another US mover in yesterday's session, actually, but after hours over in the US on the ADRs. So we'll watch how that translates into the European session today.
Yeah, I think it's about 7% the moves on the ADRs, but compared to a 44% drop overall so far this year. So let's see if Novo can reverse some of those moves today in its competition with Eli Lilly, this big development here for Novo.
Yeah, absolutely. And so who gets there first with the pill form of, Wegovy, as it's called in the Novo case, who gets there first with the pill form is going to be important. And so January is the target date for Novo. It seems a little bit later in the year for Eli Lilly, so maybe that gives a few months head start to Novo Nordisk. So we definitely have a Scandinavian flavour to things this morning. We'll keep an eye on all of the Danish-listed businesses that we've been talking about, and we'll get an update on some of them from our team in Copenhagen a little bit later on in the programme. Coming up then, we'll bring you that opening trade here in Europe. We've got European equity markets then for Tuesday the 23rd of December, looking as if they could open flat to negative. That's what the futures picture has been looking like. US futures are pointing a little bit weaker this morning. We'll see whether that Santa rally story of yesterday comes back to markets or not. The sun really trying to rise here in London, struggling a little. This is Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. Now, a few minutes to go until we get the opening trade for European equity markets. So often useful to cast our minds back to yesterday's US session and see where we were when Europe closed up. Well, that's what is indicated by the yellow line. So Europe closed as the US markets were heading higher. Could there be slight room for improvement here for European stocks this morning? Not really. I mean, US stocks pretty much drifted after the European close in a sort of sideways direction. Is this all of the Santa rally we're going to get, Lizzie? I can't quite believe it. Maybe we've got another day or two in us in terms of the positivity in global stocks. But we do seem to be quite positive. We've seen stocks rallying globally, new highs for global benchmarks around equities, new gold highs, a 50th new gold high. So those two things going together, which isn't always the case. This is the futures picture for European markets. Then we are expecting a little bit of downside, but should we call it flat? That looks pretty flat to me at the start of trade. What have we got in terms of stocks and sectors in focus?
Yeah, if we're not going to get big moves on an index level, let's look at the stocks. Novo Nordisk in focus this morning, Anna. It's got US approval for its Wegovy obesity pill. It needs this, of course, to defend its market share from Eli Lilly, which has said that it's going to have its own oral obesity pill approved by March. So Novo potentially getting a few months head start here. Novo ADR's up more than 8% after hours, so keep an eye on them. Staying in Denmark, Ørsted, flagged by Louise Moon here, and generally the wind stocks after Trump banned leases for all offshore wind farms off the east coast of the US. And then the autos as well. We had new car registration numbers for Europe this morning, ticking up for a fifth straight month in November, really putting the region on course for a fourth year of gains. So keep an eye on the autos names at the open as well, Anna.
Yeah, we'll certainly keep the autos in focus. We'll get an update on that sector shortly from Oliver Crook. On the wind stocks, we'll keep saying Ørsted, of course, was down more than 10% in yesterday's session on that story. So the question today is really about whether we get another day of weakness for wind stocks on the back of that further regulatory headache in the United States for some of those offshore wind farms. So European equity markets are opening, and as is appropriate for this time of year, a little slowly perhaps, but the FTSE 100 down by 0.1%. The Stoxx 600 overall, though, up by 0.1%, waiting for the other markets around Europe to open up, keeping our eye on those wind stocks for another day, seeing if we get another day of weakness there. We'll see if we get a big pop in Novo Nordisk, pretty heavily weighted still, despite the year-to-date drop that we've had. So I am being told we have got to move higher in Novo Nordisk, as you'd expect from that story that sent the ADRs higher in the United States, or after hours, I should say, in the US yesterday. The IBEX down by a 0.1% or so. The DAX pretty flat. So overall, we are flat, Lizzie, on European equity markets. What are you seeing in terms of sectors and individual stocks?
So Novo, as you say, Novo up 6.5% at the moment off the back of that approval for its obesity pill. Ørsted down again by 1.5% as things stand. And we can take a look at the rest of the wind sector in just a moment. But looking at the sectoral breakdown across the continent, you've got just over half of sectors in positive territory this morning. Healthcare leading the gains today, up 0.8%. Real estate about 0.25% higher this morning. Autos, though, at the bottom of the basket, that's down 0.4%. I'd have thought it might be higher given the positive news that we got in terms of new car registrations. But if you dive into that sector in particular, some of the names, Mercedes down 0.4%, BMW about the same, Stellantis managing to eke out gains this morning, up 0.5%. But overall, a negative story for the autos.
Yeah, it's very much a story driven by healthcare this morning, isn't it? So we've got 0.7% higher for healthcare stocks, and Novo Nordisk is the big gainer there, up by just over 6%, followed by Abivax and Genmab. So a very strong day for the healthcare sector, and as you say, autos and auto parts the worst performer.
But quite a bland day when it comes to the Stoxx 600, only up 0.1% this morning, and US futures down 0.1%. Let's get analysis with Ben Guttridge, markets insight strategist at Invesco. Good to see you, Ben.
Well, it's an obvious segue there. It's a bland day, so let's go to our bland guest.
Don't write that kind of stuff, Ben.
Look, I want to ask you about this Santa rally. Is that all we're going to get?
Well, maybe we'll get a bit more. I mean, I think this time of year people will reflect on like their 2026 outlook and more, or the following year outlook, and more often than not, that would be positive. And I think that's like where we're seeing things at the moment. Obviously, we're happy to debate all of this, but would suggest we're looking at resilient growth backdrop. Clearly, job creation is slowing, but not falling off a cliff. Resilient growth. We've got, I would suggest, fading inflationary pressures. Of course, again, you could debate that in the short term with tariff noise, but it's given the cover. The jobs market modest weakness and the more benign inflationary outlook is giving cover for the Federal Reserve to cut interest rates. That has something of a Goldilocks flavour to it, and that leaves us feeling positive about equities in 2026.
Is the Fed going to have to be that dovish if you're so positive about growth?
Well, no, quite. It doesn't have to be that dovish. You would sort of suggest a commitment to sort of pausing on rates could unsettle markets. But if the features that are encouraging the Federal Reserve to cut only modestly is because growth is both resilient and maybe inflation isn't so fast in falling, I think the markets can deal with that. It has sort of dealt with that in the past. We are in a stop-start sort of cutting cycle, and the markets have moved well despite the periods of sort of pausing on those cuts. That's because growth has been okay.
Okay. I love talk of Goldilocks, Ben. This is excellent. It's Tuesday the 23rd of December, and it's not seasonal, but it's positive, and we like to be positive this time of year. So what's the biggest risk to the Goldilocks scenario then? Is it growth disappoints? Is it inflation's actually stickier than expected? Or what could go wrong with the sort of positive outlook? Because we speak to a lot of people who are quite positive about next year.
Well, I mean, I guess I'll be more concerned about inflation. For those who are sort of more concerned about the jobs side, because the trend in job creation is slow to sort of quite little, is that the next step would be sort of negative job creation. The profits to the amount of people who are employed is at pretty healthy levels. So it doesn't look to us as though meaningful job cuts are coming. So I guess it would be the inflationary concerns. The noise around tariffs can put sort of pressure under sort of goods price inflation. Also, I'm sort of minded about the prospect of excessive stimulus coming through. If this sort of Supreme Court prevents tariffs from being employed, I think that's sort of quite stimulative with all combined with the one big beautiful bill. All of that is a very large budget deficit, not much of an offset. That could be inflation. Whilst the market might take some enthusiasm in the short term from tariffs being removed, actually I worry that the bond market might take some fright from that because it could have could be too stimulative and a bit more inflation coming through. Not our base case, hence why we're positive too, and we want to be at this time of year, but certainly a concern for us.
Yeah, let's unpack that a little bit then. What kind of market reaction broadly we might see if the Supreme Court stands in the way of President Trump's tariffs as imposed so far? Because on the one hand, the market might quickly come to the conclusion he'll find other ways to get the revenue. On the other hand, there might be a nervousness in bond markets around the fiscal impact of this, that we don't have the money coming in that the Treasury thought it would. How would you expect that to play out?
Well, I mean, as you so neatly point out, there are some conflicting forces here, but I mean, I would always have been of the view that tariffs are like a tax, and that's deflationary, that's sapping demand, it discourages spending because prices are a little bit further out of reach, and therefore removals of tariffs are like a tax cut and stimulative, and it could be that, that level of stimulus is appropriate because the jobs market is sort of so quiet, but I would have sort of said the state of the US economy is such that it doesn't necessarily need that level of stimulus, and therefore it could be, on balance, inflationary. In the short term, of course, hedge funds having a fun on the day or the week, this is growth enhancing. Equity markets are at it, but I would just be alert to the bond. I think one of the reasons the stock market has done well this year is because the bond market has been relatively well behaved. If the long end of the yield curve starts moving higher, then that's going to be a problem, I think, for equity. So alert to that risk.
Another risk maybe is on AI, or can we just leave the bubble fears behind in 2025?
Well, I wouldn't be of the view that we're in a bubble necessarily. Valuation is not so egregious as we've seen in sort of 99, but I think the market's definitely or seemingly a bit more discerning, and I guess it centres upon free cash flow. It's obviously there's a huge amount of investment going on, and the market has been sort of fully supportive of all of those moves. But at the moment, it looks as though, well, what impact is that investment having on your free cash flow? How are you funding these big investment programs? And so not all of them are winning now. So I'm not talking about a bubble or a collapse of that sector. I just think there's sort of a degree that they're cancelling each other out. It's like if one's winning, then one's revenue is another firm's free cash flow hit. Yeah. So there could be something of an offset, which is, of course, a big part of the US market that's going sideways. Maybe we want to look elsewhere. Sorry.
There seems to be two views at the moment, though, that some people think that there'll be a cannibalisation, and other people think that there'll be a broadening out of the trade, and that everyone can win. More people could win from AI. What do you take?
Well, I mean, that's certainly what we hope, that, that there could be a broadening out, and that these AI infusion could yield efficiency gains across many more businesses, and there are more and more examples of that. Wouldn't sort of necessarily get too excited about that as a means to wanting to overweight into the AI theme, because of course there's such big stocks within that sector that dominate that could have more of a tricky time. Some could perform, but I think some could be weak because of this sort of free cash flow challenge, and because it's such a big part of the American market. Not talking about abandoning that part of the market, but just think about there's some opportunity elsewhere.
Yeah, so you're not really down on the US, but you are looking for opportunity elsewhere. So that brings us to Europe then, Ben, and or even to Asia, and maybe opportunities in China. Where are you seeing the opportunities at the moment then? What most excites you for 2026?
Well, all of the above. How about that? But I certainly think Asia and China is just sort of an improving profitability story. I was not minded to believe that. I mean, it's a few years ago or a year or so ago, a very noble policy choice, common prosperity, for an emerging economy, but that's about limiting pricing power. You hear things about anti-involution, not a phrase I was familiar with up until a few months ago, but that's about limiting competition and enabling pricing power, and you see more buybacks from that part of the market. It's as though management have much more control over the decisions they're making rather than the state. Of course, not all is perfect, but it's just, like against very low expectations, there's just more of a sense that profits are more keen a part of the agenda.
That oversupply story is being tackled, and that actually we might see a little bit of uplift in pricing.
Yeah, that's right. Yeah, I mean, you look at the solar industry in the past, a classic example of China knocking over all competition in its wake, but not doing it by delivering profits. Whereas EVs, maybe AI, certainly the internet giants are casting a shadow over that sort of concern about an absence of need for profits.
So what about Europe on the receiving end of China? Because we constantly worry about the deflationary pressures being imported from Beijing.
Yeah, I mean, that is a concern, and certainly with on the vehicle side, the autos side, maybe we could sort of see something of a response. You'd expect they need to do something to defend. I mean, I guess the businesses themselves haven't been fast enough out of the gate on the EV production side, but policymakers may respond, because that is certainly a challenge to its industrial sector. But there's lots of other positive stories in Europe. Unemployment at very low levels. The ECB has done its cuts. There's decent funding rates. Banks are lending again. There's obviously fiscal support. Europe doing its classic thing of putting up some obstruction in the pace of policies sort of going through, but we still think it's there to be. It will be executed. So there is positive stories in Europe as well.
And Germany, investing around the German theme.
Well, yeah, I mean, I think that is the major sort of source of that fiscal thrust, and maybe the industrial sector's sort of got a little hot, but the fiscal support that Germany is putting through, perhaps it could do it a little faster, is encouraging for us to invest in Europe.
Yeah, the Bundesbank was talking about second quarter next year, so we'll see. Ben, thank you very much. Thank you for your time.
My pleasure.
Ben Gutteridge, Market Insight Strategist at Invesco. Let's have a look at the core six and see where we're trading. I'm going to suggest that Novo Nordisk might be dominating the conversation here. Yes, there we are. Novo Nordisk up by 5.6%. Thank goodness for Novo. We have some substantial corporate news to talk about then this morning. Elsewhere, some more minor moves coming through. Schneider Electric down by 0.3%. Let's dive into some of the details here then. Louise Moon joins us to look at some of these individual stocks. Louise.
As you say, Anna, Novo Nordisk is the story of the day, up over 5%, almost 6%. And that's after their pill version of Wegovy, their blockbuster obesity drug, got approved in the US. So that's the start from January from next year. So really boosting that stock today. That's really the key one that markets are watching today. Another one that's being looked at is autos over in Europe. A bit of a mixed picture, so Volkswagen being dragged down alongside Renault and BMW, but Stellantis being the standout gainer there, up just over 1%. That's after new car registrations in Europe rose for the 5th straight month. So it's good news, led by EVs, but only really seeming to boost Stellantis this morning. As I say, that's the bit of the standout into the green, so we'll be keeping an eye on those. The next one we are focusing on also is Ørsted, the Danish wind company. Slightly dragging down into the red. That's after, as Anna mentioned, this is a bit of a day two. That's after their stock slumped yesterday on the latest the latest move by the Trump administration onto the sector. This is to suspend the leases of all the wind farms off the east coast of America. So staying firmly into the red as markets open today. And then lastly, we're looking at Pets at Home in the UK. They've got a new CEO, James Bailey. He's come from Waitrose, was managing director of Waitrose. So boosting their stock. This is a bit of a positive news for Pets at Home. They've had a tough year. They're in the middle of a turnaround, a bit of a retail turnaround to boost their profits. So this could be seen as, you know, a positive news to end the year, moving into 2026 on a bright note. That's how we like to end the year. Louise Moon, thank you so much, Louise, from our equities team with our movers after the open. And we're going to dive into one of them, and that is Novo Nordisk. Shares bulking up. Who wrote that? An early Christmas present for me. As it wins US approval to sell a pill version of its blockbuster Wegovy weight loss drug. We'll bring you all the details on that stock next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome back. This is the opening trade. It is 8:17 here in London, and the picture for European equity markets. Well, we're making modest gains across European stocks, up by 0.3%. How much does that have to do with Novo Nordisk? That market doing a lot of heavy lifting, it would seem, this morning. The FTSE 100 up by 0.2%. The DAX also similarly a little bit firmer. Let's go to that Novo story, though. Novo Nordisk's shares have jumped after it secured FDA approval for a pill version of its weight loss jab, Wegovy. The pill is expected to launch in the United States in early January. Let's get more details from Bloomberg's Copenhagen bureau chief, that is Sarah Scholin, who is with us right now. Sarah, thank you so much for joining us. So how significant is this for a business such as Novo that's been facing increasing competition?
Well, I think increasing competition is maybe a bit of an understatement for the challenges it's had this year, Anna, but this was very much expected. Novo has already said they expected the FDA to approve the pill before the end of the year, and Denmark is closed for the next 3 days, and then we're closed 2 days next week. So this was about time we got this news. This doesn't take away from them that this is very positive news. They're getting headway on Eli Lilly for about 3 and 4 months on their obesity pill. So we'll give Novo Nordisk this first mover advantage. And you can say that they had this before, right? When they first entered the obesity market, they basically created it. There wasn't an obesity market before Novo Nordisk launched Wegovy and Ozempic. But Eli Lilly quickly really gained up on them. So now Novo Nordisk is back to getting this first mover advantage. It has a new management. It's a bit more aggressive in its way of dealing with the business and marketing and sales. So they might actually be able to leverage and capitalize this first mover advantage better this time. And that's something we will be looking for in 2026.
Yeah, how much do you think it can reinvigorate the share price? I'm looking at it year to date, down nearly 50%.
Well, it definitely needs some invigoration. This is a first step, right? We knew this was coming. They already flagged that they were going to get their approval, probably going to get their approval. But now we're finally getting it. And we've seen with Novo Nordisk over the past year and a half, that they, especially with CagriSema, we got last year right before Christmas as well, that sort of overpromised and underdelivered. So it's really good for the investors now to see they expect something and then we're actually getting it. So the big test next year is going to see if this really can compete with Eli Lilly. It's a really good pill. It gives really good weight gain. The analyst says it has that disadvantage over Eli Lilly's pills that Novo's pill has to be taken with a meal, where Eli Lilly maybe has more flexibility. On the other hand, Novo's already launching in January, and we all need to shake off that little bit extra Christmas pounds that we got over the holidays. So maybe they can really get that headway 3 to 4 months, and that will be the change for them. I think this is a really good first step in health invigorating. Yeah.
Yeah, that's a bit dark, isn't it? The launch in January rationale. I wonder if they've thought about that. What about the pricing story then, Sarah? Because they've given us a bit of detail around pricing, and no doubt this is going to attract a lot of political attention in the United States.
Well, obviously, and they also said they're talking to Hims and Hers about putting them on that platform, and they could set it at a price as low as $25 per month for some of the patients. So obviously, this is something that's going to be out for the broader public. So we're Novo is hoping that this won't get too much pushback.
All right, Sarah, really good to see you. Sarah Scholin, Bloomberg's Copenhagen Bureau Chief, we thank you so much. And we're going to be hearing from the Novo CEO himself, Mike Dooster, that conversation on surveillance at 1:15 p.m. London time. Well, staying in Europe, new car registrations ticked up for a 5th straight month in November, putting the region on course for a 4th year of gains. According to the European Automobile Manufacturers Association, buyers registered 2.4% more vehicles from a year earlier. Bloomberg's Chief Europe correspondent Oliver Crook is with us around the desk. And Ollie, you've been diving into these figures. Talk us through what the numbers tell us.
Yeah, I have to be honest. I love going through these tables and actually getting under the hood with actually what we saw from these sales. No, listen, it's true. I mean, across Europe, as you said, 2.4% increase in sales of cars across Europe. But when you start looking at the actual brands, that's where things start to get a little bit interesting in terms of the actual portfolio of what kinds of cars have been selling in Europe. And this is super interesting, particularly since the Europeans have delayed their ambitions to basically ban EVs. What we're seeing right now is overall the sales in the EU, this is specifically in the EU, year to date, up 1.4%. When you look at petrol cars year to date, they're down almost 20%. Diesel down almost 25%. And that means that they had to make it up somewhere else. Hybrid electric vehicles up 15% in Europe year to date. When you look at the battery electrical vehicles, up almost 30%. So we're in a position now where in the month of November, hybrid vehicles have outsold. Now, this is not doing battery electric. This is hybrid vehicles, both petrol and diesel combined in the month of November. So you're seeing that transition away from these combustion engines, despite the fact that we're giving a little bit more runway to the European regulators. So potentially a bit of flexibility for the car makers is something that is welcome, but they don't really need it. You're seeing the consumers starting to make that transition, at least in Europe.
Yeah, that is interesting, isn't it? The way that the politics means that the deadline for switching has been extended, or, that's the direction we're moving in lots of parts of Europe, and yet maybe at the time that we're getting some momentum from consumers and a bit of a pivot there. So which of the brands that have been not doing so well then, Ollie, the ones that are suffering?
So I'm trying to bring a little bit of all, so the good, the bad, and the ugly. So the good, we had year to date in terms of Volkswagen. It's been a very challenging year for Volkswagen. It's been a challenging year for a number of the car companies across the world. But Volkswagen ups year to date 5.5%. Some encouraging news there for VW out of Germany. Stellantis, which of course has been a bit of a basket case this year, losing their CEO and really trying to figure out what to do with their lineup. Year to date in Europe, sales down 4.5%. And Porsche, going back to the Volkswagen family, down 13% in terms of their sales year to date. If you look actually at the month of November for Porsche, they were down 30%, 29% in terms of Porsche sales just this month. And then sort of going for the bright spot within that bouquet owned by BMW, Mini, up 18% in the month of November.
Interesting. It's only Stellantis that's managing to eke out gains off these numbers this morning. But, Ollie, just talk us through what impact BYD, of course, the Chinese maker, has had in Europe.
Yeah, so we're looking also at the battle of the BEVs. We're looking at the electric vehicles. Who are the ones that are really, truly benefiting here in Europe? And this, we always look at BYD and we look at Tesla. What do we see? Year-to-date sales for Tesla have been absolutely crushed in Europe, down about 30%, 28%. They now have 1.7% of the market share in Europe. That is a diminishing number. BYD, on the other hand, you look at the sales year-to-date, up almost 300%, 276% year-to-date, picking up some of that market share, really closing the gap a little bit there with Tesla. That being said, Tesla has production within Europe. BYD does not yet. They're paying tariffs on those cars. So imagine once they start rolling cars off the assembly line without tariffs, what BYD is going to do to this market.
Fast-moving situation, fast-evolving. Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the auto sector. Now, the CEO of ASML says Europe is losing the AI race to the US and China. Soaring demand for semiconductors has turned ASML into Europe's most valuable listed company. But in an interview with Tom McKenzie for Bloomberg Tech Europe that took place last month, Christophe Fouquet said that Europe needs to do more to attract the whole AI ecosystem.
If you look at the overall AI ecosystem in Europe, it's very weak in any way you look at it. And, today there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind. And it's true with semiconductor, right? If you look at semiconductor, basically take our shipment. The shipment of our system to Europe today is maybe 1 or 2% of our total business. And that's been the case for the last 10 years. So there is no buildup of semiconductor manufacturing in Europe, not advanced, not mature. Why is that? Is because there is also no consumption of semiconductor in Europe. Most of the consumption, as I said, of advanced chips are in the US because the company that develop the AI chips are not here. So Europe is behind, and to catch up, Europe has to create the condition basically to attract this entire ecosystem back to Europe. And that's a major task, to be honest.
Because we have the engineers, we have the researchers, we have ASML.
Yeah.
But Europe does not own the chip space.
Well, we have the engineers, we have the researcher. I would say we have the market. I think the European market is a great market.
The ASML CMO Christophe Fouquet speaking there to Bloomberg's Tom McKenzie. Coming up, we're going to speak to Christopher Evans, CEO of Collinson International, which operates one of the world's largest airport lounge networks, in plenty of use at this time of the year, of course. As we look at European equities on the Stock 600, now up 0.3%. We're waking up. The FTSE up 0.1%. The CAC 40 flat. The DAX up 0.2%. And as we look across the pond, pretty flat when it comes to Wall Street futures as we head towards the open over there. Plenty more to come. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
Want a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back. This is the opening trade. 30 minutes then into our trading session, and it seems as if markets have caught some festive spirit from somewhere, and we've returned to that positivity that we saw in global stocks yesterday. US futures had been pointing downwards just a little. Now they are flat to positive, and European markets seem to be gaining. It's not all Novo Nordisk that is having an impact, but it isn't all of that because we have the DAX higher by 0.2%. The CAC 40 is pretty flat. The FTSE 100 up 0.1%. But overall, Lizzie, gains of 0.3% on Tuesday, the 23rd of December. Maybe we'll take that.
Well, certainly it looks like the 23rd of December when it comes to volume this morning, Anna. Look at it here. Really not much to be writing home about when it comes to the volume. Actually now turning negative. But as you say, you've got more members higher than lower this morning. Gains for the stock 600 as a whole. If we dive into who some of the leaders are, we've talked about it at length already today. Novo Nordisk, the standout gainer this morning, up 5.6% on the US approval for its obesity pill. Hopefully, Novo will hope it can give it a lead on Eli Lilly by a couple of months. But this bringing up healthcare as a sector, it's leading the sectoral basket. And if we flip over to the laggards as well this morning, we have some losses, including for Richemont as a whole, luxury suffering a little. Schneider Electric down 0.3%, and Diageo down nearly 1% this morning. It's near its weakest level since 2017, Anna.
Lizzie, let's focus in on some of the other stories we need to keep across this morning. We'll start with precious metals. Gold is trading at a record high, the 50th day that it's done so this year. Silver also at a new all-time peak. Gold's Haven appeal has also been amplified by rising geopolitical tensions and prospects for more US rate cuts next year. President Trump is warning Venezuelan President Nicolas Maduro not to challenge the United States. Speaking earlier, Trump also vowed to keep oil seized from a supertanker, but declined to say if he's looking to oust the Venezuelan leadership. Larry Ellison is providing a personal guarantee of $40 billion in equity financing for Paramount's bid for Warner Brothers Discovery. The move aims to give his son's company an advantage in its takeover battle with Netflix. Warner Brothers has confirmed receipt of Paramount's amended offer and said it will evaluate. the proposal. Lizzie.
Well, it's that time of year when we're thinking about travel, going home for Christmas, and as global airports face unprecedented overcrowding, the world's largest lounge networks pivoting toward ultra-exclusive private terminals to bypass the terminal congestion. The new tier aims to restore premium exclusivity by moving high-net-worth travellers away from the standard airport crush. For more, we're joined by Christopher Evans, CEO of Collinson International, who's behind all of this. Good to have you with us, Christopher.
Great to be here.
I wonder what the gap was in the market that you were trying to fill with this new pass.
I mean, we've seen a strong rise in the kind of ultra high net worth individuals. They're looking for something particularly special, a really elevated experience. And what we're looking to do is launch a brand new solution that brings the same experience you'd have from flying with a private jet to those that are flying on commercial jets. So as you said, there's an off-terminal opportunity bypassing the security challenges that you have, which means you can then go into a very premium location and then take a limousine straight to the plane.
OK, so how different is it from the lounges that are already there? What does it get you access to?
I mean, it gives you access really to the speed through the airport, often bypassing that challenge within the airport. So people are looking for the ability to minimise the time they spend in the airport and then an increased level of luxury and exclusivity in the lounge. And as I said, getting the opportunity to go straight to the plane is another level that hasn't been experienced typically.
Christopher, good morning. So it seems that it's about speed. It's also just about solitude. It's about being without other people. Is that something that is driving demand for this kind of product?
It is indeed.
There's some of those lounges that are in existence that get pretty busy.
Too busy, Christopher.
I think what we've seen is there's incredible demand for airport lounges. It's probably the most premium desired benefit on credit cards at the moment. And yes, there is strong demand for it across the globe. So this really gives an opportunity to be away from those others in a much more refined environment.
So let's focus on London, because in London there's been much talk recently about the Windsor Lounge at Heathrow, which is actually a separate terminal, isn't it? A private terminal for customers who can afford to pay for that. And that gets you a lot of solitude. It probably gets you a lot of speed through the airport as well. Is that something that your new pass then, the Priority Pass Private, PPP, does that get you into the Windsor terminal and other places like that around the world?
It does indeed, and the Windsor Suites is a good example of that. And they really pride themselves in the level of service that they offer. I was talking to the person that was running it, and they ensure that no one will meet any other people within those different suites. They coordinate your whole route through that.
That is our idea of luxury these days, is it? Such a busy world.
It is. And some people that go there actually want incredible privacy. They don't even want to have others know that you're even in the country. So they manage that in incredibly careful and considered fashion, and have been doing so for many years. And it's that type of experience that we're replicating across the globe.
Well, what's your strategy to keep it feeling exclusive? Is that's what people want? Do you have to up the price when it gets too busy in the lounge?
So this will indeed be a very different tier. We're going to be very considered about the number of people that are invited into that programme. We're assuming it will be an invitation-only programme for Priority Pass Private. And yes, within the main Priority Pass network, we are seeing the need to kind of tier the offering. We're looking at bringing in solutions such as pre-book, so people can guarantee that access when they arrive at the airport, something that's been incredibly popular since we've launched.
And so does your strategy basically mirror what's going on in airlines? Because you've had expansion of the premium offer from airlines. Is that what made you want to do this?
It's really listening to our customers and our clients who have kind of highlighted this need and this opportunity. But we are seeing, as airlines are increasingly tiering their offering, we're seeing that within the main lounge network. So our own locations and joint venture arrangement in the UK has kind of a standard VIP lounge and then an elevated lounge experience called club rooms. And we're seeing the demand for higher-end experiences and are catering that by building our network with a range of quality of experiences.
And where do you expect demand to come from for this kind of product? Is it sort of high-net-worth individuals in the Middle East? Is it the US? I mean, I'm sure you'll say global, but what are the dynamics you're watching?
So we're actually launching it in the Middle East, so we see particular strong demand there. If you look at the number of growth of millionaires in the UAE, for example, it's the second highest in the world. So that's our launch market. Very strong demand within the Middle East, but we are building out that network globally, so across Europe and the US, and talking to our key clients across the globe. There is strong interest and demand for those most premium, most valuable customers.
I do have to ask you, the transatlantic route, have you seen, do you expect there to be less demand of European travellers going to the US or vice versa because of the Trump administration?
I think we've seen a slight small drop-off in some of that transatlantic routes, and we see it through our insurance business as well. Much more pronounced probably from Canada, but actually we're expecting it to be more of a short-term trend. There is very strong demand for those travel routes and those travel corridors.
And how much of the demand for your services is premium and corporate, I should say?
Probably the largest percentage of our business is B2B2C, so it's really premium banking customers that typically take that on a credit card basis.
And as we're not worrying about global recession right now, far from it. We talked to lots of strategists who are very excited about the prospects for global growth next year, talking about the AI boom and other things that they're leaning into. I mean, what do growth rates look like for your kind of product at the high net worth sort of level? Is this a booming sector?
I mean, it's a very strong growth sector, actually. So you're seeing travel growth is very strong. So we're expecting more than 5% growth coming into next year. We're expecting peak seasons. We saw the highest ever number of traffic through Thanksgiving. We're expecting the same within the UK over Christmas. Probably more than 300 million visits across the festive period. But yeah, there's married to that is strong demand for elevated experiences when people travel. People are looking to really start their journey with something special, which means there's strong demand for things like lounge. And the premium card markets are growing across the globe, both in mature markets such as the US, but we're also seeing that in emerging markets.
OK, Christopher, thank you very much. Thanks for joining us. Christopher Evans, CEO of Collinson International. Up next, the Bitcoin breakdown. We will be diving deep into the market and looking at the rise and fall of Bitcoin in 2025. What are the prospects for next year? Stay with us. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
To see price actually slide this year on Bitcoin and generally in crypto markets. People are talking about the cycles, of course, of the crypto markets. But my view on capital markets and Bitcoin markets is always a long-term view. I have no doubt that this is a correction eventually into higher prices in Bitcoin and into the transition of more than $100 trillion becoming digital assets over the next 20 years.
When we look at where we are a year from now, it's been overall very positive for the space, and we've seen much more regulatory clarity coming out of this. And I think getting into next year, it's we're past a point of no return when it comes to regulation and institutions interacting with crypto markets.
Some of our guests talking about the volatility in the crypto space. You had Bitcoin sprinting into 2025, full of potential, but since reaching an all-time high in October, the biggest cryptocurrency has been pretty fragile. Traders revamping their approaches heading into the new year. We can get a view on some of those with Ana Herrera, Bloomberg's senior crypto editor. She joins us now. Good morning, Ana. Just walk us through whether Bitcoin has the ingredients to rise in 2026. Rise again.
I mean, it certainly does seem so, right? The environment, as some of your previous guests were suggesting, is very changed, right? We have now the president of the United States, a big crypto fan. There's legislation in the U.S. supporting crypto, more legislation coming. We've seen banks starting to offer crypto trading to some of their retail clients in Europe. And yesterday we reported that JP Morgan Chase, U.S.'s biggest bank, is considering offering crypto trading to institutional clients. You know, all the big asset managers have ETFs. So obviously the environment is very changed from, 2022 when there was a big crypto crash. But despite this, the price has been a bit disappointing towards the end of the year. We had a big crash on October 10th, and it's been Bitcoin has been in a sort of funk since then. So we'll have to see what happens next year.
Yeah, so heavy going, despite all the positives in that sort of setup, that regulatory setup that you point out, Anna. Thinking about some of the clues that people look to here, the digital asset company Strategy Inc. has raised cash reserves and paused Bitcoin purchases. Now, does this signal something of a bear market? Does the market watch really closely what Strategy is up to?
Yes, one of the biggest trends this year was these digital asset treasury companies, and obviously the model was pioneered by Strategy. And the fact that they paused purchasing must, for some, signals that they think a crypto winter is coming. But maybe they could also say, well, actually, we think maybe the price will go up and it's not a good time to start buying again right now. So it is, again, one of those big trends that was leading this year, and we are seeing perhaps unraveling towards the end of the year. But again, we'll have to see what happens to all these digital asset treasury companies, most of which are not even following Bitcoin anymore, but some of the smaller coins.
Okay, Anna, really good to see you. Bitcoin now down 0.8% at $87,515 a token. Bloomberg senior crypto editor Ana Herrera, we thank you. Well, having a look at what's on the diary this morning, we have at 1:30 p.m. London time US GDP numbers coming out, durable goods as well, followed at 2:15 p.m. by US industrial production figures, and then at 3 p.m. by US consumer confidence numbers. And then at 6:30 p.m. we have a Bank of Canada policy summary. So still plenty on the diary.
Yes, there is a bit of data, isn't there, out the United States? Certainly. It is the 23rd of December. We'll see how much we have to talk about in terms of data tomorrow. But for today, we have some data. Sticking with the United States then, Bank of America CEO Brian Moynihan says the US economy will be strong next year, due in part to companies ramping up their AI investments. He spoke to Bloomberg about what he sees as AI's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at customer or client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in a 4.5%, which is very consistent with a very solid growing economy. At the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster. But even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, or 40-year, it's 5% and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
Bank of America CEO Brian Moynihan on Bloomberg's Wall Street Week with David Weston, and talking AI there and what it can do, Lizzie. And I think next year is going to be so fascinating, isn't it, in terms of the questions we're going to be asking around AI. Just so many of them. I mean, from a big macro perspective, we're going to be asking continuously what impact this is having on the economies around the world, on jobs, on growth, and our corporates really seeing the returns from the investment that they're making, because that's really going to be about the truth about what this delivers.
Yeah, one conversation that really stands out to me from 2025 on this programme was with Karen Ward at JP Morgan Asset Management, and saying really that she's focused on the business to business, the B2B impact of AI more so than consumers. She told me that consumers don't really pay for this sort of thing, and I said to her, I buy loads off Instagram, Karen, but she says, the big AI companies can't rely on that to give back the return on investment that they need from all this CapEx.
And one of the things that's really important in the differences between the late 90s and now, and the big boom we had around internet stocks then, was that there was a lot of fuss about the fact they weren't profitable. And now the companies that are investing so much in AI, they are profitable. They have free cash flow. They can spend it on some of this CapEx build out. But that's not necessarily the case of everybody in AI, is it? So some of the large language models, waiting to see who's going to pay what to use some of those products, that will be part of the conversation as well as we are going through 2026.
Yeah, you have the likes of Jeff Bezos saying that, yes, there'll be societal benefits, but there'll be lost investment along the way. So I suppose in 2026, that's when we find out where that money gets wasted. But look, we've got a busy day in terms of the economic calendar as well. We're expecting a handful of releases in the US, including the GDP and durable goods numbers. For more, we're joined by Bloomberg's cross-asset strategist, Ben Ram. Ben, which are you prioritising out of these data releases?
Morning, Lizzie. I think that the third quarter GDP is expected to show a modest revision. This is the second reading. But what I will be looking at is the personal spending. If personal spending is forecast to tick higher, and I think that if personal spending keeps going robustly, I wouldn't be worried about the soft patch in the U.S. economy. I think that, what is pertinent to keep in mind is that the Fed, in the December dot plot, they showed in the summary of economic projections, they projected growth of 2.3% for next year. That's well above trend growth of 1.8% and also a revision of 0.5 percentage points, which is a pretty significant acknowledgement of the productive boost that AI is expected to deliver. So at this point, today's data is not going to be groundbreaking. But it looks like, as Brian was saying, mentioning earlier, I think the labor market is flattening out. But I think that the overall augury for the U.S. economy is pretty good.
Yes, and let's go to Japan then, Ven. If we can park the US for the moment, let's go to Japan, because there's been a lot of focus on Japanese assets as we get towards the end of this year. We've had this interview with the Japanese Finance Minister, Satsuki Katayama. Really interesting comments there about having a free hand, that being interpreted by markets as having a free hand in terms of US pressure to intervene in currency markets. And we're seeing that the market is listening. The yen is up by 0.7% today.
The yen is up on some short covering for sure, but I think that there is no alarm in the markets. If you look at the options market, Anna, what the volatility pricing is subdued on US dollar yen cross, and I think that speaks to the market's frame of mind that, look, we've had plenty of jawboning from the Japanese authorities over the past couple of months, coinciding with Takaichi's ascent to power. But the markets are thinking that, look, this is all bluster and this is not going to go too far, because if you've got real inflation, real rates in Japan trailing elsewhere and in deeply negative territory, you've got to acquiesce to a weaker yen, and that is what we are seeing. And that fundamental trajectory can't be changed by no matter what the finance minister says about the scale of intervention. Yes, the yen has the potential to rebound on any intervention, obviously, but the question is whether it's going to stick. We have seen prior intervention episodes last year when the yen bounced back huge, but then went all the way back and brought us back to the state we are in at the moment.
Ven, I'm looking at the euro up again today against the dollar by 0.2%. 117 is where we're at today. How much is this yen recovery actually about the euro rather than the words from the finance minister on maybe an intervention?
Definitely early in the Asian morning, it was the euro that was helping the yen rather than anything about the intervention comments. So it only speaks to the fact as to what I was saying earlier. It's the markets are by now very well inured to comments from Japanese officials about the yen trading at a significant deviation from its fundamentals. We all know that the yen is one of the cheapest currencies, if you look at the real effective exchange rate. But to what avail? In the short term, what matters to the markets is the real inflation-adjusted interest rates. And if inflation-adjusted interest rates are not going to keep up with the inflation, I think that the yen is going to be a laggard, no matter what the Japanese government says.
OK, Ven, thank you very much. Ven Ram joining us there from the Markets Live team with thoughts on what we're seeing in Japan and what to make of the data that we're going to get out later on today. So the GDP print could keep us busy to some degree later on in the session. Lizzie, in terms of markets, what we're watching the gold price. Of course, we talked about this at the top of the programme. 50th record in 2025. Plenty of drivers there, up by 70% year to date. Silver also on the rise. We're also watching what's going on with Novo, though. And Novo Nordisk could be a real focus for markets, given a lack of corporate news flow today, but the stock up by 7.4% on the back of that US approval.
Yeah, and interesting that it's actually boosting some of the other healthcare names this morning. Actually, healthcare is the best performing sector across the continent, up more than 1%. So that competition between Novo Nordisk and Eli Lilly, good news not just for Novo with this progress on Wegovy, but also seemingly for the other drug makers as well.
Yeah, absolutely. So will they get this head start that seems to be so important in terms of pitching their product to customers against that rival Eli Lilly in the US market for pill-based obesity treatments? And we will be hearing from the Novo CEO. That is that conversation coming up in surveillance. Mike Dustar will be with the team, the surveillance team, at 1:15 London time. That is it, the opening trade. We have European equity markets putting a brave face on things and actually managing to eke out some gains this morning. The FTSE 100 up 0.1%. The CAC 40 underperforms a little bit. The Stock 600 up by 0.2%. As we head through the European session towards the US Open, US futures are flat to negative. I'll be back with the pulse in the next hour. This is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Danish pharma giant Novo Nordisk jumps after winning approval to sell a pill version of its blockbuster Wegovy obesity drug in the United States. The yen leads G10 currencies higher after Japan's finance minister repeats Monday's stern intervention warning. Plus, President Trump says the US has to have Greenland as he renews his push to take control of the world's largest island. Welcome to the Pulse, everybody. This is a picture of the markets as they stand right now. S&P futures are suggesting a little bit of downside at the start of trade. Gains globally in Monday's session. Looks as if that Santa rally just stalling into Tuesday. US 10-year yield at 4.14%. The yen is fighting back, up by 0.6% or so against the US dollar. 155.89 is why we trade. The market seeming to listen, at least in part, to what we've heard from the finance minister in that verbal intervention. And gold spot trading a lot higher at 44.89, a lot higher this year, and marking its 50th new high for the year, new record high. Let's get to the European equity markets then, and this is the picture across these markets for you. pretty range-bound, pretty flat across European stocks. So the FTSE 100 just up 1/10%. The DAX just keeping its head above water in positive territory. And the CAC 40 down by 0.2%. You can also see a little bit of weakness coming through on the IBEX. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning. Now, Novo Nordisk is rallying after the company secured US approval for a pill version of its weight loss jab, Wegovy. It's a positive end to a very difficult year for the Danish drug maker, which has seen its market cap roughly halve in value up against stiff competition these days. Let's get to Bloomberg's Copenhagen Bureau Chief Sarah Scholin, who joins us now. Sarah, good to speak to you again on this. I mean, how significant is this news then for the Novo Nordisk business?
This is obviously really, really good news and significant for them after, as you rightly say, Anna, it's been such a brutal year for them. This was not entirely unexpected. Novo had already guided that they would probably get the approval before the end of the year. And in Denmark, we're closed for the rest of the week and then two days next week. So they really had to get the news out about now. But this doesn't really take away from them that this is really good news. And we've had, to be honest, it's just been such a rough year over here for Novo Nordisk. The share is down almost 50% for the year. It's helped a little bit today. It's actually moved below that. It's not down 50% anymore in the year. They lost a lot of market share to Eli Lilly. They issued several profit warnings. They had to change the CEO, change the board. They laid off 11% of the workforce. It's just been like such a tumultuous year for them. And now they're really going to start 2026 on a high note, and they're already rolling out the launch of the Wegovy pill in January, so we don't even have to wait long to see if there's a big uptake for it.
And so you've talked about some of the challenges. I mean, is this, Sarah, something that might help to reinvigorate the Novo share price? It's certainly under pressure year to date.
Well, it certainly looks like it today. As you said before, and it's up 7.5% today, and it's quite thin trading. All the Danes are probably left for the summer houses and the holidays at the moment, but they're all going back into it now to see how Novo Nordisk is doing. What was really going to be, I think, a key test for Novo Nordisk, whether this can or cannot reinvigorate the stock, is if they can keep this first mover advantage over Eli Lilly. So we expect Eli Lilly to get approval for their obesity pill maybe in March, April next year. So it gives Novo Nordisk a 3 to 4 month head start against Eli Lilly. Novo Nordisk has had a first mover advantage before. They basically created the entire obesity market, and then they lost it in the end a little bit to Eli Lilly. They weren't really expecting so much popularity. They weren't ready. They didn't have the capacity. But now they have a new management. They learned from the previous failures, so maybe they can keep this first mover advantage against Eli Lilly.
OK, yeah, we'll see how that competitive landscape then shapes up. Sarah, thank you very much. Bloomberg's Copenhagen Bureau Chief Sarah Scholin. And we will be hearing from the Novo CEO, that's Mike Doustar, later on during surveillance programming. As Sarah says, new management team in position, relatively new, so 1:15 UK time, that conversation on surveillance. Thinking about the US economy and how it fares, the Fed Governor Stephen Miron says the central bank could risk sparking a recession unless it continues to lower interest rates next year. Speaking on Monday, he also told Bloomberg that data on housing costs has been impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown. But it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We've got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech at Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's the kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance?
So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
That was the Fed Governor Stephen Myron speaking to Bloomberg about his views on the US economy. Let's stick with that theme and speak to Thomas Romig, who is multi-asset CIO at Assenagen Asset Management, and joins us now. Thank you so much for being with us, Thomas. So we were just listening to an interesting conversation there, Stephen Myron from the Fed, talking about how he sees the need for rate cuts to continue into 2026. When you look at the US economy as it is, as we get ready for the new year, do you agree that it's an economy that will need further rate cuts?
Our view is that we will see the priced-in rate cuts. So the market currently prices in 2 to 3 steps in the next 12 to 18 months. So we are seeing quite stable growth surrounding in the US, and we see more the surprises in inflation on the upside than on the downside. So I think it will be a tricky year for the Fed. In Europe, we have a flat valuation by the market because of interest rate moves. So it will be very much the focus on the Fed, and it will be a tricky year. So we think maximum 3 steps down, maybe only 2, because the economy is stronger than most of the external participants think.
Yeah, I mean, Thomas, I spoke to a couple of guests this week who said perhaps the central bank conversation, the Fed conversation, takes more of a backseat this year. Of course, there will always be the politics and no doubt a lot of news flow around that. But that actually the fiscal stimulus in the United States is something that we need to watch more. How does that fit into your asset allocation?
Definitely. So we don't look especially on 2026. We are convinced that most of the governments on the globe which have to do with global economies are learned a lot in the COVID phase. So they will focus on fiscal stimulus, and it will be, yes, supported by the central bank policies. So I have the same view. Fiscal policy will be in the front row, and we have to look and watch what is done there. We are in a mid-cycle year next year, so we think that the Republicans will do everything to keep the economy up and proud.
OK, and does that mean an inflation risk then, Thomas? I mean, you talked about how, you see inflation as being a bit sticky. Are we going to see inflation? Yeah. Are we going to see a Fed that accepts inflation above target in 2026?
I think that will be the tricky question, to give support to the economy and to keep an eye on inflation. We think that if it ends up, they will accept a little bit more inflation towards 3%. And that's the name of the game. So we see more potential for surprises upwards in inflation globally, also in the US, than downward.
Okay, let's talk about the euro area. You join us from Frankfurt, Thomas. We see an expectation in markets that the ECB is on hold through 2026.
Yeah.
Is that your expectation, and how will that support investments in Europe?
Yeah, so look at the situation. So currently we have an interest rate of 2%. That's not high. So if you look for historical comparisons, 2% is low. And we have still a lot of processes which will keep up, especially core inflation, above 2%. And then you have to look at the oil market, energy market. I think we are quite supported with oil prices around 60. So if you maybe get a surprise on the energy side of 70 to 80, then you have the inflation game on the desk again. So we don't see any room for interest rate cuts in Europe, the same as the market sees it. So there are no cuts priced in currently in the Eurozone.
And Thomas, can you give us your insights and your assumptions when it comes to how much the German fiscal package is going to deliver for the German economy? Because on the one hand, investors get very excited about the overall euro amount attached to defence and infrastructure spending. On the other hand, plenty of investors tell us their expectations are muted because they're not sure how quickly these positives will come through.
We think the positives will come through, not in that volume which was expected at the beginning. So there will be some delay, but we would think, or we see that it will be a 1-2 year boost to Germany and also to the Eurozone, especially in the industrial sector. So that is, but it's already priced in. So we will see how it works through the system, and we think that we will get positive signals also to the other sectors here in Central Europe, and that will hold up also the equity markets and the economy here in Central Europe.
And what about thoughts on emerging markets? Are you looking actively at opportunities in emerging markets, and how much does that still depend on what happens with the dollar?
Mm-hmm. Yeah, we currently, if you look into our portfolios, in our multi-asset portfolios, we are quite short on duration. We don't like a lot of government bonds. We like emerging markets, both bonds and equities. We have a better surrounding the framework they have established over the last 10 years on average, always on average, is really compelling. So we see, in conjunction with a maybe weaker US dollar, more support for emerging markets, for emerging market bonds, even corporate bonds, and also emerging market equities.
And is it dependent on that US weaker dollar, though, Thomas? If we don't get that, is the emerging market trade at risk?
If it trades around 115 to the euro, not below, we see that the signs are green for emerging markets. So we would rethink our positioning if we go below 115, 114 against the euro. So that would be our trigger point to think about changing our positioning in our quite successful multi-asset portfolios.
And are you concerned about AI overvaluation, about bubbles, about comparisons with the late 1990s, Thomas? Or do you think 2026 will deliver more positivity on that theme, just as we saw in 2025?
We expect a more broadening in the development of the risk market, so not that much focus on the MAC 7 and RE theme. We think that we will get a broadening towards the other regions like Europe, like emerging markets, but it's not a negative outlook for all the AI positive stance. So I think a lot of expectations are priced into the valuations, and we're seeing already since beginning of the second half, a broadening in the interest of equity investors, so towards emerging markets, towards materials, even towards Europe. So we see a more broadening and maybe not this exceptional status of RE investments or RE-driven stories or stocks anymore in 2026.
Thomas, thank you. Thanks for your time. Thomas Romig, multi-asset CIO at Assenagen Asset Management, joining us there from Frankfurt. Up next, the Bitcoin breakdown. We'll be diving deep into the market and looking at the rise and fall of Bitcoin in 2025 and what to expect from next year. That is next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
If you look at the overall AI ecosystem in Europe, it's very weak in any way you look at it. And, you know, today there could be a debate about will the US or China win the AI race. I think it's clear who is losing it today. It's Europe. Europe is behind. And it's true with semiconductor, right? If you look at semiconductor, basically take our shipment. The shipment of our system to Europe today is